Good morning. Stocks set to jump again following a solid session on Wall Street yesterday. The S&P notching its best day since late November. And a big morning of earnings results rolling in from Pfizer, UPS, Alibaba, and more. We're going to bring you the highlights. And is the silver streak over already? Well, the precious metal falling in price after yesterday's spike. We're going to talk to the CEO of Miner Wheaton Precious Metals about what it's like to be in the eye of the Reddit storm. Final hour Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin on Groundhog Day. Groundhog Day, U.S. equity fuel. We already played the Sonny and Shay right at the top of the show if you missed it. It's always playable, though, and reminds everyone of that great movie. One of the top 20 comedies ever made, I think. He's got a few of them, old Bill. Anyway, we're up 238 points now, or 239 on the Dow, up about 98 on the NASDAQ, the S&P up about 28. We keep checking silver. Just checked another quote on GameStop. Maybe we'll look at that, too, at some point. But as you can see, silver down about 5%. GME, at this point, you've been watching this, guys? I got a 138 bid. So down 30% yesterday to 225. And now down from 225. I got it at 140. I got a 138 bid right now. So 30% yesterday, 37% today. I don't know what to say about that other than we said all along when the shorts get covered, what's it worth? What's it worth when the shorts get covered? Did anyone ask that question? Well, we did, obviously, but
yeah, a lot of people.
I don't know what the company is. I don't know what the company is actually worth. And I love when people say, you know, maybe the Chewy guys got some great plans. Who knows? Maybe they do. Maybe there's some online business model that works for a brick and mortar, right? I mean, that I guess you could somehow justify, you know, a 2,000% run up, but I don't know. What do you think? Does this go back up to 500 at this point, or is the fever broken at this point?
Look, I wouldn't proclaim to know what's going to happen with different investors who try to get in and run with this. We knew from the beginning that you may double a stock, and that looks outrageous enough. But when you're trading at 20 times what you were a couple of weeks ago, there's something besides fundamentals that are at play there. So I think it'd be almost impossible to say because it hasn't been a fundamental move that's been driving this for quite a while.
Right. And Hollywood's weird, isn't it? There's a couple of movie versions in the works already. They have. I hear when they make a movie, they make 3 different endings. They have no idea what the ending of this is going to be. Wouldn't that matter on the?
Ben Mesrick is doing one of them, and you know he did the Social Network before. This one's the Antisocial Network. I would sign up for that. Yeah.
Well, I'd like to have some idea what the ending is going to be before I sign on. I guess maybe it doesn't matter. Anyway, earnings. We're seeing maybe the beginning of the ending here, or who knows? I have no idea. Nothing surprises me anymore when you hit up some of these 3-letter symbols, whether it's GME, AMC, NOC, NOK. Sorry. Rolling in this morning for some of the biggest companies. Pfizer reporting a top-line beat. But missing on the bottom line for its latest quarter. The company is raising its full-year earnings guidance amid positive results from Pfizer's coronavirus vaccine. And shipping giant UPS scoring top and bottom line beats for its latest quarter. Among the factors, a nearly 8% increase in revenue per delivered package in the United States. And Alibaba also reporting better than expected profit and revenue for the fourth quarter, helped by growth in active users as online shopping has boomed. Alibaba also saw growth in its cloud computing business. Becky, Honeywell.
Thanks, Joe. Yeah, industrial giant Honeywell teaming up with other organizations for a vaccine pilot inside the Bank of America Stadium in Charlotte, North Carolina. That's where the NFL's Carolina Panthers play. Over the past weekend, 20,000 shots were given to residents. Joining us right now to talk about this phase of the fight against COVID-19 in an exclusive interview is Honeywell's CEO, Darius Adamczyk. And Darius, it's really good to see you this morning. And people have been watching and kind of seeing what you all have done here and have been amazed. But I'd like to take a step back and kind of talk about where the virus is right now. This is something you talked about on a conference call last week when you reported earnings. But you said we're really at potentially a worse place right now than we were a few months ago, just based on where coronavirus is. What are you seeing around the globe? And tell us how difficult things are in terms of trying to see any forecast.
Well, thank you, Becky. Nice to be with all of you, as always. As I talked about on the earnings call last week, the good news is that the virus rates are falling. They're certainly falling in the U.S. and other places around the world. But we have to remember that they're falling off of all-time highs. And we're at a place that the virus has been circulating in our populations at a rate that's never seen before, including going all the way back to when the crisis started in the March-April timeframe. So I think it's really important that we keep that in mind, is that directionally we're going the right way. We're starting to see the pickup on the vaccination rates, but we still have a long way to go. And that's why we put the event together at B of A with our partners, Atrium Health and Tepper Sports.
You're a global company, so you see this playing out in different places around the world. Where is your greatest area of concern right now, just watching this?
Well, certainly Europe we're concerned about, because we see the slowest rate of rollout of the vaccine. It's it's a place that frankly doesn't seem to be able to get access to the vaccine. It's going slow, and we certainly hope that that picks up. Probably a country like India, we're also watching very, very closely. Obviously, very large country, large population. Logistics are challenged to get this vaccine out to 1 billion people. Is a big logistical challenge. Let's forget some of the vaccine availability. And, this is why I'm such a strong believer, and some of the partners that we played with, is that the way back to normal is through these mass vaccination events, particularly as the vaccine becomes more readily available. Let me just give you a few statistics from this past weekend, because I do think that this is important, which is we were able to vaccinate a person every 4.5 seconds. We got through 20,000 people. The average wait time, and that includes the 15 minutes of people sitting there after they have the vaccination, was roughly about half an hour, even a little bit less than that. And this is all possible. And by the way, the other statistic that I think is really important here in terms of equity, 30% were from communities of people of color. So we had really nice representation in what we did. And we did this in a course of 3 days, Friday, Saturday, Sunday, 12 hours a day, 20,000 people. So just think about if we could do that, set up 50 or 100 of these kinds of sites across the country. Granted, right now we're still constrained by the vaccine. But now hopefully we'll have the J&J vaccine approved in a matter of a couple of weeks. Whether it's Novavax, AstraZeneca vaccine should be coming right behind that. And I really hope that we move to this kind of a model, because at the end of the day, this becomes a queuing problem. And the right way and the most efficient way to solve the queuing problem is to have very large, very efficient distribution centers spaced out throughout the country, throughout the states, and very quickly get these vaccines into people's arms. We have a great deal of passion around this, and we're proud to participate with our tremendous partners, Atrium Health, with great support from the governor of North Carolina, Mandy Cohen, who's our HHS leader. They were fantastic, because they basically said, we're going to allocate you some vaccines, we're going to give this a try and see if you can make it work. And we were thrilled with the outcome.
Darius, correct me if I'm wrong, but this came about because you were out on a walk with two of your friends at these partners that you mentioned, and you were all frustrated with the pace of the COVID vaccine rollout at that point. What happened? Kind of walk us through that story.
Sure. Now in the COVID era, one of the social things you can still kind of do is go for walks outside with some of your friends. So that's sort of what we do on weekends sometimes. And I happen to have gone on a walk with Tom Glick, who's the president of the Panthers, and Gene Woods, who's the CEO of Atrium Health, and they both happen to live in my neighborhoods. And we were looking at the rates across the country. Said, maybe we could help here. Maybe we could partner as a team. Obviously Panthers having the large stadium, used to moving a lot of people through that facility very quickly. Atrium Health, obviously, with having the expertise on the medical side and dispensing of the vaccines and all the things that go with it. And then us as logistics, warehouse distribution company, and then adding our technology to this whole process. So, for example, we added cameras which really detect the number of cars and people, because at the B of A event, we had both people and cars. And we said, if we put all these technologies together and capabilities together, we think we could do something differentiated. And I've got to thank our mayor, thank our governor for really taking a shot on us, because this could have been a disaster. But, we did an event at the Speedway the weekend before this last one. We vaccinated 15,000 people there. We just did 20,000, both in a matter of 3 days, only operating half the day. I really hope that this is our future, because we have to get these vaccines into people's arms. And there's two fundamental reasons for that. The first one is we got to get back to living our lives again. We got to get back to good economic times. And the fastest way we can have the economy recover is to get people vaccinated. But the second one, and I always enjoy your conversations with Dr. Scott Gottlieb, the other thing that to remember is that the bigger the population is available to having this virus really move in the population, the more likely it is that we're going to have a variant that we can't deal with. We already have some troubling variants coming in from South Africa and the UK and so on. But the bigger the population that's not immune to this virus, the higher the probability of us getting a variant that's going to be hard to deal with.
Darius, I think it's really interesting that you all were able to open this up to such a broad swath of the population in Charlotte, and that you had 30% that came through that were diverse people of diversity. And I think the reason this is so important is, to this point, I do think that those who are connected, those who are wealthier, have probably gotten a larger portion of the vaccines that have been out there. If you happen to be connected to a hospital group, you're far more likely to have gotten this. I think that this model is interesting for that reason alone, to make sure that it's an equal opportunity for everybody to be coming through the doors. I worry about that a lot. How did you guarantee that anybody and everybody could get in? Did you just have to sign up by, I guess, hitting refresh, trying to get an appointment? How'd it work?
Well, I got to give all the credit to Atrium Health for that, but they basically opened up some of the schedule more to some of the diverse groups, some of the church groups and so on, to make sure that they had access to some of the scheduling. And because of that, we were able to really get that kind of a representation, which is terrific. And obviously that's been a challenge. It's going to continue to be a challenge. And I do think, I have an opinion on this, that we also have to really support this at the national level. And there's an effort by the BRT, the Ad Council, supported by Salesforce, and will be supported by Honeywell as well, where we really get some influencers, whether it be political figures, entertainers, athletes and so on, that really demonstrate that they're embracing this vaccination effort, that they're taking the vaccinations themselves. And, even if this sort of, jumping out of line concept, the number of vaccines that would be required to really on TV vaccinate some of these people is inconsequential versus the benefit we're going to have in a more equitable distribution of the vaccine itself. So I'd really hope that we see more of this kind of advertising national support, because we'll work it at our local level, like we did here with partnership with Atrium and the Panthers. But we really need some broader help at a national level through the Ed Council efforts, and hopefully many like it.
Well, to that point, you said that you like watching Dr. Scott Gottlieb, when he's on with us. He has definitely given us a ton of great information on this. He's been of the opinion that we should really roll these vaccines out to the big boxes, to the Walmarts, to the CVSs, to the Walgreens, because those are in everybody's neighborhoods and it's easier for them to access it. And that would do the same thing, really open it up to the general population to make sure that anybody and everybody can get access to that. That's kind of counter to the method that you all have put forth here. How do you kind of square up those two different ways of going at this?
Yeah, well, I think for now it's really kind of a moot point because we really still have a constraint on the number of vaccines that are available. But, frankly, each state should be using up the vaccines every week that they're allocated. So, the delta between administered and actually distributed every week should be zero. They should be consumed on a weekly basis. So right now there's still very much a constraint. But hopefully in a few weeks' time, there won't be any constraint. And I really applaud what Walmart and Starbucks and the CVS and so on are doing there. It's terrific. But if we really want to move this very, very quickly and efficiently in facilities that are really designed for high traffic, like speedways, like large stadiums, I don't think that there's any other way to get a vaccine into people's arm every 4.5 seconds. I mean, that's what we accomplished at the FEB. And I think, we got to do this in phases. And I absolutely think that there's a place for the Walmarts, the CVSs, and so on. But I think if we have to prioritize distribution and speed matters, I think you have to go to these mass vaccination centers. And this is back to the queuing problem, which is, do you really want to design the system for efficiency and speed or convenience? And I would argue that for now, until we really get this up and running, once there's no vaccine restraint on capacity, we really have to design the system for speed and efficiency.
Darius, very quickly before you go, you mentioned that you got help from the governor in North Carolina on doing this. Have you had any conversations with the Biden administration?
No, not recently, but we're looking forward to that. And we'd love to engage, whether it's sort of some of the best practices, some of the technologies that we had, because, whether it's some of our software, some of our AIDC technologies and so on, we can contribute that. I mean, I'll give you an example. For example, people were standing there with clipboards filling out forms. We looked at that. We applied our software and AIDC technology, and that step went from 12 minutes to less than 30 seconds. So we're looking to engage and hope to engage with the Biden administration very soon. And I think we can add some value to the discussion.
Darius, when I applaud you and your partners' efforts at this, we really appreciate what you're doing, and we appreciate your time this morning talking about this. Thank you.
Thank you, Becky.
Take care. Andrew?
Okay. Thanks, Becky. Coming up when we return, the head of silver miner Wheaton Precious Metals is going to join us on his week's extreme volatility and where we go from here. But first, as we head to a break, check out shares of ExxonMobil, which are on the rise this morning. The company missed on the top line estimate for its latest quarter, but beat on the bottom line. The Wall Street Journal also reporting that Exxon expected to announce board changes as soon as today, pushed by investor D.E. Shaw. Stay tuned. You're watching Squawk right here on CNBC.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister, the Taoiseach Micheál Martin, sits down for the CNBC conversation.
Helping you navigate the new normal. Squawk Box on CNBC.
Watching the shares of GameStop right now, as you can see, down 30% yesterday, 41% today, down 91 points or so. In fact, we used to have a little bug on GameStop on the way up, but here on the way down, as you can see, we'll see. It could be a bounce, or maybe it continues. We'll see. Coming up, a pair of big interviews you don't want to miss with Dallas Fed President Robert Kaplan and the CEO of silver miner Wheaton Precious Metals. And check out the action in silver this morning after yesterday's spike. Silver pulling back a little. You're watching Squawk Box on CNBC.
Back in my day, the Supreme Court wasn't ruling that immigrants had to meet a certain wealth requirement to come to America. No siree, Bob. They only became wealthy once they married Donald Trump.
Financially, I believe everybody is in a very challenging positions and situations. We do have restructure some or most of our debts. We communicate and negotiate with our lessors already. But we are pretty much confident with the support of Indonesian government in making sure that moving forward, we can achieve what we are aiming, which is 50% of our target revenue compared to 2019.
Welcome back to Squawk Box this morning. We may be seeing, well, that the Reddit rally is flaming out, at least for the stocks that led it from the outset. GameStop shares down more than 40% alone just this morning, down now at $134. Movie chain AMC also seeing its shares plunging as well. And joining us right now, talk about whether we're seeing the beginning of the end of volatility in these names and what all this means to the larger market is Rupal Bansali. He's the Chief Investment Officer and Portfolio Manager at International and Global Equities at Ariel Investments. Good morning to you. Speak to these stocks for a second in terms of what you think they represent for the larger market, Rupal.
I think, frankly, not much. It's limited to a handful of stocks, and I think it's an extremely isolated development. The stock market consists of thousands of stocks out there, so I think we're making much ado about not much.
But you have a larger thesis, I think, which may feed into what we're seeing here, which is that we could see a correction this year, a significant one.
I think so. I think, you're seeing a lot of signs of a market top. And frankly, this volatility that you described amongst retail investors, chasing up a few names and trying to, again, speculate, frankly, rather than invest is just symptomatic of what we see in the broader markets. The record flows into high yield, junk bond ETFs, the valuations of the market, issuance of SPACs, IPOs, all of these things, typically tend to be signs of a market top. So I think expectations need to reset with respect to a vaccine-led rally, that we've seen underway since November. And I think the second half looks much more vulnerable, although the first half we may still manage through.
It's always hard to call what would be the tipping point or the trigger for a correction. But given that you're talking about a significant one, I think a double-digit correction is what I saw. What do you imagine the tipping point would be that would force that to take place?
Well, it's what always matters to the stock markets, which is earnings expectations. I think that we are just too far ahead of ourselves on a wide slew of companies and sectors and geographies. In fact, this morning, you had a couple of profit warnings in Germany, from Fresenius Medical, a dialysis company. So I think we still have to work our way through COVID. And I think expectations for 2021 will have to get reset. That, I think, will cause the pullback.
Does that mean that you're telling investors they should be selling stocks now, getting into cash, waiting for this to shake out? Does that mean that you're recommending rotating into, I don't know, you tell me?
Well, no, one should not try to market time. I think that it's important to reposition a portfolio and to always stay, invested in the markets, but in the right areas of the market. I think stocks in the twilight zone, as I call them, are a very attractive opportunity here. These are companies that are not cheap enough to screen on value investor screens, but they're not growthy enough to entice growth investors. But they're perfectly good companies, with steady growth at reasonable multiples, just not heady growth at hefty multiples. And some of the big pharma names like Glaxo and Roche in the international markets are good examples of this. They're perfectly fine companies, just don't appeal to the two extremes of the market.
What about in the United States?
Slim pickings. I think international markets offer far more opportunity, both from a stock market standpoint, but also from a currency appreciation potential standpoint. While in the near term, the dollar decline may have been arrested, but I think in the medium to long term, the dollar looks pretty vulnerable. And that means you can make two ways. You can make money two ways by investing abroad, through the stock market appreciation because it's more undervalued, and currency appreciation, which I think in the next decade will probably be a source of greater returns, idiosyncratic returns than people are expecting right now.
Okay, Rupal, thank you for joining us this morning and adding your insights and perspective. And we look forward to talking to you again very, very soon.
Good to be here. Thank you.
Becky?
Thanks, Andrew. When we come back, the head of Wheaton Precious Metals will join us live with his take on this week's volatility. His take on this week's volatility in silver and how he's managing his company in the eye of the Reddit storm. Stay tuned. You're watching Squawk Box, and this is CNBC.
The countdown to the open of the U.S. markets is sponsored by IG.
keep up with the crisis. Squawk on the Street on CNBC.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
As the Pakistan economy climbs its way out of the deep COVID hole, gradually the fiscal policy is also shifting towards greater restraint, while the monetary policy settings continue to be accommodative to support the emerging recovery. We think this is the right mix of macroeconomic policies to help Pakistan.
Welcome back to Squawk Box. I'm Mike Santoli. Let's get you a picture of where the market is set to start this morning. The S&P 500 over the last 6 months, some pressure has come off. Last week's 3.3% decline. Bit of a shakeout of some crowded positioning, both in the long and short side. You see yesterday's bounce actually did a lot to sort of relieve some of that pressure. Today we're looking to tack on maybe 2/3% on top of that. It's trying to get back up into this very orderly uptrend. It's in an area that it spent a lot of the month of January. So I still think there's a little bit of back and forth. Look at GameStop over the last 5 days. It's very interesting as a pressure point for this market that is now easing. The one day before yesterday, the S&P was up, was Thursday, and that's when GameStop was down. Every other day, you had a net gain in GameStop, and you had it working the inverse to the S&P 500. It just really was the focal node of some of that short pressure. It's not going to last. This is not going to be the tell for the market for a long time, but it has been for a few days. Look at silver. This was probably a little bit of an ill-conceived target for another squeeze. Yesterday, tremendous volume in the SLV. You did have a gain, giving some of that back right now. When you're talking about futures, talking about a global metals market, it's just not the same as trying to go after a short, a crowded short in an individual smaller company where people have to buy back the stock. Futures are a two-way street, Joe.
All right. Thank you, Mike. That's an interesting correlation, but we have noticed it. For a closer look at the recent silver surge and slump, let's welcome Wheaton Precious Metals CEO Randy Smallwood. How should we view it, Randy? We've stopped talking about those pesky fundamentals with a lot of things we discuss now. We just, we watch momentum. We watch, I don't know what you'd call it at times, but what happened with silver in your view?
Well, I think, there's such strong fundamentals behind silver. And when you look at silver and how it's been valued relative to other precious metals right now, especially compared to gold, I think the opportunity to just get those fundamentals out there and people see it, and it does look like a great buying opportunity. And so I'm not surprised to see, the retail crowd come back in and push it. But it is a bigger market. It is a much broader, global commodity, as Mike said.
Randy, I've been hearing that, though, for, well, maybe not all the way back to 1979, but I've been hearing about the fundamentals for silver. And it's been a well-known sort of a thesis. And, a lot of people advertise, there's a lot of companies that they're involved in silver and gold, obviously, that advertise across the board on cable. What changed in the last 3 months? Actually, I guess it was up quite a bit over the last year or so as well from what would be, I guess, historically depressed levels.
Well, it's just that, as we see mobility, and if you sit and look at how the world is changing right now, especially in response to this pandemic around the world and how important mobility is, silver is a crucial metal when it comes to mobility. Anything that has batteries and you want to have power last longer and be more efficient and have more processing power, silver comes into play. It conducts electricity better than any other metal. It has lower resistivity than any other metal. It's also got great antibacterial applications, which in today's world is also very, very important. And so this year has sort of really highlighted the strength. And you're right. A year ago, silver was trading around $15 an ounce. And so I'm still very happy at the prices we're seeing today.
How much of this is the Fed and the notion that this is another store of value and something that it won't be debased like fiat currencies?
Well, and there's no doubt. I mean, obviously, we're focused on precious metals, and about 60% of our revenue comes from gold. So we're a little bit more gold focused. I'd love to have more silver in our portfolio, but it's just not available. There's just not a lot of good, strong silver projects out there or byproducts available for us to purchase. There's no doubt silver always lags gold. If you go back and look at any of the strong bull runs in precious metals, gold always starts first, silver lags, but then it outperforms. Silver has higher beta. It always has, it always will. There's some just fundamental reasons. So much of it is produced as a byproduct. Only 30% of silver comes from silver mines. 70% of silver actually comes as a byproduct from copper mines and from lead zinc mines and from gold mines. And that just means that those mines don't change when the price of silver climbs. And that just gives you supply side pressure and you get a higher response. And so what I've seen here, gold's been on a good, strong bull run now for about 4 or 5 years. Silver has really woken up in the last year and a half, and I just don't see this stopping. Obviously, this little Reddit short squeeze that we've seen, or Reddit instilled short squeeze we've seen, has sort of highlighted some of those fundamentals in silver, and I think it's probably welcome. I think us in the silver market have now welcomed back in some of those retail investors that we haven't seen for a while. It's shaping up very nicely for us.
So you have seen that then that is responsible for what we've seen in the past 10 days or so. You've been able to actually detect that there are Reddit investors that have embraced silver after some of the other well-known names in the stock market that we've mentioned, and you welcome that, and probably Wheaton itself too, right?
Yeah, no, we've definitely outperformed. We've got one of the higher, in terms of percentages of revenue in the precious metal space. We're just around 40% silver revenue, or just under 40% silver revenue. So there's no doubt that we have caught a little bit of this wave, and we're probably going to give a little bit of it back. But we're not here for the short term. We build long-term value here at Wheaton, and we're focused on, with over 30 years of reserves, we're going to see a lot of days like this over the next 30 years of reserves, and a bunch of resources after that. So it's short-term volatility like this is part of the game in silver. Silver's always had a track record of being extremely volatile and sort of responsive. And so, we like it on the way up like this. When we see strength in precious metals, we're going to see days like this in silver again.
All right, it's all thrown into one. Randy, thank you. Appreciate your time this morning, and I didn't realize that. So a lot of it comes as a byproduct from other. Do you know what the stock to flow on silver is right now? What the actual number is? How long it takes to replace the entire supply, Randy? Do you know? Well,
every year we're producing worldwide, producing between 600 and 700 million ounces. We have seen peak silver production. That was about 4 or 5 years ago. We peaked at worldwide at just over 800 million ounces. And so again, because most silver comes from base metal projects, and copper prices have been depressed, and lead zinc prices have been depressed for a very long time, there hasn't been a lot of reinvestment into that space. And so we've seen a drop in silver production combined with higher demand on the industrial.
That's amazing. So if copper is depressed, there's less new copper projects, and then that actually hurts the supply of silver. That's very interesting. All right, we're going to end it there. Thank you. Appreciate it. Randy.
You, Joe.
Andrew. Okay.
Okay. Hey, thank you. Coming up when we return, an exclusive interview with Dallas Fed President Robert Kaplan is going to join us. Don't go anywhere. Squawk returns right after this.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Sullivan. Good morning. Worldwide Exchange on CNBC.
Squawk Box right here on CNBC. Want to get right over to another big interview this morning. Steve Leisman joins us with a very special guest. Steve.
Good morning, Andrew. Yes, we're joined by Dallas Fed President Robert Kaplan. President Kaplan, thank you for joining us this morning. I want to get right to, there's just a ton of news out there, but the first thing I want to ask you about is the issue of the vaccine. How critical is the vaccine to the outlook? How closely do you follow it? And I think the most important part of this question is, how does it look like the U.S. is doing relative to your expectations?
The vaccine is critical, and getting the population vaccinated and making sure we can do that rapidly is critical. And when you think that there are various variants of the virus around the world, some of them may be here, may grow here, I think it makes the urgency of getting people vaccinated that much greater. And that process is critical to seeing the economy recover, better mobility engagement, getting schools reopened in person. It's central to everything we're seeing in the economy.
So what's your assessment then of how it's going? I'm assuming that a lot of your outlook, you said yesterday that you thought we were headed towards 5% GDP. I'm assuming a lot of that outlook is relative to the vaccine getting out there and distributed. Is it going according to your forecast?
It's, I think with the plans that have been announced, with the administration's plan of at least 100 million vaccines in the first 100 days, if that were to occur, which we're hopeful it will, and we maybe can do better, mobility engagement will still be sluggish, we think, up until June. And the next few months, certainly in the economy, are going to be sluggish. But I think you're going to start to see then, once we get to June and beyond, better mobility, better engagement by consumers, a lot of small businesses doing better, and everything will flow from that. But it's critical. So how are we doing? I know there have been some fits and starts, but I'm very hopeful that we'll make more progress. And cities and states do need money to execute this program, and it's money for logistics, but they need money for staff to administer the vaccines, and we're hearing that throughout our district.
You talk about increasing mobility in June, the economy perhaps returning to normal. How does Federal Reserve policy react to that? You're buying an awful lot of securities, $120 billion a month of treasuries and mortgage-backed securities. You're at zero interest rates. As the economy returns to normal, does Fed policy need to return to normal?
I would say there'll be time to have that discussion down the road, and you've heard me say before that once we've weathered the pandemic and we've moved beyond it, which we're not out of the woods by a long shot yet, and we're making substantial progress on our goals, I think there'll be time to have that discussion. I think we'll be healthier to wean off these extraordinary measures. But right now, we're in the teeth of this pandemic, and so I think we should be aggressive. And I'll probably avoid talking about timing, and I want to avoid being rigid or predetermined about when we're going to move beyond this pandemic. Right now, we're in the middle of it.
You've long talked, President Kaplan, about your concerns about the effect of monetary policy on financial markets. It's hard not to look at some of the things that are going on right now, from GameStops to Reddit-fueled short squeezes, and think that maybe there aren't some excesses going on. To what extent do you see that linked to monetary policy?
So I don't see anything right now systemic. I'm watching this very, very carefully. I'm looking at financial stability questions in the non-bank financial markets, funding risk. I think part of what you're seeing, I think there's a lot of factors in the current situation, but one of them, yes, is there's a substantial amount of liquidity, and we're seeing that at play. I still think we need to be doing what we're doing right now in the teeth of the pandemic. But again, I think as we move beyond it, it'll be healthier to start limiting this liquidity and normalizing monetary policy down the road. The issue is, I'm going to avoid talking about when that might be. But yes, some of the current situation, you're seeing one of the factors is there's a lot of liquidity, and some of that relates to Fed purchases of $80 billion of treasuries and $40 billion of mortgage-backed securities every month. I think it's wise for us to acknowledge that.
The other side of the liquidity from the Federal Reserve is concerns about inflation. I want to ask you broadly about whether or not that's something you see coming down the road, but more specifically, being the work that I know the Dallas Fed does about oil prices, I've been surprised that given the lack of demand right now for oil, the price has held up quite so well. Is that something you expect to perhaps go up a lot more when the economy returns to normal?
Yeah, we do. We expect the global oil and gas markets will get into rough balance probably sometime in early 2022. You'll see production this year we're in probably flattish, but as the year goes on, there's no doubt that driving will increase. As long as all goes well with the vaccine and with the virus, mobility will increase, driving will increase, consumption will increase. In terms of inflation, it wouldn't surprise me to see during this year some inflation spikes in certain items. We see shortages of things like semiconductors, metals, wood products, packaging products. I think a lot of that will be transitory. I think the longer term issue is going to be, as the cyclical forces of inflation build, how much are they offset by technology-enabled disruption, globalization? I think the jury's out on how those forces will play out.
President Kaplan, I've got two more questions for you, if you don't mind. First, you have a choice. You got a $600 billion package from the Republicans. You got a $1.9 trillion package from President Biden. Pick one.
Yeah, I'm gonna defer, but thank you for offering. I'll stay away from that debate completely, but I would comment. Here's what I'm hearing in my district, which I'll give insight from that point of view. It's critical that we have money to do vaccinations and testing. It's critical that people are out of work, have continued relief beyond March, It's critical we have enough money to reopen schools. And one of the big issues in this pandemic is women with children have disproportionately left the workforce. So getting schools reopened in person and having money for that and money for childcare is going to be critical to getting that group back into the workforce. We need it if we're going to grow faster.
Thank you for that, President Kaplan. One more question. The 10-year yield now at 111, which is one of the highest levels we've seen on the one hand. On the other hand, be still my beating heart that it's only still 111. Jeff Gundlach on our air a few weeks ago talked about the idea that perhaps the Fed is gearing its concern about the 10-year towards when it becomes positive in a real basis, that the 10-year yield remains on an inflation-adjusted basis negative. Is that a point at which you might become concerned and think that there's it's the time to come in and perhaps cap that growth, or is it not a concern of yours at all?
I think if we go through the year and we're successful in combating the virus and we get higher growth, you're going to see the 10-year and the curve back up. In other words, rates will be higher. I would expect that. And you've heard me say before, I'd be reticent at this point, based on what I'm seeing, for us to take action and do things that might distort those market signals. I think it should be expected and maybe healthy to see that curve back up as we recover. Back in January of 2020, the 10-year was 1.75 to 2%. I don't know where we'll head here, but I would expect it'll be a healthy sign for yields to back up as we recover, and I'm probably expecting that.
President Kaplan, thank you so much for joining us this morning.
Good to talk to you, Steve.
Okay, Andrew, back to you.
Steve, great conversation. Thank you for bringing that to us right here on Squawk. Meantime, I want to get over to Jim Cramer this morning. He joins us live as well. Jim, there's so much to talk about, but I got to talk GameStop and some of these other stocks that you're just seeing literally collapsing in front of our eyes this morning. Any way this turns around the opposite direction?
Well, I think that you have to have something coming from the company. The company's been mum. We called them again yesterday. We like to call them. Why? They seem like very nice people. But they have not been responsive, and because of that, are they losing the opportunity? Contrast that with Adam Aron from AMC. He didn't lose the opportunity. He was selling stock constantly for the company, of course. So when you see this, you say to yourself, opportunity squandered. Could they have bought a gaming company? Could they have opened gaming palaces? Of course. But I think they were caught as unaware as the short sellers were. And unfortunately, for the short sellers, they lost a fortune. Unfortunately, for the people who were on the other side, it's what we call at law school sui generis. There aren't a lot of GameStops out there that are heavily shorted. People will say there are, but that's hyperbole.
Okay, so here's the question. Do you think that GameStop could still issue shares and raise money?
Oh, yeah, absolutely. Now, of course, there are a lot of people who say they can't, but those people are ill-advised. What I think is interesting here is that, you would have to sell stock and to get raised cash. They have a not great balance sheet. Really a victim of the fact that they did a hideous buyback at a time when their model was changing and the direct-to-consumer model came in. But you know what? There's always time, provided that that this fellow, Ryan, who's joined the board, comes up with a game plan. But he's got like a 15-bagger? I mean, what's his point? It was a great story. It was, as we would call, if you're a Hitchcock fan, a MacGuffin. But the real issue here is that the model is very hard to fix. I offered a couple of solutions that might be able to get it back to the glory days of 50 to 60. I did that in part because that's where it did trade before the direct-to-consumer model took over. You have to go back to a January 18 release where they admitted that admitted that they were going to make about half the money, because they were quite blindsided by the fact that the Take-Twos, the fantastic Strauss-Zelnick, that the Activision Blizzards, and that the EAs were going to disintermediate them. Not unlike what Nike's trying to do with Foot Locker. Is Chewy a good model? Geez. Andrew, if you and I were working on something really special and then we went on something else, people would say, you know what, those guys are smart to figure it out. But Chewy is that's trying to upend brick and mortar. Is it hard to upend yourself? Oh God, it's hard. You have to take all the people on the board and say, listen, we've done things wrong. But money is the succor, and I think that the clock is ticking. They may have reasons again to say that they can't do it, but that's because they're not as again, I choose the word ill-advised because I used to say raise eyebrows. I've got a lot of terms that I used to use, but I've become much more of a diplomat in the line of Gandhi or even Jefferson.
Jim, we got to run. We're going to see you in just a couple minutes. By the way, if they do raise money, does the stock go up or down from here at $128? Real quick.
People like it. Some of these younger people like it when they raise money, but AMC didn't. Darius Adamczyk, is he a hero? How about that? He takes a walk. We sell 20,000 people. Hey, I'll take a walk.
Jim, we'll see you in just a couple minutes. Squawk returns right after this. Thank you.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think
Sim Wong Hoo on the next Managing Asia.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Welcome back. New this morning, Impossible Foods is slashing its suggested price at U.S. grocery stores by 20%. It's the first time the privately held company is lowering retail prices. And based on figures from the Agriculture Department, customers will still pay more than double for an Impossible Burger versus a traditional hamburger, but prices are narrowing a bit. In an interview with CNBC.com, Impossible Foods president Dennis Woodside said the coronavirus pandemic led the company to speed up its retail strategy. I got to get with the program, Becky. I think I might pay twice as much for the regular burger. So I've got, my whole, you know what, I might drive my internal combustion 7-speed. Right. I might drive my internal combustion engine to In-N-Out and get, but then again, we'd still have hurricanes if I don't get on board. And I definitely want to get rid of those once and for all.
Or blizzards.
Once we do all this. And everything else.
You are the anti-trendsetter,
cold weather, warm weather. Yeah, everything. Just got to fix all that stuff once and for all.
That's right.
We're gonna,
Let's take a very quick
Andrew,
check. A final look at the markets.
I miss him already. Yeah.
Well, good news for you. He'll be back here tomorrow morning with us. All three of us are going to be here tomorrow morning once again. We'll see you then. Right now, it's time for Squawk on the Street.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber. Coming off the S&P's best gain since late November, futures point to some further gains today as the Reddit rally fades. Attention turns to earnings, stimulus, and more reassuring COVID trends. VIX below 28. Our roadmap begins with the retail mania reversal. Shares of GameStop, AMC, and Silver falling sharply ahead of the open.
Plus, as the speculative trading frenzy eases, U.S. stocks, well, they're set to rally at the open, extending gains for what would be a second straight day. And so-called productive talks at the White House. But can Senate Republicans and President Biden close what is still a $1 trillion gap in what they want for stimulus? Carl.
All right, guys, let's get to it, Jim. We mentioned some of the Reddit trades down in the pre-market, taking out some lows from the middle of last week. But we're also VIX below 28 and oil above 55 for the first time in a year.
Yeah, this is great news for the VIX. We needed that to start going down while the market went up. That's more normal. It's interesting that oil going up, even though first world demand is going down. I'm sure we'll talk about Exxon. The GameStop issue, my nephew and head writer and only writer, Cliff Mason, came up with what I thought was by far the best analysis, was a series of things they could have done when they had a higher stock price. They could still do it, but including reinventing the company, perhaps becoming more of an exchange place like StockX for sneakers, maybe even being a gaming palace, buying David and my old friend Zynga. They haven't done that. They've been mum. But, David, I will tell you one thing about GameStop. It's been missing the whole time. They are incredibly nice.
Okay, well, anybody who's watched for any length of time understands what is really meant by that statement, Jim. But you've been talking about this possibility of them having sold stock to raise a good amount of money to perhaps, as you say, redirect the strategy of the company. They haven't done it yet. We'll see. But, Jim, we've been talking about this now for more than a week. Let's call it roughly a week. There has been little doubt as to where this stock, I think, would eventually end up. The only question was how long it would take to get there.
Right. And I think, David, one of the critical aspects that you talk about better than anyone on air was that there was actually a cost to be able to stay short that had a lot more to do with the ability of the hedge funds to have staying power versus a company that may be in more trouble. And, David, you know the actual toll on borrowing shares was very high here.
Well, not to mention, of course, the unlimited downside you have from shorting a stock, which is something we can come back to and probably should occasionally to remind people. It's one thing when you buy, 10 shares of a $100 stock, you could lose $1,000. But if you short 10 shares of a $100 stock, well, it's still unlimited, isn't it? When it goes to 200, yeah, you're down 1,000. When it goes to 300, 400, 500, that, of course, was the case with Melvin Capital, which we pointed out many times. A very rigorous hedge fund when it came to analysis, but perhaps not so much in terms of at least understanding the risk they were taking on by having so much of the float short and the other copycat trades that had taken place in the market, Jim, as well, with shorting GameStop. They're not here potentially to benefit from this fall. A number of other hedge funds may be, Jim, in terms of the short side, but we also pointed out that when the shorts sort of dried up is when this perhaps would become more of a concern for those who had decided to buy it with such fervor.
Right. And, Carl, one of the things that I think people have to get away from is the idea, okay, which GameStop, what's the next one? Well, is it, say, AMC? No, because Adam Aron, the CEO, he's announced that he has an at-the-money offering. Is it American Airlines? No, they took advantage of this and they issued stock. Is it Bed Bath & Beyond? No, Marc Tritton's got a turnaround, and so his is not likely. Is it some of these stocks like a Virgin, a SPAC? Well, Churchill 4, these things, they're not short squeezes. That's just excitement. But the idea that you could find a GameStop, I've been looking and looking for the next GameStop, something that people could run with. It's hard, Carl. I can't find one.
Yeah. It's fascinating. Goldman's got a great note out this morning from Jeff Curry talking about why it's basically near impossible for Reddit traders to corner, say, the silver market the way they did back on Silver Thursday. We'll get to that a little bit later. I do want to get you, Jim, because we do have some M&A today. Uber is buying Drizly for $1.1 billion in stock and cash. The leading on-demand alcohol marketplace in the U.S. will eventually be integrated with Uber Eats, and we hope to talk to Dara Khosrowshahi in the next few minutes. Jim, we know what's happened to at-home spirits consumption in the past year, and I guess this is a comment that that's not going to change anytime soon.
This is so needed. Obviously, I own 2 restaurants. One's a bar, Bar San Miguel. We are, the word is mothballed, and hopefully it'll Cinco de Mayo. Why is this so important? Our money's made on alcohol. It's not made on food. And the way you'll be able to make money at a store or a restaurant in New York City or many other places is that you got to get people in to buy the taco and then have them drink. Well, obviously, we're restricted to having only 25% capacity. So if you have Drizly, you'll be able to have a much better way to send liquor with the package. Now, will there be state and local rules? We'll be talking to Dara. There are absolutely issues. But I will point this out. There was such a thing called Cuomo fries. That's what you were supposed to do in New York. Order fries and you can get the liquor. And did we do that? We did what was ever legal. But without liquor, Carl, frankly, we lose money on every delivery because the delivery charge itself wipes out most of our profit.
We'll talk to Dara and Corey about that. Yeah, that's coming up, I think, in a few minutes, guys. You know, more broadly, Jim, we do have J.P. Morgan had a chart out yesterday looking at decent uptick in open table seated diners in states like California and Texas. And certainly the governor hopes to have indoor dining in New York City come back around Valentine's Day.
Well, you know, you have to use the Japanese model. It's not talked about enough. We're very provincial about this. The way you measure whether your restaurant has too much COVID is you measure the carbon dioxide level. They're very similar. So we need carbon dioxide monitors. They're not that expensive. We've been trying to get a bunch of them for our places to be able to measure the aerosol load. I want you to consider COVID to be very similar to secondhand smoke. If there's a table in the back and people are smoking, you're going to get it forward. If that's the case, then you will be exposed to COVID. Unless we figure out airflow, which is chiefly ventilation, then we're not really doing anyone a favor here. Now, it is scientific. The science had become kind of a rudiment. It's time to put it back in force because I know I would not go to a restaurant if there were not proper airflow, even if there were 25%. And I own restaurants, so I may be my own worst enemy, but I like to be prudent. The goal is to not put people to work. The goal is to make people safe. It is not safe if there's improper ventilation. And people who don't believe that do not believe in science.
That said, Jim, we are at a point here, at least, where I think I'm starting to sense from market participants the hope that we really have turned the corner when it comes to the virus. Now, we all know about the variants that are out there that are scary, to say the least. But we also know that hospitalizations and new case counts continue their decline, and we hope that deaths will soon follow. You know, you do wonder about that reopening trade coming back and being sort of more to the fore yet again in terms of the minds of investors.
Well, look, I have Chipotle on tonight. Maybe they can tell us they've got both indoors and outdoors, and they've been quite an extraordinary performer during this period, David. Yes, I mean, yesterday I had Marc Casper on. I mean, he's really the king of the PCR, thermoscientific, and we're making unbelievable strides. Dr. Gottlieb on this morning talking about antigen tests. We'll be doing at-home antigen. All of these things show that there is more of an effort by public and private. What David Tepper is doing with Darius Adamczyk in North Carolina from Darius earlier on for Honeywell. So I think it is coalescing. We want to be careful, and we want to be able to make it so that we rely, something we haven't done in this country, David, rely on the success of other models around the world, of which Japan has been at the forerunner of this, Taiwan second. It's time to become less xenophobic, less jingoistic, and more scientific, David. And that will determine whether we open the restaurants effectively.
Yeah. Well, as David implies, we've got U.S. cases down week on week for 21 consecutive days. And at this point, we have more Americans who've been vaccinated than have actually had COVID, a milestone that we hit yesterday. We'll take a break here. Plenty to get to. A lot of earnings, UPS, Pfizer, and some others. And, of course, we'll talk to Darius Adamczyk and Corey Rellis of Uber and Drizly on that billion-dollar deal when Squawk on the Street comes back.
Chartered, we believe money can be a force for good, which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Moments ago, Uber announcing an agreement to buy Drizly, a Boston-based alcohol delivery startup, for $1.1 billion in cash and stock. Joining us exclusively this morning, Uber's Darius Adamczyk and the co-founder and CEO of Drizly, Corey Rellis. Gentlemen, congratulations. Good to have you with us.
Thank you. Good to be here.
Thank you.
Dara, you point out in the release, you've added groceries, you've added prescriptions, and now alcohol. Talk to us about the deal and why now?
Well, for us, as you know, Uber Eats has been an incredibly successful part of our platform before the COVID hit us, the virus hit us. But during this time, our delivery business has been growing at extraordinary rates. And we essentially want to double down. We doubled down initially on grocery. And now we're doubling down on the delivery of alcohol. Drizly is by far the leader in the space. They have grown very quickly, but they've grown the right way. And we think bringing Drizly together with Uber allows Drizly to essentially continue to extend its lead as we put Drizly in front of the incredible Uber audience. So we think it's a win-win. It's a win for Uber because the Uber audience gets access to delivery of even more things to their doorstep instantly. And it's a win for Drizly as well because their audience expands immediately overnight in a very, very big way.
Yeah. Corey, we were talking about what's happened to in-home spirit consumption over the past year as we've seen this enormous wallet shift away from eating out, drinking out. Can you just give us a sense of what gross bookings have been like for the last year?
Well, it's been an extraordinary year. I mean, COVID obviously fueled a level of awareness for the consumer side that didn't exist, and the industry followed suit as well. So between that, we had over 330% growth last year, and we did it profitably, as Dara said. And that was fueled by building the infrastructure over the last 8 years, waiting for this industry, trying to build this industry to catch up to many other categories that are coming online at a much faster rate. So we actually think it's still a very nascent in what it can become. But between the combination of Uber and Drizly's category expertise, we actually are incredibly excited about the acceleration of the coming years.
Darius, Jim Cramer, I got to thank you. As a restaurant and bar owner, you know we can't make it without alcohol, and you know that there are different restrictions in different cities. We were selling alcohol. If you order a margarita, we'll deliver it to you. We kind of, or obviously our restaurant was shut down like everybody else. But what I want to know is, can you ferret through this incredible nest of local regulations? Because we've been afraid historically to sell liquor to people who are underage, to people who are overserved. We don't want that liability. At the same time, we want to do priority delivery that you introduced that could give us a little bit extra vig, so to speak, because we need the alcohol to stay alive. Can you help me on some of these questions?
Yeah, absolutely, Jim. So I think one of the unique histories of Uber is that we have been locally regulated since we were born, essentially, as a company. So we're very familiar with and comfortable with the myriad of local regulations all over the world, not just in the U.S., but outside the U.S. as well. So we've been comfortable within a regulatory environment and building systems that can operate at scale, but also can be customized so that we are following local regulations to the letter, to the T. And what impressed us with Drizly as well is that the Drizly founders, the team, from the very beginning wanted to innovate, but wanted to innovate in the right way. And they have worked with local regulators, and they've really built Drizly the right way so that we can now be confident going to merchants, whether they're alcohol merchants or restaurant merchants, and letting them know that we have a safe and effective way for you to sell alcohol, which is incredibly high margin, to an expanded audience. We check ID. We're using the same technology, for example, that checks to see if drivers have their masks on, to essentially go out and identify the buyer of alcohol and make sure that that buyer is of age. So I think we built an ecosystem that can scale, and we built an ecosystem that can scale the right way safely.
Oh, well, that's terrific there. That's what we need to hear. Corey, congratulations on the deal. One of the things that I'm concerned about is what can be in the package. We currently use a competitor of yours. Why? Because we were a carry-our shop, and then they got bought by DoorDash. What is the mode here? Can you give me more assurance if I use the Drizly Uber combination than if I use the other guy? Because you know what we care about? We care about being put out of business. We're not going to be put out of business by customers. We're going to be put out of business by regulators. Can you give us some assurance that if we use Uber, it may be better than using the other guy?
Well, I hear you, Jim, and it's something we'll definitely consider on the on-premise side. To go back to Drizly's founding, we've largely focused on the off-premise side. So we're talking about liquor stores and grocery stores and chains, and that's really where we focus on the consumer experience to date. The on-premise side is pretty recent, and I think COVID actually opened up regulation in a way where this becomes more of an ingrained consumer behavior. I think there's a lot of validity to it, and that's absolutely something between our technology and category expertise and Uber's brand awareness and the food scale that they have. Putting those two together is absolutely something we should think about in the future. And to your point on competition, I think it all rely on the consumer experience and what we need to build going forward.
Mr. Ellis, it's David Faber. I would assume getting liquor licenses is one gating issue here. How many do you have in how many states, and how many are you seeking right now?
Well, it's an easy answer for us. We have 0 liquor licenses, and that's because we were founded on the idea that we're a technology provider to the 3 tiers of alcohol and respecting the intent and the regulation that has been in place for many, many years. That allows us to work across the 3 tiers and specifically build technology for retailers to bring their shelves online, allow consumers to shop across them, and receive the benefits of having a larger selection and price transparency that you could get relative to shopping at one store. It also allows us to think a little bit bigger about how we bring brands closer to consumers, their incredible storytelling, and really leveraging that to grow the consumer awareness of the space. And also, it's a very social category. It's a lot of fun. So the more we can bring consumers and brands closer together in a regulatory compliant way, which is how we're built, I think that's going to be the key to unlocking the next level of growth.
Okay, understand it a bit better now. You're going to be taking over 90% of the consideration in Uber stock. Why did you choose to sell the company at this point in your growth cycle, and why are you confident taking Uber stock as largely most of the consideration?
Well, it was an interesting time for us. I mean, we're obviously doing very well right now, both in growth rate and profitability and balance sheet. When we thought about the Drizly vision, we thought a lot about how we accelerate it past where we are today. It's a nascent category, less than 2% online for e-commerce sales for this particular category prior to COVID, maybe 4% today. There's nothing structurally holding us back from being 15 or 20%. We brought technology to meet the regulation. Now with Uber's scale and their technology prowess and their logistics, you put those two together, I think it becomes very powerful. We need to execute. But given that proposition and given what we know we can build going forward with a combination of the two, we absolutely wanted stock because we're believers in the story and we're believers in the value we're going to create towards that shared vision of receiving everything within a couple of hours under the Uber platform.
Hey, Dara, finally, I got a twofer for you to close us out. The one is we've been talking about vaccination trends and the economy potentially loosening up. Are you seeing that on the ride side? And then lastly, people wonder with Drizly, can pot delivery be that far behind theoretically?
So I think as far as the opening up of the markets, we're not seeing material signs of opening up. As you know, this crisis has continued much longer than most thought. The great thing about our position as Uber is that we're essentially hedged. As cities stay closed, and believe me, we don't want cities to stay closed. Our delivery business gets bigger and bigger. We continue to acquire customers and kind of take advantage of the acceleration of delivery of all things to your home. And when markets open up, and they will open up, our mobility business is going to take off like a rocket ship, and our mobility business is the real profit generator of the business. So we're in a unique circumstance. While I am hugely rooting kind of societally for things to open up, we can actually thrive either way. And I think when you step back and think about the vision of Uber, you know, if Amazon owns the next day, Uber can own the next hour. Any place you want to go, anything you want to get within the next hour, if you want it, that instant gratification, Uber can be there for you. And that's a unique position in the marketplace.
And finally, on cannabis, could that be next?
I think it certainly could. I think that we're waiting for federal legislation to fall into a place where we would feel comfortable engaging in cannabis. So for now, we've got alcohol. It's been a business that's been around a long time. We're very comfortable with the regulatory field, and we're going to focus there. Never say never with cannabis, but it's certainly not tomorrow for Uber.
Guys, I really appreciate the time. Fascinating deal. It's good to see you both. We'll hope to see you soon.
Thanks for having us.
Thank you for having me.
On Uber and Drizly today. We'll get to some earnings, Pfizer and UPS, Hog, and some others ahead of Amazon and Alphabet tonight. Futures are green. We're back in a moment.
And these are the stories you should be checking out on CNBC.com. As BP posts its first annual loss in a decade, the CEO Bernard Looney tells CNBC there is light at the end of the tunnel after what was a brutal year for the sector. That story's on the website now. U.S. President Joe Biden will push ahead with his $1.9 trillion COVID-19 relief package, rejecting calls for a scaled-down bill after meeting with Republicans. But the GOP remains optimistic that there's still a way to meet in the middle. Head online for the full story. And China's economic growth is likely to moderate in the next few months, according to Goldman Sachs. It says Chinese policymakers may begin pulling back on stimulus as the country's recovery takes root. Head to CNBC.com for more. And remember, you can follow us on Twitter at CNBCI.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Be ready before the opening bell. Squawk on the Street on CNBC.
Keep your eye on the Reddit trade today. GameStop now down 39% pre-market. AMC down 28. GameStop not quite to Thursday's low, intraday low of 112, but we're going to watch that, obviously, when we get the opening bell in 5 minutes. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages, 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market. As you say, the increased retail activity in the market and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
The news cycle is racing along. We have to be checking every bit of it along the way, because one false narrative can change the course of how we respond to this pandemic. And we can't let that happen. We're going to do our dead level best to get it exactly right and never tell people how to think about it.
Let's get to a mad dash as we count you down to an opening bell. Jim, a lot of earnings this morning. I want to talk a bit about ExxonMobil when we get to the opening bell. They are a very important conference call for that company. But UPS, another that reported earnings, and I know a focus for you on your mad dash.
Yes, I have Carol Tomei on tonight. She's the terrific CEO of UPS. She used to be the incredibly formidable CFO of Home Depot. People doubted her, David. They even talked about the idea that there were some issues with online delivery and with customers. They were completely proven to be untrue. As a matter of fact, the numbers here are extraordinary. International segment package up 29%, revenue up 26%, domestic average daily volume up 8.9%. The numbers were well ahead of expectations. Extraordinary. They're very much in control of their own destiny. The fact that it's only up 7% represents the idea that how much can it really go up on one day. But I would tell you, David, that domestic yields were up more than costs. The company is a new company, and there were so many people who were betting against Carol Tomei. Sometimes you have to say to yourself, you know what? There are people who are such good operators, David, that they can execute. Carol Tomei is an excellent operator, and that shows why this company had such great numbers. And a fantastic team, of course. We all know UPS operates as a team, and boy, did they ever come through for the holiday season.
Yeah, well, the stock has certainly shown that, of course. 12 months, 51%, going to be adding to that this morning. And Carl, of course, as we get ready for that opening bell, we are keeping an eye on a number of earnings. Alibaba, as I mentioned, ExxonMobil. We'll get to those in just a moment.
Yeah, as we get the opening bell here and look at how Brett fills in on the S&P. We're going to start at 37.73. Jim, Pfizer did raise their guide, sees 310 to 320, prior 3 to 310, and estimates $15 billion in 2021 COVID vaccine sales.
Yeah, so then people would say, well, why isn't Pfizer up more? Well, this is the problem we had last night when I was speaking to Thermo Fisher, Marc Casper. He was unwilling to be able to say, look, the incredible numbers we've had, they're the gold standard PCR maker and vaccine maker, including mRNA, the technology. He was reluctant to put up a big number, say, listen, we're going to be able to duplicate that. The reason why Pfizer can have such a big number and people aren't buying it, aside from the fact that they did have a miss in some lines, is that you really can't decide, what David Faber was saying earlier, how long is this going to last? David, when J&J comes up with something that could be $100 million, I don't know, $500 million, we don't know how much they have, and it's one shot, then what it does is make it so that, David, it's very hard to predict how much Pfizer can make going forward. And I think that's why people are looking at the stock and saying, they're scratching their heads, but they shouldn't. That stock represents the actual issue of a company that is really hostage to the pandemic growing.
Yeah, I guess so. But let's not forget they have a very broad product portfolio, don't they, Jim? That is not dependent at all on the progress.
They do.
Yeah.
But David, they're not J&J, and they're not Eli Lilly, and look, I like them, and I think they do a terrific job. But again, David, we're really stuck with a company that's been doing a lot of financial engineering, and who knows better than you about what Pfizer was trying to do at one growth point when they really were stymied about what to do next.
You are correct. Well, they certainly looked at doing an inversion, of course, remember, for quite some time, any number of different deals. Then they did the Mylan transaction. And you're right, until running into sort of the positive, it's one positive, I guess, from the virus as a result of their work on the vaccine. They've sort of suffered through a number of different things. Speaking of suffering, guys, I did want to, as we watch AMC shares and GameStop shares declining sharply in these first moments of trading, I did want to get to ExxonMobil, because while we certainly will not forget the last week in terms of what it's meant for the market and these names, I do think when we look back, we'll probably look back at the announcements from the likes of GM and what we expect this morning, at least in this conference call that's just beginning from ExxonMobil, as perhaps more momentous and more important. And here I'm talking, of course, about really what are the development of a new industry, or one that's just in its early stages, namely EV, the changes that are being wrought in auto manufacturing, and in those who supply the fuel for those automobiles. And there you get to ExxonMobil, which did report earnings this morning. It was a large loss. A lot of that is write-downs that we've talked about in the past. But I want to focus people on Darren Woods, the company's CEO, this morning, because it's an important conference call that he will be leading. And it's sort of a different ExxonMobil in some ways. There's going to be, as you take a look at the loss and the CapEx spending that they did, where they are, of course, CapEx continues to be a focus for the large investors who are in there. D.E. Shaw didn't nominate directors, but we do have a new director today. His name, as you see at the end there, is Juan Arifin. He was formerly led Petronas. So you've got somebody with energy experience coming on there. You've got the creation of these low carbon solutions businesses and the $3 billion they'll be investing. But even more importantly on this call, it's my understanding that Mr. Woods is sort of going to try to send out a message of a level of accountability and being more shareholder friendly to a certain extent, more transparency in a way. Obviously, they will talk about the dividend, which remains sacrosanct, at least at this point. Debt payments, investments, operating expenses, CapEx, things of that nature as well. But Jim, you know this company. I mean, Rex Tillerson, yes. Lee Raymond, these guys were like emperors, and it was like the Kremlin over there. You didn't really know what was going on. It's a different ExxonMobil. We'll see if this new board member makes a difference, but there will be likely another significant board member coming, and they did give note to this in their press release as well, saying that in the near term, they continue to look at potential directors, and in the near term, they expect to have more news on that front. Fascinating to watch the transition here. Take a look. That's actually what they said. Discussions with other director candidates, a range of skill sets for a potential addition to its board. And they went on to say that that's something that they expect to take in the near term, Jim. So I did want to focus people on ExxonMobil. Yes, GameStop, incredible. But that announcement from GM last week, the moves ExxonMobil's making, these are things we may remember for many years to come.
Yes, David, look, first time, we're talking about Exxon first loss in 40 years. The old days, what I would do is I would turn to the sheet that they put out and talk about production growth. And production growth was okay. Oil liquids up 2.3 million versus 2.4. That's not bad last year. Natural gas a little disappointing. But what's amazing, David, is what else do they put out in the release? That they're meeting generous methane reductions. They're talking about flaring and cutting flaring down. David, those are not the things you put in a release during a Trump administration. But when you're trying to be able to get people to say, you know what, is Exxon an ESG company? Are they working on carbon capture? What it says is, hey, maybe this is a new Exxon. Is it a new Exxon? It's got... Look, any stripes can change, but boy, were you ever right? Exxon was always the company, David, that had the 50-year plan. It's Mike Wirth at Chevron that has the plan to be able to get it so that really that oil is a bridge fuel. But you mentioned Mary Barra today, David. I spent some time talking with Mary. You know, David, GM is not waiting. They're not going for the 2035 bridge fuel. Obviously, Tesla isn't. So there's a race against time and a race against ESG. They might be able to win some ESG by talking about methane flare, but they're still flaring a lot. Can they race against time? David, the love and the amount of money that this market is willing to give to EV, David, tells me the clock is ticking even for Exxon.
Yeah. And we know, of course, when it comes to EV, that has, Carl, been another area of great fervor for many investors, including the people that that Jim refers to as the merry men, or the I don't call them retail as much, the active traders that are out there these days, who are taken with the prospects of so many of these companies that are going to potentially participate in this new and very much growing part of our economy. Whether it's the battery makers or the car makers themselves or so many of the different components that go into it. And man, the SPAC thing, Carl, just continues apace. I'm sure you've seen some of the announcements this morning.
Yeah, there's some familiar names on the SPAC front today, which I think we'll get to in a minute. Really quick, guys, we got a halt on GME, so we're back to volatility, pauses in trading there. On the EV front, Jim, you know, David mentions Exxon, certainly huge news. I saw yesterday Adam Jonas at Morgan Stanley took Tesla to 880. You got the Ford-Google partnership. Maybe we'll hear more about that when Alphabet reports tonight. And then NXPI, I know you would have mentioned it otherwise, but huge tailwinds in both mobile and auto.
It was going to be my stock trading. You front me, Carl. NXPI is one of the stocks I've been recommending as to be able to play the incredible vast chip shortage. NXPI, very linked because of the acquisition of Freescale, very linked to auto. Auto's coming back. I have Norfolk Southern on tonight. Auto's coming back there again, too. NXPI had been an also-ran, but David, one of the reasons why it was, as you know, was it got caught up in some incredible takeover chatter that made people feel like it was done. Obviously, David, NXPI was never done. They just kept engineering and engineering. They're looking like the #2 player now when it comes to Internet of Things, to Skyworks Solutions. Congratulations to that management team. Look at that stock. Isn't that even better than owning some, I don't know, let's say a company that sells hard Xboxes?
Or the games that go in them. You know, it is funny, of course, you say caught up in takeover chatter. Of course, they actually were supposed to be acquired by Qualcomm. Qualcomm probably regrets the fact that Chinese regulators would not give them the go-ahead, and they waited and waited, and they finally pulled the plug after quite some time. And you may recall, of course, in the long run-up to that, my following it closely, I think it was $127.50 was the final price that they'd agreed to. So it does give you some sense, Jim, that it is not in the best interest of shareholders for the boards to sometimes decide to sell the company. Yes, it did trade well below $127.50 NXPI for quite some time. But as you point out, it's a $180 stock roughly right now, and its fortunes seem to be quite strong. Guys, I did, as we take a look at AMC shares, which were also in significant decline. Yeah, go ahead, Jim, sorry.
Well, there was a fellow by the name of Rick Clemmer that ran NXPI, and I became close to him, big position for my charitable trust. And what he was saying is, listen, we're thinking that autos are going to boom. And David, one of the things that he did was he didn't say cell phone. They do have cell phone. They do near-field communication that allows you to be able to use touchless when you be able to buy something on your cell phone. But he just said, you know what, autos are going to come back and we're going to own autos. You know what, David? No one believed him. But you're looking at a chart of a man who said, you know what, industrial semis, like Texas Instruments, like analog devices, are the future. Well, you know what? You've got a Skyworks saying that it's going to be 5G in other parts, but IoT is good. It all worked, David, and I salute these semiconductor companies who did not take their cue from Intel. They took their cue from worldwide business trends. So smart. It's not like the old days. These are not just a bunch of commodities in the SMH. They're very good companies.
Right. Yep. And again, Carl, we're keeping a close eye on shares of GameStop and AMC, two of which went up to extraordinary levels, almost wiped out a major hedge fund, certainly took significant losses from a number of funds, although the month perhaps was not quite as bad as many had feared it would be, broadly speaking, for the hedge fund community. But it forced Melvin to raise, what, almost $3 billion in capital. It's forced Robinhood to raise over $3 billion in capital, all kind of from the same trades. And that was focused on GameStop, and we see it there now, approaching new recent lows. But Carl, another area that we've been talking about on our show, in terms of at least a focus that Jim had focused us on in both the Reddit Wall Street Bets area, Robinhood trading platform, has been SPACs, particularly those that do choose to acquire or merge with an EV company. But I did want to mention today, did you guys see we got a new SPAC from Wilbur Ross? As we take a look at Robinhood restrictions as of Tuesday on some of those stocks and what happened there. Jim, did you see Wilbur Ross, 83 years old? He's launching a new SPAC. Larry Kudlow's on the board, by the way. So, you know, they got that. They got, then you got Muhlenberg, the Boeing CEO. Yeah, launching a SPAC.
Yeah.
Obviously, Omar Ishrak, chairman of Intel. He's got his going. Sternlicht prices his latest JAWS offering as you take a look at the CNBC SPAC 50. Ares does a very large offering, almost $800 million. That's a big one. And I could go on and on. I mean, they just hit my inbox literally every 5 minutes. There's another announcement, either a new deal, a planned deal, or they announce their transaction. But Jim, it just continues. We have two indexes now. We have one that tracks the SPACs after they price their own deal, but before they announce their merger candidate. And then we have an index that actually tracks them after they announce their merger candidate. But Jim, they won't let me do anything but take a look at GameStop back in the control room, I guess.
Well, look, I think the SPAC issue is going to become an issue. Right now, everyone's been making money off them. I tend to look at them as fantasy football, David. These are all fantasy players. Well, we know that Wilbur Ross, I mean, can he really deliver? Or is he Goff? When we have Dennis Muhlenberg, is he going to turn out to be Tyreek Hill? Or is he going to turn out to be someone who we should have cut in fantasy? In other words, it's all, at this point, a big name game. I know people are going to get excited about Dennis Smallwood. He used to run Boeing. Wilbur Ross, a very well-connected guy. These are all terrific. But, David, at a certain point, business models will matter. And when that comes about, then you're going to talk about, well, do the rocket ones better than the EV ones, which might be better than the personality ones? Do I like it? It doesn't matter whether we like it. But what I don't like, David, is that when you see so many of these, you know where this does lead. When I say things like that, you know, David, people say, old guy, whatever. But, you know, we know we don't want to get people hurt, for heaven's sake. I mean, if you bought GameStop at 300, how you doing there?
Yeah.
Yeah.
You're not doing too well. No, you're not. Yeah, you're not doing too well. If you owned it last week, again, this is something we talked about. I know, and Jim, we do get a great deal of criticism. We take it in stride. I guess we're dinosaurs, but we've already recognized that. But you know, they had a good run, Carl, the dinosaurs. I mean, I think we sometimes think of them as failures, but they were around for hundreds and hundreds of millions of years. That's a lot longer than we've been around.
They ruled the damn world.
You know, I don't take it that badly. Yeah.
Davis right, Carl.
Yeah, guys. GameStop. GameStop 103.
taking out last Thursday's low of 112. Last Tuesday's low was 80, and last Monday's low was 61. So still a ways to go before it erases some of the crazy gains that it's had over the past few weeks. Take a look at the bond report this morning in Santelli's absence. We'll see how treasuries are faring. Yields rising across the board. COVID relief package of talks, of course, remain in focus after that meeting between GOP senators and the president last night. Over in Europe, data shows the Eurozone economy contracts 0.7 in Q4 due to a new round of lockdowns. Economists do expect a drop. They did expect a drop of 2.5. German GDP grew 0.1. And we'll take a look at the dollar index as well, as we do see risk on across asset classes around the world. We're back in a minute.
Of all the companies on the Fortune 500 in the year 2000, more than half no longer exist. Digital transformation isn't just a good idea. It's a matter of corporate survival. Enterprise AI enables organizations to use artificial intelligence at enterprise scale, solving previously unsolvable business problems to help you not just survive, but thrive. C3.ai. This is Enterprise AI.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Daybreak in the U.S.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Can a recovery be equal, green and united?
There is a direct link between vaccine and economic recovery.
The journey seems to be a little bit delayed, but should not be derailed.
We do need some more fiscal stimulus to continue to bridge the gap. There's still an enormous amount of uncertainty.
New targets of climate change.
Again, the Journal says Netflix is in talks with Zero Dark 30 screenwriter Marc Boal for a movie about the frenzy, while execs at MGM are planning to develop a forthcoming manuscript by Ben Mesrich about the saga titled The Anti-Social Network. Jim, the problem here is we don't know what the third act, how it resolves.
No, we don't, and I know that there are going to be alternative endings. I do feel that people like cop shows, and they like hospital shows, they like fire shows, they like those movies. Can this be an intellectual take that make it so that people get excited? You know what? I think that there's a kind of a ideological rift in the country between rich and poor. They may get a kick out of it. Well, I want to watch it. I don't know. Maybe I'll be in it. I haven't decided yet. David, we are in some wacky world. You know, we're so used to being boring. I guess we ought to take advantage when we're exciting, huh?
I suppose. I don't know. It's been an interesting time. Well, listen, I still occasionally get a check, Carl, from Wall Street 2 or 3. I forget which one it was. I think 3. So, you know, if they want to make some movies, I'm all in. Great. Hopefully we can play our roles.
Well, David, you had some very good roles in movies.
Yes.
Were you in Margin?
Yes.
Were you in Margin Call, David?
I think I was, yeah. Or Arbitrage, I know. But, of course, the great one was you in Iron Man, and you didn't get paid. So, too bad.
Well, I got a hat. You see, I thought it was going to be a failure. Everyone else made hundreds of thousands. I got a Stark Industries hat. I was so thrilled that I actually thanked the director. I may be one of the most ill-advised people when it comes to movies, so thank you for mentioning that complete fiasco. I always like to be brought down by my colleagues. It's better than the people who hit me on Twitter who don't really know me that much. Carl, the 1.5 million friends I have on Twitter, they were very valuable when I was sick last week. Many of them weighed in.
In a good or a bad way?
Bad, of course. I was part of a vast conspiracy to keep GameStop up or down.
Yes.
A vast conspiracy against the regular investor. A vast conspiracy in favor of the short hedge funds. Here's the vast conspiracy that I'm in part of. The vast conspiracy to keep my wife happy because I am at home in Brooklyn. She's showering right now. I'm sure she likes that bit of information. And I have made her life hell. So I've got to break that vast conspiracy in order to be able to deliver what I should be delivering on the show.
Yeah.
Yeah. It's life as we know it right now,
be a little
guys.
lighter.
Trying to go remote 3 ways here from 3 different locations. The delay, hopefully it's something that we don't have to deal with as we get more and more of the country vaccinated. We'll take a break here. By the way, best 2-day gain for the S&P and the NASDAQ since basically Election Day. We're back in a moment.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
Fred, tell us about this painting.
It was commissioned for the city of Disneyland.
And the city of Disneyland.
Yeah, before they built the amusement park there, it was just a city.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
economic reopening trade is definitely in play today. Disney's leading the Dow, Amex and Visa not far behind. On the S&P, top 5 gainers include both MGM and Live Nation. We'll see how this develops. Squawk on the Street's back in a minute.
Stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
This budget is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5 in the year in which the spending happens. The 2.5% of GDP spending on the infrastructure can translate into between 5.5 to 6% of GDP just from the infrastructure. This would be, of course, adding to the V-shaped recovery. The healthcare spending that's actually a signature moment in India's history in terms of the emphasis on healthcare.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that's always believed in the unity of the people of Ireland, and we must work out what a shared island would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Let's get to Jim and stop trading.
Not long ago, Nikesh Arora took over Palo Alto Networks. What was his first thing to do? He put millions to work buying his own stock. Why? Because he believes in himself. Should he have done? Absolutely. Today, the stock hits an all-time high. Why? This morning's Credit Suisse saying that they've got really the best on-premises and cloud-native approach, meaning that if you're still stuck in the skyscraper, but you also want to be in the cloud, Palo Alto might be the call. I've liked CrowdStrike, I've liked Zscaler, I've liked Okta, but you know what? The winner here may be Palo Alto. Congratulations, Nikesh, for a transition that many people doubted he could make, and he's accomplished it. Well done.
Jim, you're also going to have Amazon and Google Alphabet to kick around tonight. Expectations going into the print?
I think that, boy, these have run a lot. Alphabet at an all-time high. Amazon not that far. Look, I'd obviously like a little more give. Amazon, the numbers are all over the place. Obviously, that's, I think, one that people are going to say, well, hold it, was that just the nesting trade? I don't think it was. I'm looking forward to speaking tonight, by the way, to Carol Tomei, UPS, because I think she has a very good read on e-commerce and whether it's going away, whether it's staying. Norfolk Southern, much more, of course, about general industrial trends. And then here's the man of the hour. Chipotle's pulled it off, Carl. They're making as much money pre as post because they figured out technology. Brian Nichols, a genius. All these three guests are very exciting. I live for the show. I live for what we do. I'm going to thank everyone, whether it be Todd Bone, executive producer, Regina Gilligan, Heather Gaines, who's here with me. Everyone's made me feel very at home. It's a family. And no one like David and no one like Carl, because it's not easy doing this three-way thing. And I really enjoy and love you guys.
Somehow we get it done, and it's good every time, I got to say, Jim. Really quick, before you go.
Thank you so much.
You know, a fun strat last night, their point was if you can get the VIX to settle down, it's now below 27, that's a sign some of the technical selling is over, and stocks will sort of come to Jesus on the good COVID trends. That ostensibly is why the Disneys are leading today. You buy that?
Yes, I do. As David was saying, and we were getting closer to an opening trend, as you've been talking, Carl, the disparity between the people who have COVID and the people who are getting the shots matters tremendously. I think Disney is one of the most undervalued stocks there is. And a lot of what's happening at Disney is a recognition that when they are able to open, you get $200. And that's going to happen, Carl. I really do. Christian McCarthy, what a great CFO.
Oh, well, what? That'd be a big story. Jim, we'll see you tonight. Of course, a busy day on the earnings front. Mad Money, 6 p.m. Eastern Time. Good Tuesday morning, everybody. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. As we said, best two-day gain for the S&P and Nas since early November, as you got the VIX getting lower, oil above 55. As we said, Disney, MGM, some of the reopening trades definitely in play. Our roadmap begins with the game stopped. Shares of GME, AMC, and others on that Reddit squeeze plunging again this morning as that trade remains volatile.
Plus, we're going to talk about the hedge fund response, particularly to what's going on with short sellers. Kyle Bass will be our guest. He says, quote, "This isn't investing, this is insanity."
And Elon Musk's SpaceX announcing plans for the first ever all-civilian space flight. We've got those details and what's actually a pretty busy day for space, Carl.
It definitely is, and we're going to get to that. We'll start with GameStop, though, plummeting for the second straight day as trading limits remain in place with many brokerages. Joining us this morning is someone who helped us understand this story early on, former E-Trade CEO Karl Roessner, currently CEO of Lesteris Acquisition Corp. Karl, welcome back. Thanks again for the time this morning.
Thanks for having me, Carl. It's a pleasure to be here.
I'm not going to ask you to pontificate on near-term stock swings or price action, but I do wonder if it feels to you, given everything you're seeing, that this fever is somehow breaking.
So I think we have to be a little bit cautious in terms of fever breaking. With respect to GameStop, it appears as though some of the air has come out of that balloon. But I think what you just said in terms of, you know, the guest you're going to have on later for this is not investing, it's insanity. I actually think it's investing insanity, right, in terms of what you're seeing. You have some folks who are out there fighting for their cause and doing what they believe is right and taking some of the losses that they're talking about taking today, yesterday, and on Friday in terms of the just downdrop in GameStop. For others, it's their investable cash. It's their hard-earned money, and they're sitting with maybe having put $100 in and now looking at $20 or $25 in their account. That, to me, is the problem that we have to solve for. We have to figure out how to protect those folks.
Yeah. We now know that House Financial Services is going to hold a hearing on the 18th, and I think we do expect to hear from Vlad at Robinhood. You think anything constructive comes from that?
So I'll be a little bit tempered on this one because we've lived through this before. When you look back to what went on with, when Flash Boys came out and some of the things around order routing and payment for order flow and that whole routine. So I think using that for an understanding of the overall structure of the markets and what went on here, right? What actually happened when NSEC, DTC got that notification in terms of, the settlement risk that was there? What happened in that? Were so many people caught short? Where was the risk management? Where were there, order rooms and risk management systems? How did that all work together? Because I think if we can get an understanding of that and how the sort of shorts in the background, how the whole, the market making situation behind it, how all those market centers acted, if you can get an understanding of the whole situation, maybe you can start to address some of the risk that this actually posed to the little guy, right? To the retail investor who really is going to end up suffering on the back end of this.
Carl,
so I think if we can get good information out of it, that would be my goal.
Yeah, certainly I think all eyes will be glued on that situation. I'm curious what you think of the fact that investors put another $3.4 billion into Robinhood in recent days. That's more than I think the company had raised since its inception up until this point. Is this investors looking to protect their previous investments? Is this a vote of confidence, given the fact that Robinhood has been so downloaded and has really now become a household name for better or worse? Or does it speak to the value of its business, of those order flows, given the fact that they are so heavily skewed towards retail investors and younger retail investors?
So to unpack that, just a little bit, what I would say is they have an amazing system that provides a very easy to use user interface, right? UI, UX that I believe is, really, really well done. And, the retail investor has really adopted to it and continues to open new accounts and download. If you just look at some of the, data available on the downloading of the Robinhood app, I think people are still extremely interested in the platform. They've made it extremely simple for the retail investor to, get into the marketplace. So I think there's a lot of value here. The other points are they needed that, capital or the infusion of that equity to continue to operate, build their business and address some of the issues, as a result of this. So, the decision is kind of easy if you're already in that investment and you see how good the technology is and where they think they can get to, right? You're going to want to shore it up and keep it going. And, you want to protect the company and protect the investor base.
Carl, it's David, and it's good to see you. On this Robinhood question, though, as somebody who has somewhat unique perspective here, I mean, it appears that a lot of their money is made by just selling their order flow, maybe to the likes of Citadel and some others. I understand the power of the platform, but it does also seem to be a more capital-intensive business than perhaps they had anticipated. I'm just trying to understand what the real business is there. You seem to obviously view it positively.
Well, I view, let's just step back for a second, because what I view is leveling the playing field for retail investors as extremely positive. Right? It was the premise that started E-Trade way back when in 1992. Right? So we've been at this for a long time trying to level the playing field and give the retail investor access. So that's where I'd sort of, full stop on that point. In terms of payment for order flow or, the market centers behind this, that's not really where, from what I can tell and what's available out in the public market and what they've disclosed so far, that's not where the capital need or the liquidity crunch came from. It really came from, the clearing center, the central clearinghouse of DTC, saying that there was settlement risk that was involved that was a greater extent than they'd ever seen before, because of the volume and enhanced, unbelievable volatility that was taking place. And when they saw the numbers come through from, the trade reporting facility in terms of what was actually out there, there was a demand for additional liquidity, right? You have to, by the time those trades actually right, they're already cleared on the back end. They're already matched by the market centers, right? Payment for order flow is a completely different issue. Yep. Go ahead, David. Sorry.
Yeah, no, I get that. I get that. I guess I'm just trying to figure out exactly what Robinhood's business model really is in terms of their ability to actually profit. Because you could argue, Carl, that if they were a public company and we watched this occurring in real time with their stock price reflecting the difficulties they were having, it's very much unclear to me whether they'd still even be around.
Well, the one thing I would say is from time to time, right, and it's one of the reasons that I'm very careful about speaking in any negative tone about any competitors or other systems out there on the street. From time to time, all of the, brokerages and the retail houses will have their issues, right? Whether it's a technology outage or some kind of a slowdown or an order routing problem. So we all go through those hiccups. And for something like this, right, with the unprecedented volumes that were out there and just the sheer volatility and magnitude, what I hope they'll do, David, is look at this from a risk management perspective, sit down with their order room, sit down with their risk management group, do a full diagnostic, right? Learn from it and build to address it. And it appears that that's what they're doing, because some of the information that's coming out, I think, into the marketplace today is a lot more clear. At least they're trying to, sort of get out and communicate a little better with the street.
Yeah, Carl, I mean, I realize this has been a broad-based phenomenon, and certainly Robinhood has been the lightning rod in many ways in terms of where the attention is going. I wonder, though, because of that and because of how competitive this landscape is among the online brokerages, if there will be winners out of this in terms of increased market share or ability to attract more users now.
And that goes to the central question of trust. Right, when you're dealing with someone's finances, you're dealing with someone's paycheck or their hard-earned money, and helping them invest it and saying that it's simple and easy to use. If you break that trust, it's very, very hard to get back. So I'm very interested to see sort of who the players are who come in here and who benefits from this, if anyone. I mean, I hate to see folks benefit from others, stumblings, if you will, or growing pains. But I agree with you. It's going to be very interesting to see how this all maps out.
We appreciate your guidance as always. Hope to talk to you again soon. Thank you again.
Thanks very much,
Karl Roessner joining us today. We're starting to get a glimpse of what the U.S. House impeachment managers will say when those impeachment proceedings begin. For that, we'll turn to Ylan Moy. Hey, Ylan.
Hi, Karl. Well, the House impeachment managers have released their pre-trial brief ahead of those Senate proceedings against former President Trump that are set to begin next week. Now, in their document, they will say that President Trump's responsibility for the riots on January 6th is unmistakable. It goes on to say that President Trump's conduct must be declared unacceptable in the clearest and most unequivocal terms. This is not a partisan matter. His actions directly threatened the very foundation on which all other political debates and disagreements unfold. Now, in their case, they will try to rebut several of the arguments that President Trump is likely to make in his defense, including that this process is unconstitutional because he has already left office. The brief says that history, originalism, and textualism leave no doubt that the Senate does indeed have jurisdiction to hear this trial. President Trump is also likely to make the argument that he was merely exercising his free speech. The House impeachment managers call that argument a red herring. Now, Morgan, we are expecting to get a similar document from President Trump sometime today. We will let you know if and when we get it. Back to you.
We know you'll bring that to us if and when we do. Ylan Moy, thank you. Meantime, the hedge fund industry is readying an aggressive response to all the criticism amid the GameStop saga. Eamon Javers has the latest. Eamon.
Yeah, Morgan, that's right. We haven't seen anything sort of in front of the scenes so far, but behind the scenes, I'm told by sources familiar with the hedge fund industry's plans that they are readying a defense here, that they feel that in the wake of this GameStop story, they've received so much criticism across the board on the internet and in the media and elsewhere that they feel like they need to ready a defense, and they're putting that together now, putting together a unified message from the industry, and we can expect to hear that soon. Here's a quote from one source familiar with the industry who explained what's going on, who said, a significant amount of time and attention will be spent working to explain the industry's story a little more cogently. Never has the need for this sort of thing been more apparent. So what is that going to look like, explaining the industry's story? Well, I am told that the possibilities include messaging to both the public and to lawmakers on Capitol Hill about the hedge fund industry, explaining in their view how hedge funds benefit communities, explaining the wide variety of approaches and investment strategies that hedge funds employ, so that there might be a hedge fund employing a strategy that you don't like, but if that's the case, there's probably one employing a strategy that you do like, and a reminder that hedge funds didn't take bailout money. That could be in the cards as well here. So this is, self-serving set of arguments from the hedge fund industry, but I think it's what you can expect them to roll out here in coming days and weeks. Clearly, this whole controversy has gotten the industry's attention, and now they feel like they have to respond and defend themselves both in public and on Capitol Hill. Guys, back over to you.
Eamon, thank you. Fascinating. Would be interesting to watch and listen there. Speaking of hedge funds, by the way, later this hour, don't miss Heyman Capital's Kyle Bass. He's a hedge fund manager who doesn't mind speaking his mind and, of course, has been a short seller quite often. We will talk about the future of short selling with Mr. Bass. Stay with us.
The countdown to the close of the European markets is sponsored by IG.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC. Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Siemens Energy has announced it will cut almost 8,000 jobs by 2025 as part of a cost-cutting program. It comes as the German company returned to profit in the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world. It's now always keeping the balance. On the one hand, really driving the growth path and at the same time improving the areas where we see more challenges in the market, like oil and gas.
It is now time for our ETF Spotlight. We're taking a look at the transports, ticker IYT, and the green again this morning, up double digits over the past 12 months. What are the names that's pushing the group higher today? UPS, beating on earnings estimates, reporting a 21% jump in revenue to $25 billion during the quarter. That marked a record for UPS as it navigated unprecedented e-commerce sales over the holidays, put a lot of measures in place to do that. And that, of course, was on top of the vaccine rollout as well. The stock is up more than 50% from a year ago. It's up 4% right now. Jim Cramer will have an exclusive interview with the still new CEO of UPS. That's going to be tonight on Mad Money at 6 p.m. Eastern. Carol Tomei, you don't want to miss that. We're going to take a quick break. Stay with us.
Resilience is being ready for tomorrow. Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone, which is about bring health through food to as many people as possible. And I think the resilience comes from our ability to trade off the very short term, the mid-term, and the long term.
Supply chain resilience is something we've been working on at Walmart long before the pandemic. What we find is when you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
It's time to create the next normal.
The countdown to the close of the European markets is sponsored by IG.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture. on the next CNBC Virtual Davos Debate.
Is shining a light on the millions of Americans who were not invested in the stock market. Robert Frank has more on that this morning. Hi, Robert.
Hey, Carl, good morning. Well, the hope for all this retail trading revolution is that it will democratize the stock market, a market that has been growing increasingly concentrated into the hands of just a few. Now, according to recent data from the Federal Reserve, the top 10% of Americans now own 88% of all corporate equity and mutual fund shares. That is among the highest shares on record, and it's actually above the pre-pandemic levels. Now, the peak for broader American stock ownership appears to have been back in 2002 when 67% of Americans said they own stocks. Now, about half of Americans don't have any participation in the stock market or own any shares, even if you include their retirement accounts. Now, the concentration is especially high at the very top. The top 1% now owns more than half of all stocks, and they gained over $6 trillion in wealth just since March. Generationally, today's millennials are also lagging behind. The median value of their stock holdings is about a third less than Gen Xers at the same stage in life. You look at the disparities along racial lines, those are even worse. The stock ownership by Black and Hispanic households is about half of that of white households. Morgan?
Breakdown and exactly where we're going to start with our next guest. Robert Frank, thank you for that. Amidst the Robinhood frenzy, many retail traders are flocking to alternative platforms to invest. Let's discuss with Noah Kerner, CEO of Acorns, a micro-investing platform. And just as a disclaimer, NBC Universal is an investor in Acorns. Noah, thanks for being with us this morning.
Good to be here.
What are you seeing in terms of more people coming to your site and signing on right now?
Well, we've almost reached 9 million accounts. And what happened last week was Wednesday to Thursday, we saw a doubling of accounts, and then we saw another doubling of accounts. This is new user accounts. So we're seeing a lot of people coming in. Obviously, they're coming in because of what's happening out there. Acorns does not offer trading. We offer diversified portfolios of thousands of stocks and bonds. And what we try to encourage people to do is not to think short, but to think long and to own part of the entire American economy, rather the whole American economy, rather than thinking about, just having a fragment.
Yeah, so just to be clear, you are not in competition with the online brokerages like the Robinhoods of the world, but in many ways, the retail frenzy we're seeing has been a tide that's lifted all boats. I am curious, though, what the millennial situation is. I mean, we've known that after the Great Recession, millennials were skittish to get into the market and basically were not invested in the way previous generations were. Are we sort of hitting a tipping point now where that is changing? And if so, is the fact that we are seeing the air coming out of the GameStop shares, for example, right now a real risk?
Yeah, well, I mean, over 60% of our customers are first-time investors, which is great. The thing that I'm afraid of with what's happening right now is people are thinking a lot about trading, right? And trading in short term and this kind of frenzied activity. And that's getting sort of heightened by all of the news media coverage. And this is a little bit like what happened when the pandemic hit and the market crashed and everyone was saying the world's coming to an end, get out. A lot of people got out. And the thing is, that's exactly when you should stick with it and stay patient. And right now, what I hope the message becomes, and I hope people come to understand, is diversification. Put your money in a basket of ETFs, which is one of the things Acorns obviously offers, and just let it sit there and be patient. If you want to play with 10% or less of your money and take risky bets and invest in individual equities or trade or buy options, whatever it is you want to do, that's fine. But the 90% plus of your money, that is going to help you really build a future, you want to put that into a diversified portfolio. And I just really want to get that message out there more than anything, just because I want people to know it. I mean, obviously, you know, we benefit from people coming to Acorns, but that's really secondary for me, frankly.
Yeah. I am curious, though, because part of what I guess has led to this moment that we're in the market right now has been those direct stimulus checks to people. Have you been a beneficiary as well? Have you been seeing people put that money to work at Acorns?
We have over the last 10 months when these things happen. We've seen increased contributions, which is great. I mean, since you can only contribute to diversified portfolios at Acorns, that's a great thing. And you know, we actually did see in 2020 a higher retention rate than we saw in the past, which means people were sticking with it, which I hope means that the education we were providing for people and the messaging we were providing about the fact that sticking with it, staying patient, don't pull your money out when the market dips, stay the course. And by the way, that applies to diversified portfolios, right? Not necessarily individual stocks. So I think that messaging came across, and you know, I am glad that we did see people putting their stimulus checks to work in terms of putting their money into diversified portfolios.
Hey, Noah, you know, if we're in an environment where obviously a lot's being driven just by the meme, we've talked about memes a lot. They sort of are hollow in essence, but I wonder if there's a way to sort of harness that power and the virality of it and from that extend a lesson that says, look, it's not about how much you made over the past week, but look how much you made or someone might have made over the past 5 years. You know, so where the heroes of social media are those who have made a decision, an investing decision, and stuck with it.
Absolutely. And, you know, when you look at the market overall in history, I always like to say every downturn in history ended in an upturn. So if you really stick with it and keep your money diversified, it's going to end up paying off. When you look at the market overall over time, you know, 6%, 7%, 8% growth, it's not a get-rich-quick scheme. It's more of a get-rich-slow scheme if you can stay patient and stay the course. And one of the, you know, when we have 100,000 new customers come in a really short period of time, that's great. You're going to see a little bit more of a higher churn rate because people are coming for a certain thing. But it's our job at that point to educate people to the virtues of diversification, of sticking with it, of investing in the entire American economy rather than just a fragment of it. And I think that you know, that's hopefully the message that's resonating for our customers who are coming for one thing and then being introduced to another.
Yeah. And certainly that's loud and clear. It's diversified portfolios where Acorns is concerned. I am curious, though, just before we wrap this up, if you are considering new offerings or new services, given the fact that there is so much appetite in general out there right now.
I mean, we're always considering new offerings, but it's always a value orientation and a mission orientation. Like what's in the best interest of the customer, and what's in the best interest of the customer is to go long, stay diversified, benefit from compounding. So that's, you'll continue to see us add products, but we think of Acorns as the place where you should put the majority of your money and go long. And so no risky bets.
All right. Noah Kerner, Acorn CEO. Thanks for joining us.
Thank you.
Well, as you saw, GameStop shares nearing 100. After the break, Heyman Capital's Kyle Bass is going to talk about the action in that stock, what it's meant for those who would choose to short single name stocks, and a lot more. We're back in 2 minutes.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Reporting on the Federal Reserve is one of the pillars of CNBC's coverage.
You guys ready? Here we come. Let's get to Steve Leisman with the Fed decision.
Up by 1/4 point.
Put up the Dow. We're up 250.
Obviously, the market reacted to it.
New Chairman Jerome Powell will hold his first news conference.
Afternoon.
Leisman gets the first question.
Where's your biggest concern here? Is it in overkill when it comes to rates? There's very little that moves the markets as consistently as the Federal Reserve does.
Give me Treasury.
I feel tremendous responsibility both to get my reporting right and to get my analysis right.
your CNBC COVID update at this hour. Pfizer says this morning it's speeding up its delivery of the COVID vaccine to the U.S., with 200 million doses coming by May instead of by July. The company says regular booster shots will probably be necessary to maintain the immune response and deal with any new variants of the virus. New data published in a medical journal shows Russia's Sputnik V vaccine is almost 92% effective in preventing symptomatic COVID-19. In the United States, 134,000 new COVID cases were reported yesterday. It's the 5th day out of the past 8. The case count has been below 150,000. 1 month ago today, we saw the biggest one-day count of the pandemic with more than 300,000 cases. And at a meeting today between Japan's Liberal Democratic Party, the head of the team organizing the 2020 Olympic Games, postponed to later this year, said they will definitely be held, regardless of the COVID situation in the country. Back over to you, David.
Well, that's good news for a lot of athletes who work extraordinarily hard. Thank you, Courtney.
Yeah. Thanks.
Short sellers, well, they've been running for the hills as the retail stampede and names such as GameStop brought them horrific losses. Our next guest says the market will miss them. He's Kyle Bass, who in his long career in asset management has focused on companies he believed were overvalued and in many cases, Kyle, even frauds that you helped to potentially uncover. Let me start, though, with the simple question. Is short selling, as we've known it, dead?
I mean, I don't want to be hyperbolic and say it's dead, David, but, you know, you and I have known each other for the better part of 25 years, and things have evolved over time. You have the Fed printing an unprecedented amount of money. You've got retail traders, getting together and kind of laser focusing on companies. And so I think the risk profile of being a short seller has dramatically changed. And I think that the one negative consequence that I see coming out of all of this is the fact that short sellers are a natural balancing force in the market. Many past and current chairpersons of the SEC have said so. And so the work that's done in the short selling community to police the market of frauds and Ponzi schemes and deceptions by management, I think is a very positive balancing force. And unfortunately, what the most recent events are going to precipitate is the fact that short sellers, many of them are going to walk away and not do the work that they used to do over the last few decades.
Yeah, you mentioned, of course, our long friendship. We date back to a company called Arrakis Energy in 1995, Kyle. And there was a series of companies from the late 90s and onward that you focused on in terms of doing work at that time, that reporters also focused on, because you did feel that there was something wrong or that there was actually fraud in terms of what they were representing. Explain to people what short sellers, in those cases at least, were capable of doing and why that was a benefit to the market.
Yeah, I think when a short seller finds a fraud, finds where there could be tens of thousands of individual investors. Typically, frauds are perpetrated not on institutional investors, although they do get caught up every now and then in frauds unwittingly. But I think the majority of the frauds throughout my almost 30-year career on Wall Street has been taking advantage of mom and pop, taking advantage of people just trying to earn an income on their retirement savings, or just trying to grow their portfolios slowly because they're not financial market geniuses. They're not people that spend all their time in the market. So, you mentioned Arrakis Energy. If you remember, that was a company, a Canadian listed company. It was also listed in the U.S. that was telling people that they had one of the largest oil finds in African history in the Sudan. And the company built up to over a $700 million market cap. And when I got a hold of the Chevron project manager that sold Arrakis Energy the oil lease for $1 million, he said there's no way it can work. They'd have to heat up the oil at every 300 feet for 400 miles to get it to the coast. So these frauds end up sucking in so many individual investors. And we can go through the list of frauds in the big ones. The Enrons, the WorldComs, the Wirecards. Most recently in Germany, in Wirecard, they put the whistleblower in jail before they realized that he was right, and the whole thing was a fraud. So it's very important to have this balancing force out there to keep the investing public out of being defrauded of their precious retirement savings.
Yeah, but there is a distinction to be drawn here, for example, in the case of GameStop, and we're watching these shares collapse right now, Kyle, but the argument there was not over whether GameStop's a fraud. Nobody was claiming that was the case. It's not. The argument was about valuation, was about whether the stock price actually reflected the real prospects for the company or whether it was perhaps inflated. And there were a lot of people who moved into those shares and shorted them on the belief that they weren't. You know, sometimes that can be viewed quite negatively. Sometimes it does appear short sellers are also getting together in a way to create what we call a bear raid. You know, you can have arguments about valuation, and sometimes short sellers can take it a bit too far, or no?
I mean, look, I think in a world where there's a Gaussian distribution of participants, i.e. there's a very large number, there's a bell curve, there will be some bad actors, there'll be some great actors, and there'll be some actors in the middle. I think there's always abuses on both sides. And look, in the instance of GameStop, I think every market professional knows that this is going to end in tears. It's great that a bunch of people got together to focus their sights on something that was heavily shorted. But if that's your strategy, you're going to lose a lot of money over time because A, short sellers actually do a lot of work. And there was a reason they were short a broken retailer. B, you know, if what you're doing is attacking something that's broken, you're just going to end up, you know, holding the bag here as we see investors in GameStop. GameStop 2 months from now won't be mentioned. It'll be, you know, back close to where it started. And unfortunately, you know, I'm sure we've all experienced this being market participants, but 2 nights ago at dinner, I had people from the service industry asking me, hey, should I buy AMC and GameStop? I had an 8th grade kid tell me he and his whole class had logged onto the Robinhood app and they all own GameStop. And I'm thinking, everyone's just going to get massacred here. And it's because of the price frenzy and this aggrandizing these groups of people that, you know, have for a day or two achieved incredible success. But the funny thing about GameStop, or the irony is, the shorts got carried away in a stretcher and the majority of the longs are going to lose almost everything too. So that kind of volatility is not good for the market. It's not good for securities regulators. It's not good for hedging and everything that goes on. In my view, this was very bad for, call it, trust in markets. And I think social media, just like social media brought Trump to power, social media created this phenomenon. I think we live in a post-truth world, and he who tells the best narrative wins. And therefore, I think we're in a new paradigm of social media narratives, and I think it's a very dangerous world that we're living in.
Yeah. I'd call it a postmodern world myself. I realize that there are many different sides to this, and certainly we're going to be talking about it for a while. But if we just step back more broadly and look at market structure and the fact that that is now, I think, going to be under increased scrutiny. I mean, we had Congressman Lynch on yesterday. He's actually the chairman of the House Subcommittee of National Security. He actually said on our air that he is looking into this as a possible national security situation because he is now worried that this has highlighted vulnerabilities within our markets. As somebody who focuses a lot on that area as well, I wonder how you think about it from that standpoint.
Yeah, I mean, it has been reported that you've seen Chinese investors, Indian investors, and South Korean investors piling in. The question is, you know, with so many state actors in some of these areas that are true national security threats to the United States, you know, their ability to fan the flames of populism and dissent in our marketplace is absolutely huge. And, you know, why we allow countries like China to have all of their wolf warriors, or call it state media operators, on our social media while our social media is banned in China is still a giant question mark to me. I don't know why we allow this to happen. Either we should have a full and open marketplace where everything's fair and equal, or we shouldn't allow it. And so I think the investigation here is going to show there were a lot of foreign actors involved that actually jumped onto the bandwagon once the wagon started moving. You know, I don't know what started it all, but I know that we're vulnerable.
Yeah, we also don't know how many larger investors were involved, but something that's been pointed out, and right now on Twitter is as well, those who are saying stop crying for short sellers, will point out that at least we've heard that over 140% of GameStop's float was short. I don't know if that was truly the case. or whether people were naked shorting, as we call it, Kyle, but there are some abusive practices on that side of the game as well.
You know, so I'm just going to say that the SEC's got that under, in my view and in my experience over the years, they have that under control. If you call your broker and you locate a share, they send you a location code and there is a bona fide transaction. If you engage in a naked short, the SEC catches you in a nanosecond. They know exactly how to do it. And they're very good at it. And they've got a lot of programs and AI in the background these days that find people that do it, David. So I'm just going to tell you the numbers you're seeing aren't right. I don't know what they are, but anyone that naked shorts is going to get literally immediately caught by the SEC. Today's regulatory system regarding shorts and naked shorts is actually very good. So again, I don't know what the number is, but you know, one of the other things I'm sure, David, I don't know if you guys have talked about it, but look, Robinhood has free trading. Well, nothing's free. So it's important to note that Robinhood sells its order flow to people like Citadel and others. Well, I think the causal linkage between what firms get to see Robinhood's doing before everybody else, I think that should be investigated.
Yeah. Well, listen, a number of things may be, again, as we watch GameStop near its lows. Something we talked about last week. You talked about the social media fervor as well, Kyle, but you know, a name like Tesla, though, has had a lot of back and forth through the years. I think you probably were shorted along the way, never alleging fraud, but wondering about their aggressive targets. In that case, short sellers obviously lost big to the crowd that ended up being correct in terms of at least the prospects for that company.
Yeah, I think, so look, full disclosure, I have long ago lost money. I made money and lost money in Tesla. Actually, I don't know what the net end game was, but I think Elon Musk is a genius. I was only short Teslas. I was long some other companies in the EV space. But I would say that Ace Greenberg at Bear Stearns, when I was a partner there, or a senior MD there, told me one thing once. He said, never short anything just because it's expensive, because it will get a lot more expensive before you end up being right. And look, those are words of wisdom. You know, you want to be, if you're going to engage in market hedging, being long something and short something, you know, you should be short something with a broken model, not necessarily something that's just overvalued. I mean, should Tesla be worth $800 billion or worth more than all the car makers that you can name off the top of your head combined? You know, probably not. Is Elon Musk an amazing visionary and entrepreneur? 100%. I toured the SpaceX factory. I'm still in awe of what that man's been able to put together in his life. But, you know, this focus on the short sellers of Tesla, you know, they'll all learn their lesson. And that's the beauty of this game, David. If you're short something that is constantly doing better and working and operating as a great company, you're going to lose every time. And so this is it's not a free lunch here.
No. All right. And finally, Kyle, you know, I've had a number of people who run hedge funds tell me they are certainly going to reconsider whether they want to do single name shorts and maybe perhaps not do that, at least for some period of time. Is that going to be the case for you as well?
Oh, absolutely, David. I mean, this is, I don't believe I don't want to exclude it for the rest of my life, but I'll tell you in my foreseeable future, I'm not going to engage in anything like this. You know, it's taken me 28 years to figure out that investing in human innovation and positivity creates so much of a better life for you, for your country, for everything you're investing in, and focusing on the negativity, you know, with even some of the recent frauds that I've found. You know, one of them is suing me for defamation, even though the SEC brought multiple fraud charges against them. Their auditor got censored, fined and barred from auditing public companies, and they haven't been arrested yet publicly, but here I am in a lawsuit. So I think, you know, it's a business where there's not a lot of upside. There's a lot of downside. I think the upside is in human innovation, and I'm very excited about focusing on that in my future.
Well, Kyle, appreciate you taking time. Interesting subject for us to discuss. Thank you.
Thank you.
Yeah, well, watch GameStop now in full collapse, down 60%. Watch Pfizer as well today. After a slight miss on earnings, revenue came in ahead. Company raises full-year guidance, says it expects about $15 billion in sales from the COVID vaccine this year. We'll be right back. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
Here, ESG covers the kind of responsible, sustainable investing, impact investing, and thematic. But there's an ongoing spectrum of philanthropy, philanthropic donations, so on and so forth. I like this.
The street, I'm Frank Holland. Stocks, they are rallying today with every single sector in the S&P in positive territory. Financials, they're the big outperformer, up more than 2% so far today. Within that particular group, many of the big Wall Street banks are leading. That includes Morgan Stanley, Bank of America, Wells Fargo, and Goldman. And this move comes as we see yields move higher on the U.S. 10-year Treasury note, hitting their highest level in more than a week this morning. Morgan, back over to you.
Holland, thank you. Coming up, a lot of news in the space. Rocket startup Astra going public after its small rocket successfully reached space in December via SPAC. That's going to value that company at $2.1 billion. Shares of the SPAC, Holicity, shooting higher. Talk about a rocket ship emoji. Plus, SpaceX announcing plans for the world's first ever all-civilian mission to space. That's lifting shares of Shift 4 payments up 6% today. We've got those details. Stay with us.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
This budget is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5 in the year in which the spending happens. The 2.5%. Spending is that's actually a signature moment in India's history in terms of the emphasis on healthcare.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
GameStop, as we said before the break, in full collapse today, hits an intraday low of 74.22. Morgan is a far cry from 483 last week. From the highs now in the past week, GameStop's now down about 82%.
Yeah, a fast move higher, a fast move lower. SpaceX, meantime, though, announcing it will launch the world's first all-civilian space mission later this year, with 4 passengers headed to orbit aboard its Crew Dragon capsule. The mission, called Inspiration 4, will raise money for St. Jude's Children's Research Hospital for childhood cancer research, with one of the seats being raffled off to a random donor. The company's spacecraft will be commanded by Jared Isaacman, the founder and CEO of Shift4 Payments, who is also the man funding this mission, and he joins us now. Jared, you definitely have the best live backdrop of the day, I have to say. It's so great to have you with us.
Oh, thank you very much, and I completely agree with the backdrop.
So this is quite something. At first all-civilian mission. It's going to be 2 to 4 days in space. It's a Mercury-era style trip in orbit around the Earth. I'm not going to ask you why SpaceX, because I know you're a fanboy, self-proclaimed fanboy, but I am going to ask why you're doing it this way.
Yeah, so I think that Inspiration 4 is incredibly exciting mission. It's the first step in a world where everyday people can go and journey among the stars. And recognizing kind of the significance of that first step, we tried to be really incredibly thoughtful as to the crew selection process, the individuals who are representing this mission, the organizations that stand to benefit, like St. Jude's Children's Research Hospital, which will be, the largest fundraising and awareness campaign in their 59-year history, but also Shift4 Payments as well, playing a very key role in the entrepreneur selection process, which is how we'll identify one of the one of the crew members on this mission.
Yeah, I mean, you hold world records for some of your flying. You certainly have, I think, thousands of hours under your belt as a pilot. To basically do this all civilian, I mean, we've seen other examples of so-called space tourism and people going to orbit, but every time until now, there has been an experienced astronaut on board. The fact that you're going about it this way, what's involved in the training, and how are you thinking about it from a safety perspective?
Yeah, so I'm incredibly confident in the product and technology that they have pioneered here at SpaceX. I mean, this is an organization with amazing foresight. I mean, you know, 20 years ago to set out as a commercial entity and try and revolutionize space technology, pretty amazing undertaking. And I mean, just look what they've accomplished. I mean, they land rockets on ships in the middle of the ocean. I mean, that's super impressive. Not to mention the Falcon 9 and the Dragon spacecraft that I'll be riding on, you know, first human-rated vehicle in the United States since the space shuttle was retired. Now, that's NASA going through, you know, 60 years of lessons learned to put SpaceX through their certification process. So completely confident. I've had, you know, total exposure to the training curriculum that we'll be undertaking throughout this year. I am very confident we'll be well prepared for this mission later in 2021.
Yeah, you're donating the other 3 seats. I think one's going to be dedicated to a frontline healthcare worker. The other 2 are going to be basically given to folks through these competitions that you've put in place. I think you're even running a Super Bowl ad as well. At a time where, and I brought this up on the conference call last night, but at a time where we're very focused, certainly here at CNBC, on this whole discussion around democratization of markets, you could say that this mission is in some ways a push towards democratization of space. How are you going to pick those people that are going to fly with you, and what's going to be involved, I guess, in their training?
Yeah, so that's such a great question. I mean, that's like the most exciting part about Inspiration 4, and it's right there in the name, is that, you know, we aim to inspire the world as to certainly what's possible up there, you know, among the stars, but definitely what can be accomplished down here on Earth. And that's why we're so focused on this crew selection process and picking, you know, everyday people, all very special in their own right, who, again, are walking around today and probably don't realize, you know, 30 days from now they're going to get fitted for a spacesuit. So the crew members are supposed to represent all of what we think are great attributes of humanity, mission pillars. So we have hope, which is a frontline healthcare worker. We have generosity, which is, hey, anyone can go and donate on our mission website, Inspiration 4. It's to a great cause. You might be an astronaut in 30 days. And, of course, the Entrepreneur Contest is part of Shift 4 Shop.
All right. Well, we're up against the end of the hour. I have so many more questions for you. So please come back and keep us updated as all of this planning unfolds here. Thanks for joining us today.
Thanks for having me.
Squawk Alley will be right after this break.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages, 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market, as you say, the increased retail activity in the market, and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, Blake Mycoskie. CNBC.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
morning. It is 10 a.m. at GameStop headquarters in Grapevine, Texas. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Tuesday. Welcome to Squawk Alley. I'm John Fort with Carl Quintanilla and Deirdre Bosa. Is it game over for the GameStop rally? Shares getting crushed this morning, down about 58%, along with several other meme stocks, while the major averages are surging. We will have Twitter's former CEO, Silicon Valley's congressman, and the dean of valuations all weighing in on the GameStop and related trades and the continued disconnect in the markets. But that's not all we're watching. Deirdre?
John, we're also watching fintech valuations at large. I mean, over the last few years, startups in this space have raised money at a dizzying pace at ever higher valuations. Take a look. Robinhood, Stripe, Chime, Plaid have become some of the biggest unicorns in the world, seen as tech first, financial services second. But the Robinhood blowback could raise a question, Carl. Has regulation been an overlooked risk, and could we see some of these valuations unwind this year?
Yep, we're going to watch that along with Marc Cuban. D, I know you've been tweeting a little bit about his Ask Me Anything on Reddit, talking about Wall Street bets right now. We'll get to that in a moment as we watch GameStop's collapse today. Joining us this morning, start off the hour, former Twitter CEO Dick Costolo is with us, currently a general partner at O1 Advisors. Dick, always good to see you. Good morning.
Great to hear you guys. Would love to be in the studio with you, maybe someday soon.
Yeah, we're looking forward to that day. Look, I mean, we're watching GME obviously go back to levels that we saw about a week ago. Game's not over by any means, but what early lessons should investors be drawing? Should hedge funds, regulators be drawing from the past 7 days?
I mean, there are tons. The first one, which is probably obvious and should have been to anyone thinking about investing in GameStop, is the music was going to stop there sooner or later, and it's almost always sooner than later. So it's no surprise that it's falling back down to earth. I feel bad for the people. You see a lot of articles about the guy who made $1 million in it. Feel bad for all the people who are losing a lot of money in the late going. The second thing that has to happen is the SEC has to demand that hedge funds declare what their short positions are. They have to talk about they have to announce what their long positions are, but they can be short. They can be on the short side very quietly, and that causes all sorts of problems. They write these articles or quote unquote research reports that don't announce that they're short the position and make it look like it's independent research on the company, and it causes all sorts of problems. And it's probably caused some of the problems here. And I think thirdly, the issue for Robinhood is, and that was always an issue, and I told one of their lead investors several years ago, if you're selling mispriced risk out the back door with a sign on the front door that says free trades, you're going to get into trouble sooner or later. They were always opaque about their business model. And when it caused problems for them, people created all sorts of conspiracy theories, and they weren't clear with their users what the actual problem was, that they were under-collateralized. Under-collateralized, that's a hard word. It's the roosters, the chickens have all come home to roost now.
Right. That said, it doesn't sound like you think Robinhood is facing some sort of existential moment.
I think it was just it was a failure of strategy and then an even bigger failure of communications. But I think the company will recover from it. They just have to stop. They keep sort of shooting from the hip. They did this bank, created the bank. Hey, we're a bank a couple of years ago, and 2 days later found out there are all sorts of regulations about creating a bank you should have considered. And now they sort of make the communications announcement in a rush instead of seeing if they could go out and sort of raise very short-term financing from a bunch of their investors to collateralize the trades. And they just need to stop shooting from the hip. I think if they learn that lesson, they'll recover, and they have a lot of users who still love them and use them regularly. And I think they will be able to go public later in the year. In the short term, they're going to face a lot of regulatory questions, and they've lost a bunch of goodwill of their customers. That's recoverable, but you got to stop shooting from the hip.
Hey, Dick, it's John Fort. Now, I'm looking at GameStop trading now. I want to note it's been down before. It could go back up to 300. Yep. It could drop down to $10. I mean, there are a lot of things that could happen here. I want to talk about the retail investor in all of this, though, because I think, unfortunately and wrongly, this has been set up as a thing of the retail investor versus the hedge funds. If you want GameStop to go up, then you're for the retail investor. You know, if you say anything bad about GameStop and its valuation, then you're in favor of the hedge funds. Look, there's a fair value for GameStop, and it's probably lower even than $100 a share, the way people usually value stocks, because it hasn't been growing and its business model is a thing of the past. What's the retail investor to take away from this volatility that we've seen in this and other stocks, and what it means for trading going forward?
The retail investor should take away that when people start to pile into these ideas, it's the early people in who are going to make a bunch of money, and everybody who's late to the game is going to get jammed. And that's exactly what's happening. You know, the early people were able to execute this short squeeze against the hedge funds. Well, a bunch of the retail investors are getting squeezed on the long side now and watching their investment when they piled in at 350 and so forth. You know, they're getting jammed, and they're going to have to, you know, either cut their losses here. It's not going to be the case that these things can just continue on for weeks. I think what will happen in the future is they will last for even a shorter period of time, because people will learn the lesson, like, I got to get in and get out right away. So I think this is probably a 1 or 2 time thing, and people will, you know, unfortunately learn the lesson, and they'll learn the lesson because they got jammed. I will go back to one of the things Deirdre said about fintech, which is I don't think this is going to hurt fintech valuations overall. The fintech space has been consistently underappreciated and undervalued. I mean, look at when Square went public, its valuation was, you know, orders of magnitude lower than it is today. When Bill.com went public, it came out at $2 billion. We have investments at O1 Advisors in Tipalti, a global payments and payables company, and Spot On, a point of sale company, who have seen a tremendous acceleration even during COVID. And, you know, Spot On is a small business and restaurant point of sale company. You would think they would have gotten jammed by and really squeezed by the pandemic. It's accelerated. So I think these fintech investments, because of the total addressable market, can be much bigger than anyone thinks.
Right. And Dick, I do want to challenge you on that, because I tend to believe they've been seen as technology first, financial services second. Now, perhaps investors, perhaps they could be reassessing that. But hold on, because I can't stop looking at this Reddit AMA with Marc Cuban. Carl mentioned it at the top. But, you know, he's answering questions, and he says regarding GameStop, if you can afford to hold the stock, you hold. Why? Because when Robinhood and other online brokers open it back up to buyers, then we will see what Wall Street Bets is really made of. He's also saying that Robinhood basically created this dive, calling it the Robinhood dive. I just wonder, what do you make of all of this? It seems that he's sort of igniting more to this trade and sort of fueling the Wall Street Bets group to, you know, keep buying GameStop, even as we see it plunge below $100.
Yeah, well, Marc Cuban owns the Dallas Mavericks, so it's easy for him to play Russian roulette with your money. That's my comment on that. You know, I just think, like, it's easy for people like that to sit back and go, "Hey, hang on, you know, it's going to be. Don't worry, the water's fine. It's going to be. We're all good." You know, it's easy to do that when you own an NBA basketball team.
So do you think he's being sort of irresponsible here by telling all these retail investors?
Yes, I do. You know, it's not. No one's investing here based on the fundamentals. They're investing based on momentum and whether a bunch of people are going to, you know, follow me. Everybody charge, and you know, if you're the one charging and everyone else takes a step back, you know, you're going to lose even more money. So I don't think that's particularly wise. You know, Marc likes to voice it. Marc has very strong opinions, and a bunch of other people have been on the show in the last few days saying the same thing. And it's, you know, it's the retail investors against the hedge funds. I don't look at it that way. I think a lot of people are going to lose a lot of money that they probably can't afford to lose.
Yeah, we have had a lot of debate on this program recently. Dick, back to your argument that you don't think fintech is overvalued. I hear you, given the digital transformation, but regulatory risk, I mean, we saw what happened with Ant Group in China. It was a $350 billion valuation, knocked down in the last few weeks. What makes you think that the same thing couldn't happen here, particularly as regulators start to get an eye on them? I mean, they are valued so much higher than your traditional banks.
Yeah, you know, you mentioned earlier, like, hey, are these really technology companies? You and I had an argument on the show before about WeWork, and I was like, look, just because you write technology in your S1 100 times doesn't mean you're a tech company, and we all saw what happened there. I do think that most of these fintech companies are tech companies. Stripe, Tipalti, Spot On, Square. These are technology companies. I would separate maybe the stock trading companies out because they're not necessarily the same type of animal. And what I mean by that is these fintech companies like Square and Stripe and Tipalti and Spot On and Toast and on and on and on, they can grow forever. They just have an almost infinite total addressable market, and every customer and every kind of a company in the world that could use them will eventually use them. The free trading apps, there are a bunch of them. They compete with each other now on, I'm not really sure what, on marketing dollars, because they're all down to free trades. And there aren't an infinite number of retail investors who are going to trade stocks all day. So I just think they're two separate things. I think the trading apps are going to get a lot more regulatory attention than the Stripes and Squares and Spot Ons of the world. You know, and look internationally, Adyen, the payments company there in Europe, continues to just grow like a weed. I think these companies consistently come to market publicly, maybe less valued than they should be, because people don't understand how big they can get, and I think that will continue to be the case for a while.
Hey, Dick, finally, when you watch the Reddit community and you see Cubans sort of telling them to hang tough, and then you watch them turn to silver, I just wonder what you make of that. Goldman's got a big note out this morning, which essentially explains why it is physically impossible to corner the market in silver the way I guess you could try to do on a name like GameStop. But does that reflect to you that their aspirations are unreasonably large?
Yeah, I'm not sure I would have pivoted to commodities on day two. I mean, you know, not to make too much light of the situation. Look, first of all, most of the hedge funds are long commodities, you know, as hedges against other things they're doing. So it's not like you're going to squeeze Citadel and Point72 and you know, Melvin Capital out of silver. They're already long silver. So now you're really just, you know, playing, you know, see who's still on the merry-go-round when the music stops, and you're probably got a bunch of people who are already bailing out and knowing that the rest of the people are just going to get, you know, just as out of luck as they did it when they were late to GameStop. So, you know, this is just it's gotten silly. I get the idea behind what the Reddit community was trying to do, but it's sort of gotten silly at this point. They're not really doing or hurting anyone other than the people who are late to the game.
Yeah. Dick, it's a lot to process. Last week has handed us a lot of curveballs. Thanks for helping us understand it a little better. We'll see you soon.
Yeah. All right. We'll see you. Thanks for having me.
Dick Costolo.
Meanwhile, keep your eye on Dell this morning. Upgraded to buy over at Goldman with a price target of $96. It's currently trading at $77. Find out why only on CNBC.com. We're back in just a moment.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
I'm Jemima Bersace, and these are the stories you should be checking out on CNBC.com. As BP posts its first annual loss in a decade, the CEO Bernard Looney tells CNBC there is light at the end of the tunnel after what was a brutal year for the sector. That story's on the website now. U.S. President Joe Biden will push ahead with his $1.9 trillion COVID-19 relief package, rejecting calls for a scaled-down bill after a meeting with Republicans. But the GOP remains optimistic that there's still a way to meet in the middle. Head online for the full story. And China's economic growth is likely to moderate in the next few months, according to Goldman Sachs. It says Chinese policymakers may begin pulling back on stimulus as the country's recovery takes root. Head to CNBC.com for more. And remember, you can follow us on Twitter at CNBCI.
Adam Matheson, Melissa Lee, Kelly Evans. Power Lunch on CNBC.
If you have all this stuff you don't want to be asked about, maybe don't go on a show called All Things Considered. They mean all things. If you don't like questions, I think Fox News has a show called No Things Considered.
GameStop now, they are down about 50% from where they were. They closed yesterday. It's been worse at times in today's trade, down 60% or more. But keep in mind, this is a stock that was in the single digits mere weeks ago, up above 400 a share just days ago. Who knows where it goes from here? That and other meme stocks, one of the stories of the first few weeks of 2021. Squawk Alley will be back in a moment.
Welcome to Three Brothers Bakery.
We have cinnamon, apricot, raspberry.
It's a location that has experienced 4 floods, a fire, a hurricane, and obviously now we're in the pandemic. This is during Hurricane Harvey. The water was like a river.
When you talk about NASDAQ, people don't think about insurance or catastrophe risk, but that's a product they offer. We have 12 companies that build these models. For example, we have Fathom. They are experts in building flood catastrophe models. And we get it through our NASDAQ platform, so insurers would be able to provide the right guidance to Janice and people like her, project forward the risk, and actually use that to advise the policyholder where they buy their house or where they buy the next commercial property.
Now we have this predictive flood modeling that we can go to and find out if it's going to flood there or not. And if it's not, then guess what? We get to sleep easier. We get to go on a vacation. We get to grow.
Can a recovery be equal, green and united?
There is a direct link between vaccine and economic recovery.
The journey seems to be a little bit delayed, but should not be derailed.
We do need some more fiscal stimulus to continue to bridge the gap. There's still an enormous amount of uncertainty.
New targets of climate change is an opportunity for innovation.
That's all coming up on CNBC's virtual Davos debate, Restoring Growth.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Welcome back to Squawk Alley. The major indices are higher. The GameStop trade and some other meme stocks having a hard time. We're joined now by Marc Cuban fresh off of his Ask Me Anything on Reddit. And Marc, I believe you feel that we got some things out of context about what you were saying to the Redditors?
Yeah, I wasn't telling people to buy more at all. In fact, I said, look, you know, any of us who have traded long enough have been through the pain of making mistakes. And you know, the key is to learn your lessons. And if you're going to hold the stock, if you can afford to hold it, you know, I'm not a fan of selling into a diving market. And so I told him if you can afford it, to hold on. But I certainly not encouraging anybody. But, you know, that said, I am a fan of what's going on with WSB, and I like the idea of this collective buying, and I think it could really have an impact on the markets in the future.
GameStop is halted, we want to mention. Marc, here's my concern about some of what I see happening out there, including on Wall Street Bets, is there are people saying, hey, hold the stock. Here's why you should hold the stock. No matter what happens, it's going to go higher. It's not clear who these people are, their real identities, what their track record is, what stake they have in this, whether they're really holding or if they're dumping it. I mean, I'm all for the retail investor in this situation. And so often, Marc, you know this, we see these cycles where the market gets really high valued, retail investors get in, they're trading, maybe even day trading, things go down, then they get disillusioned, they go away. I don't think that's good for retail, and I don't think it's good for the market either.
Yeah, I look at it differently. I think 25 years ago you would have been absolutely right because it was more difficult to acquire information. Now the information is so readily available, and obviously it's supposed to all be public information that we all have access to, and no one's supposed to have an information advantage. And so I think, you know, groups like Wall Street Bets, you know, aggregate that information in some cases, and you can be a smart investor and still be a small retail investor and still, you know, become part of this unwired network that buys together. You know, I get your point that we don't know who's making these recommendations, but you're not looking at one individual or 5 individuals acting as an analyst and trying to give themselves some authority. You're talking about, you know, millions of, not millions, let's just say tens of thousands of people who are posting. And the information on Wall Street Bets is just one source of information. But it's just, you know, kids today, younger generation, look at things differently. And I think what's really altered my perspective on it is what's happened in the crypto market. You know, hodling, hold on for dear life has worked for a period. Maybe you know, Bitcoin, Ethereum, et cetera, will go down again. But at the same time, we're starting to see the evolution of applications on blockchain that are really starting to build marketplaces. And I think younger kids, you know, Gen Z in particular, maybe younger millennials, have a different approach to, you know, how they look at stores of value, how they look at how assets are priced than we looked at traditionally. And let me just add, look, you know, the narratives that we create to sell stocks, price earnings, right, discounted cash flow, those are all subjective. You know, we just have been told by Wall Street that if the lower the price earnings ratio against your growth rate, then that's an indicator that the stock's going to do great things. You know, or Graham and Dodd in terms of asset valuation. And, you know, that doesn't necessarily hold in a digital environment in the same way it did in the past.
So that's really interesting, Marc. By the way, we had a halt on GameStop, limit up, and it's just now resumed, as you can see. So are you saying that the millennial generation and the way in which technology's caught up to trading is going to make Graham Dodd obsolete? I mean, those metrics have lasted for generations for reasons, Marc.
Yeah, they used to trade salt for gold, too. You know, things change. You know, yeah, I'm not necessarily going against Warren Buffett and Graham and Dodd, right? Because, you know, what Warren Buffett can do is actually come in and buy a company, take it private if it was public, and monetize it in a different way. But how people value assets is changing in a low interest rate environment. And, you know, we're looking at stocks because we've seen what's happening in GameStop, and that's, you know, we have that second by second pricing. But look what's happened in other alternative assets. You know, trading cards or digital trading cards or artwork, you know, and we celebrate when somebody that we presume is smart comes in and pays some incredulous amount for a piece of art. You know, we celebrate when, you know, that Michael Jordan rookie card has gone up, you know, 700% in a year or less, and we don't just presume that the people who are buying trading cards are just, dumb investors who don't know what they're doing. In a zero interest rate environment where access to buying assets, trades are going to happen.
Yeah, that was my next question. If it hadn't been for money supply going to the moon and everybody being stuck at home, I mean, those trends are theoretically reversible. Are you saying that the consequences of them in the short term are also reversible or not?
No, I think this is real. I think crypto, Bitcoin and Ethereum are teaching us some really interesting lessons. I posted a poll on Twitter, and I asked, how do you consume your information about stocks and comparable assets, video or by reading? And then I asked, how old are you? Are you 25 and under or 25 and older? And the result was 36% of people consumed their first information via video, and 35% of the people who answered the poll were 25 and under. I see that with my kids. They don't go online to read SEC reports. They watch videos, and that's how they get information. And the point is that, different generations consume information differently, and they also value things differently. Generations now, particularly Gen Z, that has grown up with an iPhone their entire lives, they put a premium on items that are digital. So the idea that a digital trading card or digital artwork could have more value than something tangible in our minds or physical would be inconceivable to many people, yet to Gen Z, that's what makes perfect sense. And so when it comes to stocks, it's the same thing. I don't think they look at them, and I personally never have either. I mean, I've never looked at owning a share of stock that doesn't pay a dividend as the current value, the discounted value of future cash flows. To me, that was always a narrative that brokers use to sell stocks. To me, a share of stock without a dividend is just like a baseball card. It's what someone will pay for it. And I've written blog posts for 15-plus years saying, I always was taught you get long and you get loud, and, you get out there and you create more buyers for your stock, and the stock price goes up. And that's exactly
to buyers. Then we will see what Wall Street Bets is really made of. That's when you get it all to work. But I wonder, Marc, what are you making work here? Because at a certain point here, Wall Street and the funds that were being targeted originally, they can start to benefit from this, because we don't know exactly who's in this trade. And also, if you're encouraging, more trades through Robinhood, isn't that handing more money over to Wall Street because the market makers making money through order flow? So, what is the mission here?
Okay, so a couple points. Right. The other thing that I pointed out is that Robinhood, and I think you read it, Robinhood created a big part of this dive, right? So you had the biggest artificial impact on what happened to the price action in GameStop and some of these other stocks wasn't so much what Wall Street, what the hedge funds did or the small investors did. It's the fact that Robinhood shut them down, and what you shut them down, I call it the Robinhood dive. You took out a lot of natural buyers. And you guys know how the market works. When sellers come in, if there aren't buyers, sellers keep on lowering their price until they find buyers, and the stock goes down. And because Robinhood didn't have enough capital to deal with the amount of margin loans that were being made and the DTC volatility requirements, they had to shut down that natural flow of buyers. That was the only aberrational thing that happened, yet we seem to not be taking that into account. And so what I said was, when they open it back up, first of all, I also said that you shouldn't trade at Robinhood. You need to go find an online broker that has $1 trillion plus, multi-trillion-dollar balance sheet, so that this doesn't happen again, because that was the greatest problem. We don't know what the true demand, we won't know what the true demand for GameStop or AMC and whether Wall Street Bets could truly have had an impact on how we valued this company because of what happened with Robinhood and the other online brokers that shut off buyers, right? Would you guys agree with that?
So
Yep.
Well, so then do you think that Robinhood could have done something differently? I mean,
yes.
They've been out in the media and on Clubhouse saying this was a liquidity issue. But hold on a second. The other brokerages use the same business model, right? Are you saying that they're simply better, but they also had to halt trading in some of these names?
I don't know all the. I couldn't give you a list and the balance sheets of those who did. that shut off. I do know that, at least I was told there were some of the biggest ones that did not shut it down, right? Because they didn't have the balance sheet impact. What Robinhood could have, should have done is say to them, look, guys, we have capital constraints, and, oh, my God, we are getting blown away by all of this. We are going to have to restrict. The SEC should have been out there saying the exact same thing.
Mark, where do you go?
I want to go back to what you were
use a different
saying, Mark.
business model.
Mark, I want to go back to what you were saying about the way companies are valued, because I think that's so important for retail investors. I completely get and embrace what you're saying about digital versus tangible. But when we go to valuations, price to earnings, things like that, that still strikes me as being pretty important, especially in a situation like this, because there's a company.
You know what price earnings ratio is, John? Price earnings ratio is a narrative created to sell stocks. Look at Apple.
Well, but it's also based on the idea that when you're investing, you're buying a share of future profits. I mean, that's
no, you're not.
That's
no,
generally
you're not, John. Maybe back in the day.
What a lot of people are.
No, you're not. Okay, let's talk about that.
So you're saying Apple's worth more than, or it's trading at a valuation, market cap of more than $2 trillion just because it's popular, not because iPhones make a whole lot of money and are really profitable. Like,
well, they go hand
in hand,
you don't think
that narrative underneath, the amount of cash that they have generated, the value of the design and IP, what they're doing with chips, none of that matters. It's just that it's popular.
That's not what I'm saying. That's all part of why people buy it. But what I'm saying is, what do you actually own when you own a share of stock in Apple? Well, Apple pays a dividend in a non-dividend paying share stock. What rights do you have as a shareholder when you own a share of a company that doesn't pay a dividend? If that company has a lot of discounted cash flow, are they actually, and they don't pay dividends, and they're not growing, and they're not investing, maybe they buy some shares of stock back. Maybe they issue more options for their executives. But what do you truly own? There was a point in time, back in the day when you owned a share of stock, you felt like you were an owner of the company. Now they have multiple classes of stock. You don't really own anything. What you own is the right to sell it to somebody else. It is effectively a digital representation of a share of stock that gives you the right to sell it or to buy it from somebody else. And it's
so you're saying that changes in. All right. So you're saying that changes in ownership structure. I mean, you're not no longer a shareholder. You just hold a trading instrument. I mean, that's sort of a dark view of.
It's not a dark view at all. I mean, look, if you go back to my blog post from the early 2000s, I said the exact same thing. Right? I haven't changed my position in all these years. And supply and demand matters. Why do you think that, brokerages have analysts that go out and make calls and go out on CNBC and come on and talk about the calls that they've made and the things that they see happening? They want to create demand. I mean, the reality is they shouldn't. If it was truly about ownership in the company, no analyst should go out there and say anything because you want the stock to stay as low as possible so you can own more. Right? It's
well, I mean, whether you're a Reddit trader or an institutional trader, you crave research, Mark, and that's what the banks sell. That's what analysts sell. There's value in that.
No, I'm not saying there's not value in it, but I'm saying if I'm a client of your research firm and I pay you for it, that's great. But when you go on CNBC and talk up your book, you're saying, okay, I'm creating more demand to create an exit or just to inflate the price. When in reality, if you truly were an owner and you had additional capital, you'd want that price to be as low as possible because you want to own as much of the company as possible. That's what Warren Buffett, that's the Graham and Dodd approach, keep that price down because it's undervalued so I can buy more. But that's not what happens. We go out and we get long and we get loud because everybody wants that price to go up because that gives them an outlet to sell it. And I just don't see any difference between that and what Wall Street Bets is doing. Now, I understand your point that an analyst, may have more training, more background, more, hopefully not more information, but at least be able to share that. And maybe somebody on a message board does not, and maybe they're just lying or pretending or whatever. I get the difference there, but at the same time, the goal is the same, to get long and get loud.
So, Mark, is there a world in which, GameStop can sustain a $20 billion plus valuation. And what is it then? Is it simply a store of value completely removed from fundamentals? Do you think that we're going to see that with some of these other names? And
it really comes down to, look, if somebody like Ryan Cohen, I don't know him at all, has had success with Chewy.com, and he put up a lot of his own money and bought 12, 13% of the company. Now, he's truly an owner. And owning that much stock, he put himself on the board and he put other individuals on the board, and he invested in a company that has about, I don't know, 35% of its sales that are on e-commerce. And so they're doing all they can to get away from being a store-driven.
But Mark, you're talking fundamentals here.
No, I am,
right? You're talking fundamentals,
I'm telling you the difference. No, because you asked me about the future of the company itself, right? And so I told you there was a reason why somebody bought the stock, right, and invested, I don't know how much money that Ryan invested to actually take ownership in the company and to actually influence the operations of the company. That's one type of buyer and owner. That's great. If you can buy enough for the individual trader, it's just about the narrative, right? What's the narrative? Is Ryan doing a great job?
How do you justify that? I guess my original question is, how do you justify a $20 billion plus valuation? You're talking fundamentals, but when you're talking to the Wall Street Bets group, you're saying that it can keep going up and up again. What is that based on?
It's based off of supply and demand, like anything else. If you bring in enough buyers... So then my question,
what is GameStop? What is GameStop? Is it just a store of value at that point?
Yes. Like any non-dividend paying stock, right? Look, the idea of having a $1 trillion market cap in a company would have been laughable 5 years ago, 10 years ago. The idea that a company's market cap would go, $1 trillion company's market cap would increase 50, 60%, or $600 billion and more than, almost any other S&P stock in months would seem incredible. We all would say the fundamentals could never support that, right? It's supply and demand. How many buyers and how much money is chasing? And now, with low interest rates, there's so much money chasing. And this is nothing new, right? It's just nothing new at all. And there was a time when if a company went from $100 million market cap to $700 million market cap because of all the supply and demand, and who knew where the demand came from, it was just, wow, that's crazy, but it is what it is. Now, we're only questioning it because it came from a message board.
No, I'm not questioning it because it came from a message board. I appreciate what they executed in the short squeeze and the foresight it took to recognize kind of the discrepancy there in the degree of short selling that was going on and what was likely to happen. But I want to go back to fundamentals because Apple just had a $111 billion revenue quarter.
Yep.
Right? $111 billion revenues in a quarter. The iPhone margins are amazing. Yep. iPad is surging. They're attempting this vertical effort with chips in Macs, et cetera, et cetera.
Oh, yeah,
long game, long play with Apple. So, I mean, more than $1 trillion market cap on Apple in that sense is not surprising. But it also concerns me that we tend to have these conversations about fundamentals don't matter like they used to and it's a new day when the markets and major indices are at all-time highs. We don't have these conversations when they're at lows. Then it's talk about dividend-paying stocks and fundamentals and a stock picker's market. So it's strange to me, and maybe give me a sense of the context of the time in which you're saying this, that these conversations tend to happen when things are looking pretty peaked and when, the long tail of retail investors are just piling into the market, when in retrospect, there often isn't a lot more upside.
Yeah, that may well be true. You could be exactly right, and this is the exact top. We don't know. But it still comes down to this. What are the ways that you can make money when you own a stock? There's basically two ways. You can get a dividend, or you could sell it.
Or you can sell it to somebody else, yeah. Marc, when you're on Shark Tank and you're listening to a pitch, I mean, you eventually want to see the financials, right? You want to see cash flow. Why is it, I guess, why are equities different?
Well, because one, I get to influence operations. Two, I'm looking to actually be paid.
Well, theoretically, you can do that through proxy.
Well, no, but let me finish, right? I'm looking to when I make an investment on Shark Tank, I'm not looking for an exit, right? I'm looking to make a profit based off of cash flows that they're actually going to pay to me. Notice I've always excluded, in this conversation, I've excluded dividend-paying stocks. Because dividend-paying stocks, look, if Apple with a $100 billion quarter, you want to see them raise their dividend, or continue to invest so that at some point in the future they might raise their dividend. But there's got to be a payback in my mind. So on Shark Tank, that's what I look for. Are they going to be able to write me a check out of their profits every month? And trust me, I've got a lot of companies from Shark Tank that do just that. And we work out deals with the owners, the entrepreneurs that say, entrepreneur, you own 70%, I own 30%. If we make $100,000 in cash flow that we don't need to invest back into the company, you keep 70 of it, I get 30 of it, and we gladly pay our taxes on it. You don't see that when you own a stock in a public company.
Yep. So if we're going to take the bit of our conversation, the practical parts, it sounds like you're saying two things. One is the regulators should have given Robinhood some political cover, yes?
No, I think the regulators should have explained up front what happens when you have your stocks held at a company that doesn't have all that strong a balance sheet relative to the number of customers they have. It's not that Robinhood is a bad company. It's not. It's a great idea. It's a great concept. It's well run. It's a good company. But they're not the first business to have too many customers. And there's other businesses that have gotten crushed because they had too much demand. And that's what happened to Robinhood. And the SEC should have made that clear that was a risk when you are a customer of a brokerage that could find itself undercapitalized if the growth rates are too quick. And the transactions are too high and the margin lows are too high. And so the SEC said nothing. Robinhood effectively said nothing. All those brokerages that are in that position have said nothing. That's a problem, and that's unfair to all those investors who went in not having any clue that their broker might not have the capital to support their transactions. That is the piece that I don't think is being discussed enough, because that impacted the price of the stock, in my opinion only, as much as anything else that's going on.
Marc, you've said, you've given your advice to some of the retail investors that are currently holding GameStop, but I wonder, what do you say to the retail investor who wants to chase the next meme stock? Where do they get in? Is this, is this a practical method to apply to other stocks like this?
I mean, I forget exactly what I wrote, but I answered that exact question. And I said, look, we've all gotten burned. You learn from your mistakes, but the one thing you're going to do is you've got to do the work. You've got to do your research so that you know all you can. And you also got to realize that day trading means all day trading. You have to always be on looking at what's going on. That's what I told him.
How do you do your work? Though? Like, are you not looking at fundamentals because they're getting so detached from that? Like, seriously, what is the practical way to do your homework when looking at these stocks that you're not sure what moved them other than supply and demand?
Okay, so let's look at GameStop. I mean, look, I can make you just as strong an argument that it's very strongly attached to fundamentals, right? So here, I just pulled up their holiday sales report. They did 1.77.
At what valuation?
Well, but let's put that aside for right now. They did $1.7 billion in sales in the fourth quarter, and 34% of that was from e-commerce. So let's just, for easy numbers, they did $600 million in e-commerce in one quarter. So with Ryan Cohen coming in, let's just say that he can continue to increase that. So you have a $2.4 billion going to $3 billion sales company. Are there other e-commerce companies that are valued at 10 times sales? Yeah. Are there other e-commerce companies valued at 20 times sales that are growing like that? Yeah. So the narrative is there. If you want to talk fundamentals, you can create that narrative.
As people still try to do, Marc, I got to tell you, viewers have loved this discussion. We really appreciate you calling in. You always give us something to ponder and think about. Thanks, Marc.
I appreciate it, guys. Thanks.
Marc Cuban. All right, we'll see you later as we watch both GME and the S&P, which has gone to its best one-day gain since November 5th. Squawk Alley's back in a minute.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Siemens Energy has announced it will cut almost 8,000 jobs by 2025 as part of a cost-cutting program. It comes as the German company returned to profit in the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world. It's now always keeping the balance. On the one hand, really driving the growth part, and at the same time improving the areas where we see more challenges in the market, like oil and gas.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Welcome back. Our next guest says the GameStop trade and ensuing Reddit revolution show that retail investors are through letting hedge fund billionaires treat the stock market like their own personal playground. Silicon Valley's Congressman Khanna joins us now, also a member of the Oversight and Reform Committee. Congressman, want to get straight to the reform or change that you think is called for in light of what we've seen here. Is it mainly focused on short selling?
Short selling and more capital requirements. I mean, I listened to your fascinating conversation with Marc Cuban, and what I would say with Robinhood is they should have more capital requirements or more requirements for disclosure and transparency. Either they need to have more capital reserves or they need to tell their retail investors what they're going to do. And then on short selling, we need to have, again, higher capital requirements for getting loans for short selling, and have the uptick rule, which was in place from 1938 to 2007, that basically put restrictions on short selling, reinstate that. There was no reason that should have been removed.
Now, there's more that's come out about exactly why Robinhood did what it did, and you're talking about liquidity here. What do you think the retail investor in this environment deserves, whether it's in terms of the information that they have access to, the protections around trading? I mean, being able to trade on margin, trade options, under what circumstances, et cetera?
Well, they first deserve transparency. I mean, Robinhood didn't have terms of service that said you can trade unless a stock gets too hot, in which case we're not going to be able to cover the capital requirements of clearinghouses. So they need to have transparency. I think if you have higher capital requirements, you would force the model of a Robinhood to be able to trade. And then they need to have symmetry. I think if retail investors aren't being able to trade, you shouldn't be allowed to have hedge funds trade, which have higher collateral often. So there needs to be more independent looking at what symmetry would entail for retail investors and hedge funds.
Congressman, it's Deirdre. Yeah, transparency has been a big topic, you know, whether Robinhood users or customers or the product. I take your point there. I wonder, though, how much is Robinhood itself at fault here? You said you take a look at them and other platforms, but are some of the other platforms better because they rely on a different business model? They don't earn revenue through payment for order flow?
Well, I think the biggest thing Robinhood has been at fault in is a lack of clear honesty. I mean, I saw the CEO on television. He said it's not a liquidity event. And then he said, well, what he meant is it's not a future liquidity event. So they're parsing language. They're not being honest. They should just come out and say, as Cuban was pointing out, they didn't have the money to cover these trades, and they need to revise their business model. The second thing is that the clearinghouses may be at fault, and we need to look at where the clearinghouses are. The clearinghouses have a relationship with the hedge funds. Robinhood obviously sells data to the hedge funds. So the whole thing needs to be looked at is whether there's a level playing field or whether institutional investors have advantages over retail investors, and how do we level that playing field?
Right, sells data to the market makers. Congressman, why did it take this moment, the extraordinary events of the last week or so, to look into how Robinhood is regulated or not regulated, how those stand? Do you think that this will be sort of a moment that regulators look into other fintech companies, many of which have been expanding their financial services, at a faster rate than potentially banks in some cases, and have reached far higher valuations than traditional banks?
It's a funny thing how politics works and public opinion works. Often it takes a galvanizing moment that captures people's imagination and emotions. And here, people are used to hedge funds making tons of money. They're used to folks going on television and talking down stocks and trying to legally manipulate, but nonetheless manipulate the market. And finally, you see folks beat the hedge funds at their own game. And right when they're winning, they are not able to continue trading. And something about that just struck people as fundamentally unfair. It exposed how broken the system is. And that's why I think the whole system is going to be looked at, and we may see finally the reforms that we need.
Congressman, we did a bit earlier this morning about the percentage of stocks that are owned by high net worth individuals in this country, and what a challenge it's been for decades to get more Americans invested. I mean, really invested in the market. I wonder if you think this whole phenomenon and episode is going to make that more challenging long term.
Well, thanks for raising that, because people forget that 50% of the country isn't in the stock market. Most of the assets are held by the top 10 or 15%. So one of the things we have to do is think whether we have an over-financialization of the economy. How are we going to get more productive investments into advanced manufacturing, into things that are actually going to create good-paying jobs and not just speculation? Now, I don't think that the market is totally divorced from fundamentals. I mean, I represent a district with Apple computers, and people are placing a bet on the future digitization of the economy. You can question whether that's right, but I don't think fundamentals have no place in these bets. But I do think that there is an element of speculation that has obscured the fundamentals and that has made the economy work for very few while not having wages rise.
Right, Congressman, you bring up a good point there. I mean, having more participants in the market, I think many agree, is a good thing. But, lawmakers and regulators are walking this fine line here in, trying to create safer environments, but not angering the retail investor as well. So how do you think of that balance and the moment that we're in right now, where it seems to be, retail investors versus the establishment?
Well, I think you put more of the burdens on the institutional investors and on platforms like Robinhood. Make sure that you're increasing the collateral requirements. Make sure you're making it harder for hedge funds to short stocks. And you can have higher capital and regulatory requirements on them. Will some of that eventually make it a little bit harder for retail investors to trade? I'm sure that's the case, but that would be a better situation than what we have now, where the retail investors are at a real systematic disadvantage to the institutional investors.
And Congressman, we keep using this term retail investors, but largely we're talking about traders. We're talking about day traders, and that's a very, very small segment of the overall population, much of which is, many would argue, underbanked, underinvested. What sorts of incentives, disincentives do you think either should be set up or should be put in place? Maybe you think everything's great as it is to encourage equity participation in a healthy way.
That's a great point. The Redditors, I mean, some of them were ordinary individuals, but a number of them were either day traders or there are even reports that some may be hedge funds on the other side. So the story is much more complex. I believe what we need to do is have government, private sector partnerships to reindustrialize America. I propose the Federal Financing Bank at Treasury should be providing loans to companies to build electric vehicle plants, solar plants, to build the new industries of the future, and then have more people participate in those companies' employees and giving them stock and equity so that you actually have workers participating in economic growth. We have an economy right now that's really not creating jobs in the same way as industrialization did, and I believe has been over-financialized. And that, to me, is the whole lesson of this saga.
All right, Congressman Khanna, thank you so much for joining us.
Thanks for having me.
Well, amidst all of this, the earnings rush does continue after the bell today. For big tech, both Amazon and Alphabet set to report. We are back after just a quick break. Stay with us.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
This budget is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5. Can translate into between 5.5% to 6% of GDP just from the infrastructure. This would be, of course, adding to the V-shaped recovery. The healthcare spending that's actually a signature moment in India's history in terms of the emphasis on healthcare.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Guys, great show. Our thanks to Marc Cuban and Dick Costolo for adding to the discussion today. There's a look at GameStop. Fifth halt of the day, I think, at 11:56, and we'll see how that continues to work itself out. Obviously, it got to a low of 74.22 as some of that trade did unwind and then managed to rebound. Don't forget tonight, Amazon and Alphabet currently trading up 1% to 2%, I believe. And before we move on to tomorrow, with other big names like PayPal and Spotify. Let's get to the judge.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the two tech giants reporting after the bell and what Amazon and Alphabet's results mean to the FANG trade and, of course, the overall market. We discuss and we debate that with our investment committee. Joining me for the hour today are Stephanie Link, Josh Brown, Jim Lebenthal. Diggis Wright is the Chief Investment Officer of Decatur Capital Management. I'll take you to the wall. I'll show you where stocks are trading today. Yes, they are ripping higher. There's obviously a lot of focus on tech. The Dow's having its best day since November. It's the best two-day gain for the S&P since that same time period. There's your picture. A better than 600-point gain for the Dow Jones Industrial Average. We'll call that 2%. S&P's about 1 3/4. There's the NASDAQ. And to the far right, the Russell 2000 having a pretty strong day, too, albeit not quite as the other three major averages. All right, Josh, we got a pretty good setup because I told you yesterday that Mike Wilson had come out and saying the correction had arrived and it's going to get worse. Well, Tom Lee is out and said, no, the correction ended on Friday. And now we're building on a couple of good days. So what does that mean for how our viewers should take a look at where this market is?
I think you watch tech and you watch financials. And the good news is financials are up 2.5%, had a little bit of a shakeout. They fell about 8% during that correction, but now they're rocking and rolling again. They're very important stocks. And then I think you watch tech because of how large they are in the index weighting. And the XLK is a hair away from yet more all-time highs, and not unjustified. Phenomenal earnings across the board, and we'll get more this week. So that's what I would be keeping an eye on. And look, you just had the biggest VIX spike ever in the absence of a 5% or higher pullback for the market. In other words, normally when you get a VIX spike to the extent that we saw last week, that's accompanied by more than 5 or even 10% of a drawdown in the market. You just didn't have it. So what does that tell you? That does not tell you we're at a peak or we're at complacency. It's the opposite. Everyone is still scared to death, and that's the kind of condition that you want to be in if you're going to bust through and have another leg higher to the bull market. So the sideshows are now fading away. Responsible adults who have been allocating to their accounts, responsible young people who have been adding to their retirement accounts are being rewarded for having had the fortitude to live through that volatility. And you've got earnings growth ahead of you. You've got the reopening. The vaccines are becoming less cartoonishly embarrassing in terms of distribution. We're actually getting needles into people's arms, and things are looking pretty okay going into the spring, and I think that's where we stand right now.
I'm glad you set it up that way. It really does go line by line, Steph, through what the current state of play is. And part of Tom Lee's thesis on why he says the correction ended on Friday is exactly the VIX and the way that the VIX is now reacting. Yes, it got a touch above 30. Now it's mid-20s. You know, he's always maintained
37.
that the VIX is the place to watch the most because, 37, sorry. Because if you have a VIX under 20 or low 20s, that's as much of a buy signal, Steph, as anything else. And also to Josh's point, that's why there's so much focus on these tech earnings, which are coming after the bell today. Amazon and Alphabet following what Apple and Facebook delivered last week. Those earnings reports remain critically important for the overall market because, as Josh said, the size of tech as it represents in the overall S&P.
So I know you're looking at the VIX, and I am too, but I'm also looking at the 10-year. And we talked last week very briefly when the short selling covering started happening in GameStop and AMC, etc. I was worried because it seemed to have a contagion effect where obviously we had a lot of people selling their winners to cover their shorts, but then also we had the 10-year fall below 1%. And that was the thing that got me a little concerned. So I am actually very relieved. The VIX has come down, sure, but that the 10-year now is at 109. Look, we had a 75% pullback. We had a 75% gain in the markets from the March lows. And so we were due for a pullback for sure. So it's healthy, and I'm looking at earnings. And so far, we've seen 80% beat rate. And we still have a long way to go, but stocks follow profits, and profits are going higher. And I think, sure, we can have some corrections along the way, but I think that if profits are going higher, that's a good sign.
Yeah. Diggis, where are we? Do we have to worry about a correction that still has more pain, as Mike Wilson says, or can we take relief in Tom Lee's thought today that the correction, it came, it went, and now we're back to focusing on the vaccine, and the virus trends are moving in the right direction, and we're thinking about the reopen, and you can even see it in the market today, which I'll get to some of those names after you give me your answer.
Yeah, so Scott, so ultimately, what we see is that the markets will end the year higher. However, we still will have some choppy markets. So I would say that the first half of this year through June, we may look for additional pullback. And we're looking at, right now we're around 3,700 on the S&P. We could see that pull back to about 3,500, but we feel that by the end of the year, we're going to finish probably north of 4,000. So what we're seeing is that choppiness going forward. But this is still a good time to get into the market because we're definitely long-term investors.
Yeah, Jim, 600 beans today on the Dow, at least, you know, right at this moment. A lot, as I said, of those recovery plays are working today, whether it's Disney, which is, and at least it was, you know, the best performer in the Dow, whether it still is now, I'm not exactly sure because I don't have the whole list in front of me, but it's a Visa, it's an American Express, it's an MGM, it's some of those sort of reopening plays that are getting a lot of wind today. And, you know, you own some of these stocks that I'm talking about right now. And there's a look on our screen here, whether it's Disney or CAT up 4%. I know you don't own CAT anymore, but there's AXP, Las Vegas Sands. Oil is above 55 for the first time in a year. This is where the action is today, Jim.
Yeah, I mean, there's a lot to sink your teeth into. That was a pretty long list. I think I'll just start with oil. You know, Marathon Petroleum reported today. Pretty good number, pretty good guidance going forward. And apropos of what you're saying about that's where the action is, the stock is up nicely. So I like that. By no means do I think large cap tech is dead. By no means. I did say, I think it was last week with you, Scott, that I thought it would not be the leader this year. And I'm going to stick with that, okay? I think the cyclicals, whether it's financials that Josh is pointing to or energy that I'm pointing to, I think for this year they can outperform big tech. But big tech is going to do just fine. You look at the valuations on an Apple or a Google and you say these are not nosebleed territories. These are not the areas of the markets to worry about. I do want to say one thing because we've been talking about a correction here. It's not clear cut whether the correction is over or just starting. The rub against the correction idea is how cheap interest rates are and how the money will flood in. On that basis, it's possible that Friday was the low. So I bought a little bit today. I nibbled on some stocks. I still have plenty of cash, but I didn't want to have as much cash.
One of the reasons, Jim, why you know, Mike Wilson says, well, the correction's not over yet, because he's not convinced, at least it appears that way from his research, that the de-risking and deleveraging of hedge funds, which has been going on through this story that we've all been covering, he's not convinced that it's over. And as long as you still have that possibility of degrossing from large hedge funds, you still have the possibility of more weakness in the market. Do you buy that?
I think that's a legitimate argument. It makes me wonder if that's what Apple did when it went from 145 to 131 in the space of a couple of days. But, you know, when you think of the dollar volume, the actual market cap that was lost in that move, you know, it pretty much accounts for a lot of the short sellers' losses. I think we may be through the bulk of that. That argument, to me, it doesn't make me feel like we've got a lot of downside ahead of us.
Yeah. Let me go to Meg Terrell. She has some breaking news regarding Pfizer for us, and I'll get back to our conversation. Hi, Meg.
Hey, Scott. I just got off the phone with Pfizer CEO Albert Bourla, as well as Michael Dolson, the chief of R&D, and Frank D'Amelio, the chief financial officer. And, you know, we've been talking a lot about whether we're going to need booster shots of COVID-19 vaccines because of these variants. And we know that Moderna is already developing a new construct against the B1351 variant associated with South Africa. Now, Pfizer telling me that they expect that their original vaccine should provide enough immunity against those variants. They are planning to test booster shots of their COVID-19 vaccine, as well as constantly developing new constructs of COVID vaccines in case they are needed. And in particular, they are looking at the South African and Brazilian variants, which are troublesome, and potentially trying to combine some shared sort of pieces of those variants in a construct that they could test against their original COVID-19 vaccine as a booster. But this is something they are constantly looking at, and they said they want to be in a position to be able to act within 100 days on a new variant if it's needed, but they don't want to develop develop a new vaccine if it's not needed and then take some of that manufacturing capacity. One other thing to note from that conversation, they are also developing antiviral drugs against COVID-19. These have flown under the radar, but they said an oral version, a pill, they expect to have in a pivotal trial starting in April, guys. So this could provide another tool alongside vaccines during this pandemic. Scott?
And Meg, I take this, and I'm not looking at the stock price for any validation of any point of view, because it's hard to read a moment-by-moment thing on something like Pfizer or Moderna or anything else. This sounds to me net really good news. Is that how you're taking it as well?
Well, it depends on for whom you're talking about. But, you know, Pfizer down, interestingly, 2.3%. I think a lot of people thought their guidance for this year was a bit light. You know, they forecast $15 billion in sales just this year from their COVID vaccine. A lot of people think that that is very conservative just based on the contracted doses, which is less than half of their capacity. So the $15 billion could really be a lot more for Pfizer. But in terms of them thinking that their current vaccine works against these scary variants, that's good for everybody.
Well, that's what I'm saying. I'm talking about greater civilization. The investor and the stock price at this very moment is taking a backseat. I'm thinking that this is good news that Pfizer has told you, that Mr. Bourla and the other person that you said you spoke with had told you that it's not like they are rushing to have to retool or remake a vaccine because they think that what they've done so far has the efficacy to deal with these new variants. That's the greater takeaway, and maybe the greatest, of the news that you just brought us.
Yes, that's a great summary, Scott. And I will just note, though, they do think boosters are probably going to be needed to increase the antibody level. Whether it's of the original vaccine or something they have to make in the future is an open question. But we probably are in for recurring COVID shots, just like we get flu shots every year.
Yep. I think we're starting to get around, getting our minds around that as well. Meg, thank you as always. Meg Terrell with the latest regarding Pfizer. There. Digas, I'll get a comment from you, considering you're the only one on the panel, I believe, today who actually owns Pfizer shares. Just, you don't have to, you can react to the news that Meg delivered to us, but people are focusing on how much money these companies are going to make as a result of all of this. Your thoughts?
Yeah, so well, first of all, we looked at Pfizer. Pfizer has actually not performed as well as you would have thought given the last 12 months, given that they're leading in the vaccine and actually delivering vaccine. So what we're looking at is that it actually has some very positive outlook going forward for Pfizer. We look at the profitability, and the profitability, if you measure that by return on invested capital, it is at what we call the 90th percentile. What we do for every stock is that we don't just look at intrinsic value, we look at a relative valuation and a relative positioning on profitability. Once again, 90th percentile. And then we will look at valuation, which is somewhat of a different look. Like I said before, we look at a relative valuation, and we're seeing that Pfizer is at the 90th percentile, which means for us that there's a lot of upside potential in the valuation and the pricing of Pfizer at these levels. So we believe that the company is definitely undervalued, and obviously the news that we just heard just makes it even better case for forward expectations.
Yeah. I was just noticing as well, I'm looking at the market overall. Looks like we're at the highs of the day. Dow's up 625. Again, best day for the Dow since November. Best couple of days for the S&P. For that same period, we're above 2%, 628 points for the Dow. All right, Josh, set the stage then for me. Given all that we've just talked about, your expectations for technology, how you think it's the most important place to look right now. Amazon and Alphabet. You've already maintained that you think Alphabet is going to be the #1 FANG stock this year because of its reopening play. You own both. Tell me, what's on the line tonight?
Yeah, and they're both up today. And I think a really interesting thing that's taken place over the last few weeks is that we've dismantled that kind of risk on, risk off, or vaccine on, vaccine off mentality amongst traders. It's not working anymore. Like, take a look at today. You have Amazon up, which is clearly not a reopened stock, but Starbucks is up, and that is. And you go down the list. PayPal's having a good day, but so is Live Nation. And obviously, these things have nothing to do with each other. So I know there were people talking about coming out with these ETFs or these trading strategies where when the virus news is bad, they buy the stay-at-home stocks. And All that stupidity is over with. Nobody's doing that anymore. And thank God, because I hated it so much. So now what you're seeing is leading stocks in each sector having their time in the sun. You have energy stocks working at the same time that payment stocks are working, at the same time that concert and resort hotel stocks are working. And they're working because if you're in the stay-at-home bucket, Scott, like Amazon is, the fact that we're all coming out of our houses this spring to do things live and in person doesn't change the fact that everyone has now adopted a lot of digital stuff and they won't yet give it up. So the hybrid thing is really the theme of this year. And we're going to keep DocuSign. We're not going to throw that out. We're going to keep paying people with Venmo. We're not going to throw that out, but we are going to reopen. So I think that leaves a lot of opportunity for people to own stocks in both camps and forget about that game. I think Amazon, if I were an analyst tonight, I would ask about how the comps are going to be going up against the pandemic months, right? Because obviously e-commerce just went bananas, especially categories like grocery. Those will be tough comps when we're lapping them to go up against. That might be an area where maybe people get concerned. But then you think about Alphabet. Think about all the travel-related searches that now manifest themselves as actual booked trips. Travel is a huge category for search engine advertising revenue. So I think there's a lot to like across the board. And generally speaking, when you have green in every sector, it's really hard to come up with reasons to be bearish.
You know, Steph, one of the issues, and you pointed out well in your note today, and I think we got a little whiff of this last week with Apple and Facebook. Yes, you own Alphabet. Yes, you own Amazon. In terms of Alphabet, you say you're a little nervous. The stock's up 10% going into the print. We learned the hard way when you have a nice run into the print, despite the strength of the print itself, a stock can trade lower on the news.
Absolutely. I do think it's going to be a very strong report, but yeah, the expectations are really high. That said, Scott, this stock still trades pretty cheaply on 2022 numbers, 23 times earnings on 2022 numbers, 10 times EV to EBITDA for a CAGR of 16%. So, I mean, you have a very strong franchise. This quarter is all about the recovery in digital advertising, and we have already seen that happen in the third quarter relative to the second quarter, and I expect it to continue going forward. For Amazon, so I like it. I just, you know, if it's weak, I probably would be buying more. Amazon, I think, look, we all know how strong e-commerce growth is, but retail online sales in the U.S. is actually only 20% penetrated. And then you have AWS, and we saw Azure with Microsoft growing 48%. Maybe AWS grows about 30%. They're much bigger, and that would be an acceptable number. And only 15% of the workloads are in the cloud. So there's still such tailwinds for this company, even though it is pricey. We can do the sum of the parts kind of an analysis kind of thing. But I do like both of these names. I would look for opportunities to be buying both of these names. We'll see what the action is. And to Josh's point back on Amazon and the guidance and just the comps, they have very tough comps on the revenue line, but they have very easy comps on the operating margin line. Remember a quarter ago, last year, the first quarter, the margins fell 210 basis points, and that is because they are heavily investing. And then the heavily investing theme starts to die down as you reopen. So we may have pretty good setup going forward for Amazon. We'll have to see.
You know, Jim, Deutsche Bank today, as it relates to Alphabet, reiterates their buy rating. They think you can get almost another 20% out of this stock. 22.50 is their target. They say it's their top pick in all of internet. You own it as well, and it was the laggard, well documented last year, but now it's one of the leaders going into the number. How does all that factor together?
Well, a good question, Scott, and it wasn't just last year. If you take a look at the last 3 years, it's lagged the rest of the FANG brethren. In fact, compare 3 years of Google to Apple, and you'll see Apple's had almost three times the total return. So it's not just last year, and that means there's more catch-up to go. The valuation is attractive, but here's what I think is the most important thing, is Google Cloud. I don't think people that I talk to in the investment management world are paying that much attention to Google Cloud. It is a a small but rapidly growing portion of their business, and you only need to look at Amazon Web Services and Microsoft Azure to see how important it could be to Google. I think that's what the growth driver is going forward, even though search and YouTube are going to be just fine. So if Google sells off today, that's a buying opportunity.
You know what, Degas, you think that Alphabet is a little overvalued where it is now. You suggest that you wouldn't be buying shares right here, despite that bullish call that I just read you with a $2,250 price target.
Right, exactly. So we see it as overvalued. When we look at a percentile basis with the tech companies, we see that right now Alphabet is on that overvalued side. So we would see other opportunities in the tech space that we would probably put new capital to work outside of the Alphabet. We're still whole Alphabet, but we would not be putting new money to work in it.
Yeah, what about Amazon, which you own as well?
Right. Amazon is the same thing. Amazon is, once again, slightly overvalued, but we really like the profitability. If you look at Amazon, you're seeing that it came in at a very strong, approximately $12 in this last report, $12 per share, compared to the Wall Street analysts saying $7. I mean, that is significant, 70% surprise. And everybody is looking at Amazon, so it's very hard to surprise that positively. So we really like the Amazon platform, and we think that's a good stock. Once again, it's starting to get a little bit above that fair value that we like to buy at. So we would not be new buyers, but we are definitely holding the company at these levels.
Let me run through a few moves that all of you are making too, which I find interesting today. Josh, I begin with you. New buys today of the SLV and Pan American Silver. That's PAAS. Talk me through that. Is that trying to ride a momentum wave from the obvious reasons why we've seen silver go up?
Yeah, it's not a new buy today. It's from last week. I'm just making memes, having fun. I don't really, I don't get religious with precious metal stuff. I laugh at the people that do, sometimes to their face on the show. So I think these are trades. I think silver, though, when I look at gold having gotten back up to its prior highs in nominal terms last year, and silver hasn't. And I find that to be a really interesting setup in silver. And then the other thing about silver, which I don't think a lot of people really understand that well, is the fact that, unlike gold, it does have significant industrial usage. Probably about half the demand for silver is not coming from jewelry or people hoarding coins. It's literally coming from the electric vehicle industry and from the solar industry. Silver is a very important component to some of the hottest technology sectors in the market, some of the hottest industrial uses. So you had a huge run in copper and nickel and lead and all of these industrial commodities. Gold did its thing last year, peaked sometime in August. Silver really hasn't gotten up off the mat until recently. So I like it for that reason. I bought SLV. Pan American Silver is just like another add-on, a sidecar, if you will. But that is one of the larger publicly traded silver miners. To be very clear, though, anything commodity related to me is never a long-term investment. It's always a trade. And I don't, you know, we don't love these mining stocks. You know what I'm saying? Like, they're not well-run companies. Go.
I just want to be real clear to make sure I understand exactly where you're coming from. Since you bought it last week, did you buy it in anticipation of the Reddit-induced run-up? And now you're holding it because of the fundamental investment reasons that you're talking about, or one was completely unrelated to the other?
No, actually, if you go on my blog, I posted the case for silver, the fundamental case. It's funny. Well, Jeff, it's funny that they got caught up in the memeology. I don't care about that. I'm not one of these guys going on TV and going on Twitter egging on short squeeze stuff to get likes. That's not my game. Like, I have regarded this whole situation as, let's hope the kids make money, but let's hope they do it in a way that they're not risking money they need, like for food and medicine, right? Like, I'm on the side of the kids, but I'm not out here like telling them hold the line. I'm not Ja Rule. So let's be very clear. So I own Barrick Gold, GOLD. I'm down in it, but that's like a precious metal stock I own. I bought it after Buffett bought it. So I own a little bit of silver. I think there's a fundamental case based on the usage of silver in a lot of the new technology areas that people are spending a lot of money on this year. So maybe it'll work, but I'm not diamond hands. You know what I'm saying?
No, it's not. I'm glad you explained it. And look, I mean, you're not the only one who looks at silver removed from the current situation and has a fundamental story to tell. Goldman's head of commodities research, Jeffrey Curry, who is going to come on our program on Thursday and talk about it, today says that it's his preferred metal in the space. And he's got a price target of $30 to $33. He thinks that a short squeeze is unattainable because there's enough physical supply. So I'm glad you talked through it. It is backed up by a view of others who know the space quite well that silver can continue to rise completely removed from the current situation. Jim, let me go to you. You added to Salesforce. You added to Visa, which I mentioned earlier today was one of those recovery and reopen benefactors today.
Yeah, I had a light commitment to both of these stocks, Scott. I added them to the portfolio a couple of months ago, and they're small, so they haven't moved anywhere. Even though the market's gone up, they really haven't moved anywhere. So if I liked them 2 months ago, I like them now, and it's just time to build out the position. But to be clear, this is more of a feeling I had too much cash on hand. Where was I going to put it? I still have about 13% cash in managed portfolios, which is a lot. That's dry powder for any correction that may continue to occur.
Okay, we'll bounce for a couple. We'll come back and we will look ahead. Jim Cramer's out with an interesting list of stocks you need to know about. We want to take a look at those if we do get a larger market pullback, as some suggest. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. We are back on the half right after this.
Money can be a force for good, which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost our planet. Standard Chartered, here for good.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch on CNBC.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at sort of 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
Courtney Reagan, and here's your CNBC News update at this hour. Near Fort Lauderdale, Florida, the FBI says 2 of its agents have been shot dead and 3 others wounded while serving a search warrant involving violent crimes against children. The suspect is also reported dead. In Oklahoma, police are investigating the shooting deaths of 5 children and a man, and a woman has been hospitalized with life-threatening injuries. A suspect has been arrested after leading police on a brief chase. State Department officials are calling the detention of Myanmar's elected officials a coup. They are promising sanctions and other measures against the generals who are responsible. And in Britain, Sir Captain Tom Moore, the 100-year-old World War II veteran who raised millions in the pandemic aid, has died. Moore recently tested positive for COVID-19 and was hospitalized with breathing troubles on Sunday. Scott, back over to you.
Yeah, that's so heartbreaking. It so much is. Courtney, thank you. Courtney Reagan with the latest there. Thanks. All right, we'll make a turn after that unfortunate and super sad story, Degas. I want to talk to you about the moves that you've made. I went through the others. You sold Paychex and you bought Quanta and ACOM. Talk to me.
Yeah, so basically, when we started looking at the portfolio, we saw that we had some exposure, obviously, to industrial services, and we wanted to really make a move towards the infrastructure and sustainability. So first of all, Quanta. Quanta is actually involved in the distribution and transmission of electricity. We're seeing that they have just completed a major project in Australia that they put in a very large windmill to generate electricity. Also, we like the fact that they are one of the few companies that have invested in a college that's focused on this type of work. And so that's something else that's very positive. And what we really like is the backlog. They have a $15 billion backlog into 2021, and that's going to do them very well. Likewise, ACOM. ACOM is a engineering construction management firm, and what they've done is that they've actually increased their profitability by focusing on the high profit margins in this particular space. And they do a lot of work with the cities, working with them on sustainability and other issues. And once again, now their backlog is over $41 billion in 2021. So they have a very large backlog, 13% gain over last year. So once again, they're doing a lot of work in the sustainability area, and we think these are 2 good companies that will benefit from any investment in infrastructure going forward.
All right, I mentioned Jim Cramer's out with a list of some stocks to take a look at if we do get another sell-off. I've picked 3 of them just to do that because, you know, I tried to look for ownership and names that we haven't talked about either today or most recently. Steph, Lam Research is on the list. You own it.
I do own it. And, you know, it's down 12% from its highs this year. It was up 20% to the start of the year. And a lot of that is because you're seeing a recovery or an anticipated recovery in DRAM. We've already seen NAND spend be very strong, and that continues. So they beat, they raised, they're gaining market share. They had strong wafer fab equipment sales, and you have tight supply. So you're going to get better pricing and better margins. So I like this story, especially down 12% from its highs.
Yeah, look at it off its low, up 180%. Josh Brown, CrowdStrike on the list from Cyber, along with Palo Alto, Zscaler, and Okta. Go to you because you own CrowdStrike, at least the last I checked you did.
Yeah, that's a list of like very high growth, very high valuation names, many of them overlapping businesses. I don't know that you want to own all of them because there's going to be very high beta in these stocks. There are going to be huge drawdowns along the way. That's just how it goes when you're trying to invest in innovation. But CrowdStrike is my favorite of that group. It's a stock that I actually spent last year averaging up in, which I very rarely do. But I'm in there. I think the company has a really bright future. I think what they do is very unique from other cybersecurity players, and they seem to be capturing the largest companies and governments as clients in the world. They seem to have all the swag right now. So I'm long CrowdStrike. I believe in it. I know it's not cheap, but I think it's not cheap for a reason.
Yeah, good day for that stock for certain. Lastly, Farmer Jim, to you, NXP for 5G.
Oh man,
says Jim Cramer.
Yeah, at this stock, I mean, we can all talk about how much easier this stock is than Intel. And I know Steph feels the same way. Making that switch was one of the best things that ever happened to me. The stock is fabulous. It's heavily exposed to automotive shares. And we know automotive is going well. I mean, you look at GM, you look at any of the other parts manufacturers. This is the one to be in, and it's not just automotive. This was takeover bait about 4 years ago, and I think it will be again in a heavily consolidating space.
I wasn't going to rub it in either about Intel at all. I'm glad you brought that up yourself and noted the benefits of that trade.
I love life right now.
Yeah, I was looking out for you.
I love life right now, Scotty.
Let me get to Eamon Javers has some breaking news for us. Let me jump down to him, if I may. Eamon?
Yeah, Scott, that's right. We're now getting the response from former President Trump to the impeachment article against him ahead of what is expected to be a trial in the Senate on his impeachment by the House of Representatives about his role in the January 6th storming of the Capitol, violence, riots, and deaths that we saw on that date. What Trump is arguing here through his lawyers is two things. One, essentially that he can't be tried on this by the Senate because he is no longer president of the United States. This is a constitutional argument that Trump is putting forward through his lawyers, suggesting that the impeachment process as envisioned in the Constitution does not apply to former presidents, and because he was impeached while president but is a former president now, this whole process is effectively moot. The second thing that Trump is arguing here is he says ultimately the president believes as a private citizen the Senate has no jurisdiction over his ability to hold office in the future. So he's saying that not only can he not be removed from office because he's president, but the Senate can't block him from holding office in the future. The former president here denying that he did anything to incite the rioters, arguing that he simply took advantage of his First Amendment rights as any American citizen could do. All of this now following the House impeachment managers laying out their case against the president, suggesting that the Constitution does allow for the president to be blocked from former office. Their argument is that because there's a two-step process in the Constitution, one is impeachment, and if convicted in the Senate, a removal, and a second process in the Senate for a second vote to determine whether that official should be blocked from future office, that because the official is removed by the Senate and then there's a vote on that now former official, whether that official can hold office in the future, therefore, this is a constitutional process as envisioned by the United States Constitution. So clearly, we're going to have some constitutional arguments in this process, and we're also going to have some arguments about what degree of responsibility the former president bears for the attack on the Capitol. Scott, back over to you.
To be continued there for certain. Eamon, thank you so much. Eamon Javers, very latest for us on that story. Up next, Brandon Copeland is back, linebacker for the Patriots, as you know, also a member of CNBC's Financial Wellness Council. We'll get his thoughts on closing the racial wealth gap, being a champion for financial literacy, and more. I'll ask him a question about the Super Bowl, of course. We'll do that next.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcasts or your favorite podcasting app and subscribe to the Halftime Pod today.
why this NFL player decides to take his off seasons and go back to his alma mater just to teach a course on financial literacy. The lack in access to information has caused the racial wealth gap over centuries. It's time that we finally put an emphasis on financial education in our schools throughout the country, but specifically in Black and brown communities.
And that was New England Patriots linebacker Brandon Copeland in celebration of Black History Month. We asked some of our CNBC contributors to share the money lessons they've learned growing up, how they are working to close the racial wealth gap, and their advice to empower the next generation of Black Americans. Brandon joins us once again. Welcome back. It's good to see you. I'm glad you're here to talk about this topic.
Always a pleasure to see you, Scott.
Yeah, pleasure's mine. What is your advice, first and foremost, to the next generation?
Yeah, I think, obviously there's a lot of things going on. And I think one of the biggest lessons I've learned is that when you're talking about investing, you talk about growing wealth, it's a time thing, right? Patience is key. And so, there's a lot of get rich quick schemes out there. There are a lot of ways to make money fast. But in the long run, we want to find the ways to create sustainable investment opportunities so that, again, we're building wealth for the long run, not only ourselves, but also our families and generations to come. So patience.
Yeah, you and me, we've talked so often about these sorts of topics, and it always comes down to access, and maybe better said, the lack thereof. And you lay that out very well in your opening soundbite to get into this segment. In this case, we're talking about access to information and access, most importantly, to education.
Yeah, I think that, one of the reasons why I take the time to do this is because I realized that by being in the NFL, I've received a bunch of different financial advice and financial tips. And I was like, well, what was the difference between me a year ago? Like, was I not worthy of some of this knowledge and understanding that knowledge is power? So, I've started Life 101, started doing that at Penn for the past few years, now doing it for everybody, access for everyone and anyone. So www.life101.io. I encourage everyone to go and sign up and come have live virtual classes with me. But ultimately, like you said, Scott, it's about access to information and education so that people have a chance. Right, you don't have a chance to build wealth. You don't have. We're not even talking about wealth. You don't even have a chance to do the proper things with your money if you never learn them. And when we look at our schools and our education systems, when did we have a class on budgeting? When did we have a real class talking about credit and buying our first home and buying a car versus leasing it? And these are realities of life, and the decisions that we make in those moments carry with us for all of our lives, right? The 30-year mortgages, right? So we need to start teaching these things. And again, I'm proud to be able to do it through my classroom with Life 101. Again, that's life101.io.
Where are you in terms of your own personal level of optimism that we are finally going to tackle some of the issues that you speak about? Do you feel that society has now woken up enough to realize that these issues not only exist, but have gotten worse, perhaps? And are you optimistic that we're actually going to focus on solving it?
Yeah, I'm always going to be an optimist. I naturally see the glasses half full. However, I do believe that there are still a lot of people in decision-making, with decision-making ability and in places of power who just still don't understand, or at this point just don't want to understand, right? Even the thing that I mentioned earlier about patience, it's easy to tell somebody that, hey, have patience, invest over the long term, but when you cannot eat tonight, right? And that has been not only caused by, it's not just caused by your own inadequacies, it's caused by a systemic issues that have plagued where you started in life and where you are today, right? We need everyone to kind of join in on the conversation. So I am proud that there are a lot of more people having the conversation, teams in the NFL, us at the Patriots, comfortable having these conversations. We saw Coach, did not accept the Medal of Honor recently and everything like that. But But I think that there's still more that needs to be done. And I hope that we don't allow lip service to get in the way of us actually acting on programs that actually will change people's lives, literally.
You still save 90% of your earnings?
I do. A little bit more, actually. You know, we've been tightening it up around here, man. But yeah, no, it's been
Everybody's had to do that. Yeah, everybody's had to do that. Lastly, and I got to run, who do you like on Sunday?
Oh, man, I want to see Tom Brady do it, man. I think that's a storybook ending. I know the Chiefs have plenty of weapons. I'm not going against them. I have no horse in the race, so to speak. Wish I was playing right. But I think that that's like a real storybook ending. Not even an ending for him, but I think it's a real storybook season for a guy like Tom Brady. So it's been amazing to watch what he's done this year.
Yeah, don't call it an ending. He's now talking about playing till he's 45, so we'll see. And by the way, who knows where you'll end up next season? You're a free agent as of March, I think. You correct me if I'm wrong, but we're going to follow you, see where you end up, recover from your injury, keep talking to us about this very important topic, and I hope we talk to you again soon.
Sounds good. Likewise, you take care, Scott.
All right, that's Brandon Copeland joining us there. To read more about this, go to cnbc.com/invest in you. We're back in 2 minutes.
An app that uses facial recognition software to identify people.
And it really works. Take it from me, Leslie Jones.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
BP under pressure today as the group reported its first annual loss in a decade, citing a brutal year for the oil industry with the pandemic sapping demand.
Negative prices, fuel demand down 14%, aviation down 50%, and of course we had adjustments to our planning prices, which resulted in impairments and write-offs. But imagine if we were sitting here today with no vaccine. I've lost track of the number of vaccines that are out there now. So that is the underpinning of the recovery here.
Siemens Energy has announced it will cut almost 8,000 jobs by 2025 as part of a cost-cutting program. It comes as the German company returned to profit in the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world. It's now always keeping the balance. On the one hand, really driving the growth part, and at the same time improving the areas where we see more challenges in the market, like oil and gas.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, Blake Mykowski. CNBC.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
Let's do the futures outlook now. The NASDAQ 100 is rallying again today. Bill Baruch and Jeff Kilberg join me now to talk about that. Bill, you're up first. Big tech, that's the topic.
There are a lot of driving forces here, and technicals are certainly one of them. Last week, the market stalled exactly at our upside target, 13,550. And then on the lows, take a look at this chart, held the 50-day moving average in a trend line going back to the middle of December. So in the rearview mirror, there's a big level now, 12,897. That's the 100% extension from the February highs last year to those March lows. Out above there, we're calling the NASDAQ in a breakout. So now we're looking at that 13,550 again, gets out above there, closes above there in a week. There's no doubt in my mind we're talking 14,000 plus.
Interesting. Jeff, you agree?
All right, Judge. Well, I think we do push higher short term, but I know we're all waiting for Super Bowl Sunday, but today is the Super Bowl for all giant technology names. So look at Amazon, Google. We're eagerly awaiting the report after the close. They make up 15% of the NASDAQ 100. So it's all contingent upon if they deliver and beat expectations, where the NASDAQ 100 is going.
Yeah, well, they could beat and still go down. Hello, Apple and Facebook. So maybe it's not so cut and dry. We'll see. Guys, thank you. We'll talk to you again soon. We'll do final trades next.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages, 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market. As you say, the increased retail activity in the market and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
Keep up with the crisis. Squawk on the Street on CNBC.
is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5 in the year in which the spending happens. The 2.5% of GDP spending on the infrastructure can translate into between 5.5 to 6% of GDP just from the infrastructure. This would be, of course, adding to the V-shaped recovery. The healthcare spending that's actually a signature moment in India's history in terms of the emphasis on healthcare.
Can a recovery be equal, green and united?
There is a direct link between vaccine and economic recovery.
The journey seems to be a little bit delayed, but should not be derailed.
We do need some more fiscal stimulus to continue to bridge the gap. There's still an enormous amount of uncertainty.
New targets of climate change is an opportunity for innovation.
That's all coming up on CNBC's virtual Davos debate, Restoring Growth.
Daybreak in the US.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Final trades, Steph, then Degas, then Josh, then Jim. Steph, go first.
Caterpillar, great quarter.
Thermo Fisher, greater quarter.
CrowdStrike.
General Motors should be a great quarter.
Yeah, the nice gain there. All right, Amazon, Apple, the countdown is on. What a great day for stocks it is. Best couple of days for the S&P, in fact, since November. That does it for us. Thanks for watching. The Exchanges now.
Thank you, Scott and the gang, and hello, everybody. Yes, indeed, the exchange begins now. I am Brian Sullivan. There is a lot to do and a lot to get to on this very busy Tuesday, so let's get right to it. Enough with the talk. The Reddit rally running out of steam in a big way, and many trader favorite stocks coming crashing down today, many pointing the blame right at Robinhood. Plus, a critical update on the most important story in America right now, the vaccine rollout. How's it really going? The facts and on-the-ground insight ahead. And will Amazon deliver? Is Uber really just a food delivery company? And why the former head of MGM is the latest to get into the SPAC race. All of this ahead on the exchange. But we have got to begin with the markets and a big-time rally in many of the biggest names that are out there, overall on pace for our best day since November. All three major indexes are up now for the third time in 4 days. The Dow up 605 points. The NASDAQ up nearly 2% as well. Energy, oil, and banks leading the way. And as they say on another famous street, the letter of the day is A. Alphabet and Amazon, both reporting tonight, both stocks higher ahead of their results as well. In fact, almost exactly the same, 1.8%. All right, a lot of numbers are already out. They came out this morning. Some of the highlights. UPS higher, it beat results. ExxonMobil in the green, losses there narrowed. And Pfizer a bit in the red, down about 3% as earnings per share fell short. Now let's take a look at what I call the GOAT trade, get out and travel. Expedia, Bookings Holding, Disney, Hilton, the cruise lines, they are all surging today up 3, 4, 5, 6% as the pace of vaccinations roll out. And we got some pretty good news on AstraZeneca. But it is not all sunshine on the street of dreams. There is a lot of pain in the Robinhood trade right now. GameStop's run stopped. Shares are down more than $100 right now, nearly 48%. It's a $117 stock. It was an over $400 stock just 3 trading days ago. AMC, a similar picture. We were near $20 a few days ago. AMC has come all the way back down to near $6. Bed Bath & Beyond, not quite as bludgeoned as the others, but it is still deep in the red as well. And many on the Reddit message boards this morning saying, though, they will hang on, but it has been a very, very tough ride on these stocks. And of course, we tend to show you, like that, stock movements here on CNBC. But remember, options are a huge part of what is going on in the market, particularly single stock options with weekly expirations. And if you know more about what is really going on under the hood, and Chris Murphy of Susquehanna Investment Group. Chris, it's great to have you back on. I want to start, of course, with the story stock that has been GameStop. You gave us the options trade last week. What's the option setup like on GME right now? And more importantly, what does the setup tell you about sentiment?
Well, you know, it's interesting. We talk about all the put volume last week. We talk about the stock moving lower and who's getting hurt there. But it's interesting to note that despite stock trading down significantly, implied volatility in the GME options are also down significantly. So what you're going to have is a situation where you can look at a put option from last week. Let's just say the March 100 puts, for example. You would expect just by the stock price move alone that those March 100 puts would increase in value dramatically this week. But because there's also the volatility component in options, and volatility is down significantly along with the stock, what you're seeing is those the value of a put like the March 100 put is actually not up that much because volatility is down.
All right, well, I'm going to take it a little bit out of the weeds. Options action, by the way, 5:30 p.m. Eastern every Friday night. Tune in. Chris, there's a lot of talk about the shorts got bludgeoned out. We know that, and that they're going to be hesitant to put a short on the equity. Does that put option, betting basically that a price will go down, indicate to you that they're either hedging a bullish bet on the stock or they're betting the stock will continue to fall, but using options, not the equity?
Well, we certainly saw a lot of put volume, and we highlighted that in addition to this increase in open interest. But what you're seeing today and this week is expectations, I believe, if you're looking at both the options and the stock, for GME to somewhat return back to normal. And that does not only include the stock returning back to more normalized levels, but it also means that volatility is going to turn back to more normalized levels. So the implied volatility level of the options is contracting a lot. So that's why you're seeing that the puts are not increasing in value quite as much. So investors who are looking who have a strong directional opinion in the stock but do not have a strong directional opinion on the option in the volatility should be looking at spreads to express their opinions as opposed to the options outright, because when implied volatility levels are 300%, 400%, 500%, that parameter kind of crowds out a lot of the other Greeks and becomes the most important parameter. So if you don't have a strong opinion on the implied volatility level, you're better off looking at spreads to express your directional opinions.
Okay, from a market perspective, do you have a view on the overall macro market outside of GameStop right now based on what you and your team are seeing, Chris?
Yeah, for a little while now, we've been discussing, markets are equity markets more likely to just kind of grind higher over time. But then, when you're seeing a little bit too much froth, we see these sharp, quick pullbacks like we saw, last week, like we saw in right before the election. We saw it in August as well. So we had the expectation of the market to kind of grind higher, but we are on the lookout for signs of froth for these sharp pullbacks like we just saw. And now that we've kind of reset a little bit, more likely that we start to grind higher again, and we'll continue to look out for certain signs of froth as an indicator that maybe we're getting a little too ahead of ourselves and we get another one of those sharp but quick pullbacks where then investors look at buying dip.
Okay, but overall, it looks like we are grinding higher today, and that might continue. Certainly, Chris, we appreciate your insight both on a macro and a micro level. Have a great day. Thank you very much. All right, so as you just saw, it is a very good macro day on Wall Street. The major averages, they're surging. The Dow is up more than 2%. You have positive vaccine rollout news. You got the AstraZeneca drug trial data all may be helping as well, plus the technical setup. The Dow on track for its best day in about 3 months and is up 800 points in just the last 2 sessions. Is that sharp reversal off the Friday fear a sign that speculation may be over? Fundamentals, stimulus, free money, whatever you want to call it, are back. Joining us now is Katie Nixon, Chief Investment Officer at Northern Trust Wealth Management, and Simeon Hyman, Global Investment Strategist at ProShares Advisors. Katie, it's enough to give you a little whiplash. I mean, the last few trading days here, obviously Thursday and Friday, a bit nerve-wracking. What is today? Is today a good stimulus news day? Is today a good vaccine news day? Or is today just the continuation of what has been a long-term trend because there's $4.5 trillion in cash sloshing around the globe?
I think you just nailed it, Brian. I mean, I think last week was the blip. This week, we're back to that old reflation rotation narrative where investors are looking forward to the post-COVID recovery, the great vaccine news combined with the policy news that we're getting from Washington, where there seems to be at least a little bit more alignment on a next stimulus package. Clearly, we heard from the Fed last week that they're not even thinking about raising rates. So easy money will be a character of the market for the foreseeable future. And then you mentioned that the macro is positive, but the micro is really positive too, Brian. We've had a very good earnings season so far, lots and lots of beats. We're expected to climb out of 2020 with a lot less earnings damage than we had feared initially. And it's interesting to see that it's not just a U.S. phenomenon. We're seeing beats around the world. We're seeing 80% beats in emerging markets, 80% beats in European stocks on the earnings front. So the micro and the macro are kind of rowing in the same direction right now.
Yeah, and Simeon, listen, I know things are still very tough right now. Nobody is making light of that, but we are going to come out of this. And one of my predictions that I made is I think 2022 will be the strongest economy in many ways that we will ever see in our lifetimes as we all kind of bust out. CBO raising estimates. Some of the Fed banks around the world raising estimates. ISM up. You can't find a shipping container because they're all booked up. The price of oil is higher. Are you as optimistic about the second half of this year and 2022 as some of the more optimistic forecasts?
No, I think that's right. And I wasn't going to even bring up the Baltic Dry Index because that's just one of those things that people always bring up in these instances. But all the indicators are good. And that ISM manufacturing, people kind of expected it. But surprisingly, ISM services has been well above 50 since June. So these are all indications. You mentioned the CBO, but I'll bring in one more piece of stimulus here that has nothing to do with Washington. It's the consumer. The household savings rate has been through the roof since March. There is a ton of pent-up demand. Who hasn't had that conversation with a friend saying, hey, I'm just waiting for the all-clear sign, and I'm going to go on vacation, and I'm going to do this, and I'm going to do that. So I think you'd put us in the bullish camp. But you have to be there, though, because those consensus earning estimates just for 2021, let's not talk about 2022, are for about a 30-35% increase in earnings. We only need a little bit of margin expansion to get there, but it's still a real number that has to get there.
Well, and I'll follow up with you, Simeon. By the way, you can always mention the Baltic Dry Index in any show that I'm doing. I had no problem with that. As a commodities guy, I kind of like to hear about it as well. And by the way, that is up. Not as much, but it is up. Certainly. I guess the question is this, as we all know that, and the hard part about the story is 70 to 75% of the country has been saving money. To your point, they're not going anywhere. They're not doing anything. They're just banking the coin while the rest pretty much are out of work because they're in travel and leisure. So it's a very tough story overall. The question, though, is how much more multiple expansion, Simeon, can this market and stock prices withstand?
Well, look, the market, of course, is not monolithic. From our perspective, the trade here is if you want to leave a little bit of, if you want to harvest some of your gains in that large cap tech space and you want to rotate somewhere, we would suggest not necessarily rotating the value because, as you mentioned, this is not going to be a straight line. There's still hair out there. We're not quite done with this. We think the quality trade makes more sense. As an example, the S&P 500 dividend aristocrats, those are those companies that have grown their dividends for 25 straight years. They grew their dividends 14% last year in the pandemic. And look, they're at a little bit of a discount because they've been left behind. So you can certainly look for some things that are on sale. And sometimes you don't even have to look to beaten down things to find things that are on sale. I mentioned as the note I sent over that online retail, the ProShares Online Retail Index, which was up triple digits last year, it's actually at a 30% discount to the consumer discretionary sector. And you get a play both on the growth of online, but also you get some of that reopening money if it shows up. So I do think you can be a little picky and choosy, but still general bullishness because the economy is turning around.
Katie, is there anywhere you and your team are still seeing any, I mean, everything's up in price, just a measure of how much, any value anywhere?
So on a relative value perspective, we still like non-U.S. equities. That's certainly where you get a big bang for your buck relative to the global growth story, the reopening trade later on in 2021 and into 2022, as you said, Brian. And so we want to really lean into that trade. We do think there's value right now in some of the cyclicals. It's interesting because the market itself is expensive, and it's broadly expensive here in the U.S. You know, almost half of the stocks in the S&P are selling at over 20 times earnings. So we're at a very high valuation level. So you're going to have to look to where you can get value for that valuation, right? And where you see that earnings bump, that real leverage to the upside is in some of the more cyclical trades. So we still like leaning into those trades as well as the non-U.S. equity markets.
Katie Nixon, Simeon Hyman, good discussion there. Looking at the consumer discretionary names as well, so all ready to bust out. Guys, thank you very much. All right, coming up after the break here on The Exchange, the latest on-the-ground facts on the vaccine rollout as we take you back to where it all started back in December. Plus, Americans relied on Amazon more than ever during the pandemic and lockdowns. But can the company keep all those new customers as we begin to reopen? All that much more ahead. The Dow is soaring, up more than 600 points. We'll take you to break, showing some of the winners. We're back right after this.
This is The Exchange on CNBC.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
All right, welcome back to the exchange on this big market day. Well, you may not have realized it, but yesterday was a very important day in the fight against the pandemic, because yesterday was the first day that the number of total vaccinations is more than the total number of cases since this all began last year. And that number should only grow and keep cases and hospitalizations down. And since we first took you on the ground to Louisiana and followed some of the very first doses ever delivered back in December, the rollout has really ramped up with a record average of 1.4 million shots per day being given, and it's probably actually more than that, which means we could have 100 million shots in arms by early to mid-March. And that doesn't even take into account a new J&J and or AstraZeneca vaccine that gets rolled out. So let's check back into where this all began and bring in Paul Dickson Jr., Vice President of Operations at Morris & Dickson, the 180-year-old family-run company, one of the largest drug distributors in America, who graciously allowed us in to watch them work in the very early days of this. Paul, look forward to getting back to Shreveport, but we appreciate you joining us like this nonetheless. It's been a few months now. What have we learned, and what do we still have to learn?
Well, a lot of the confusion has died down once figuring out what administration sites can handle it, how much they can handle, and a lot of that's become a whole lot smoother. Last night, it ran very smoothly. 18,000 doses roughly came in and left same day in less than 12 hours. So that's how it should run.
How can we speed up the process?
Ramp up supply. The demand is greater than the supply right now, and the distribution network is not a bottleneck. We are getting out every vaccine that is needed same day. So breaking down the confusion and making sure we know exactly what sites need what and exactly when is how we can speed it up.
Part of the conversation, yeah, that's it. So I want to focus on that, Paul, because you and I have talked about it. I've spoken about it with others down in Florida and other states. And what they say, and what maybe many people in America forget, and who can blame them, is we vaccinate 175 million people every year. We get a flu vaccine. We don't even think about it. We go to our local pharmacy, get the shot, and go home. It's not a big thing. The bottleneck is really because we are creating, rightly so, by the way, prioritization groups. CVS today said pretty soon they're going to start vaccinating. Once we hit that normal supply chain, the work that you and your team do every single day, how much faster do you think we can go, assuming the supplies are there?
As fast as the supply comes. The distribution of pharmaceuticals happens every day, 30,000 different items, vaccines alike, like the flu, and it's never been a hold up. Every pharmacy in America has what they need in less than 12 hours. So getting the vaccine distributed through the wholesale supply chain of pharmaceuticals is not a bottleneck at all. So we can move as fast as the supply comes to us.
And we're showing that video of when we were there, which is still, sort of gets me every time, as your team working those vials out of the -70 into the coolers and following, Ray down the road to Lake Charles. When we get, I assume, the J&J vaccine that does not necessarily require these ultra cold temperatures, how much more will a normal temperature, a normal vaccine also help speed it up and not rely on those big Thermo Fisher freezers you're standing in front of, Paul?
So that's not one of the big bottlenecks. I think the big bottleneck is just determining which sites can handle how much vaccine. And part of that is making sure the patients are available and making sure they have the people available to administer. So the cold nature of the product, cold chain, is really not the hurdle for the distribution side of it. We handle this type of stuff every day. Refrigerated or frozen product is not a problem for the normal distribution supply chain.
And here's maybe a more uncomfortable question, Paul. And you're down there in Louisiana, and I've traveled through the South and see there's people that just won't take it, right? I mean, we talk about herd immunity numbers, and forget about the argument. It could be 40% to 70%. Everyone's got a different view. But the reality is that there's probably a third of the country, based on surveys, that are simply not going to take it. Don't dive into that. But as you're distributing it to these hospitals, you guys see it firsthand. There are even healthcare workers that aren't going to take it.
That's right. We've seen, and again, we're not a vaccinating or administrating site, so I don't have firsthand knowledge of that. But what we understand is it's roughly a third of the people are very willing, and a third of the people can be convinced, and a third are not willing. And you see that as different sites accept different amounts each week. And the ability for them to vaccinate their entire allotment varies depending on the amount of people they can get to vaccinate.
Paul Dickson Jr. at Morris and Dickson. We were down there in December watching the very, very first shots into arms as well, and you guys are ramping it up. Look forward to getting it to those normal supply chains like you guys do every day with thousands of drugs. Right. Paul, thanks for joining us on CNBC. Have a great day. Good work.
Thanks, Brian. Thank you.
All right, there you go. On the ground, folks. Get it back into that normal supply chain, and we can, as long as supply is there, boom, ramp it up quick. All right, on deck. Uber investors raising a glass as the company drives into the alcohol market. Say what? It's a real story. Plus, former MGM chair Jim Murren jumping into the SPAC race. Contessa Brewer speaks with him and his new partner about what they want to accomplish in gaming. We'll also ask him how Nevada's vaccine rollout is really going. Remember, he oversees it. And speaking of games, the casino stocks all moving higher as America moves one step closer to crushing COVID, getting out, and getting back. Vegas, baby, Vegas.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
Navigate the new normal. Squawk Box on CNBC.
Welcome back to the exchange on this busy Tuesday, and we have got a rally in stocks, or I should say the continuation of maybe the rally that began yesterday. Getting more positive news, the fight against COVID. We just talked about it. Also got the AstraZeneca trial results that are out there as well, and CBS saying they're going to start vaccinating eligible patients in 11 states. And you remember what our guest just said about getting it into the normal supply chain, and the speed will really pick up. Either way, we are seeing the Dow up 566, a little off its high. The high was 628, but I mean, not going to dither in a nearly 2% up market. And right now, the Dow is on pace for its best one-day gain since, I think, November 9th, or at least early November. Let's check on bonds, too, because bonds are actually moving just a bit higher as well. And the dollar index, remember that, is at the highest since early December. And oil trading at its highest level in more than a year. We are seeing crude oil come up as more people maybe take into the roads, take into the skies, and by the way, take into the seas, because global shipping is up. Global shipping, of course, uses a lot of oil and gas. We are seeing silver down 10%. Remember, yesterday, silver really was the story, surging double digits to the highest level in nearly 8 years. We are seeing COMEX-traded silver now down about 10%. All right, so let's step outside of the world of money and business and get to Seema Modi for a CNBC News update. Seema.
Brian, here's what's happening at this hour, and we will start in D.C. The Senate has easily confirmed Pete Buttigieg's nomination to be Transportation Secretary. A more contentious vote on Alejandro Mayorkas to be Secretary of Homeland Security. That is set to start in about an hour. A Moscow court has ordered opposition leader Alexei Navalny to spend over 2.5 years in prison. British and German leaders are already calling for his immediate release. In Rochester, New York, one police officer has been suspended and 2 have been put on administrative leave. This after police, responding to a family help call, handcuffed and pepper sprayed a 9-year-old. And get ready for more winter. Punxsutawney Phil saw his shadow on this Groundhog Day. Even if there aren't any spectators to see him, there is some groundhog descent, though. New York's Staten Island Chuck, Georgia's General Bagard, and Illinois Woodstock Willie all expect an early spring. It's a silly tradition, Brian, but somewhat endearing.
I'm going with Beauregard and Willie, and they're optimistic. I'm glass half full, Sullivan. So you know me, Seema.
Yeah.
You know, Punxsutawney Phil, whatever it is, a little weasel can go back in the hole. By the way, I want to see them do this with a honey badger. That should be the new. If you survive the pulling out of the hole, spring is tomorrow. How about that?
I'm with you.
There we go. The honey badger saw a shadow and then ate everybody. Seema, thank you very much. All right, we've got Amazon up after the bell. Uber's boozy bet. She was like, I don't even know why he's on TV. And GameStop could get the Hollywood treatment. All that and more in today's episode of Rapid Fire. I hope to be there in 2 minutes to join you. Tune in.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
Keep up with the crisis. Squawk on the Street on CNBC.
Reporting on the Federal Reserve is one of the pillars of CNBC's coverage.
You guys ready? Here we come. Let's get to Steve Leisman with the Fed decision.
Up by 1/4 point.
Put up the Dow. We're up 250.
Obviously, the market reacted to it.
New Chairman Jerome Powell will hold his first news conference.
Afternoon.
Leisman gets the first question.
Where's your biggest concern here? Is it in overkill when it comes to rates? There's very little that moves the markets as consistently as the Federal Reserve does.
Give me Treasury.
I feel tremendous responsibility both to get my reporting right and to get my analysis right.
I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. As BP posts its first annual loss in a decade, the CEO Bernard Looney tells CNBC there is light at the end of the tunnel after what was a brutal year for the sector. That story's on the website now. U.S. President Joe Biden will push ahead with his $1.9 trillion COVID-19 relief package, rejecting calls for a scaled-down bill after a meeting with Republicans. But the GOP remains optimistic that there's still a way to meet in the middle. Head online for the full story. And China's economic growth is likely to moderate in the next few months, according to Goldman Sachs. It says Chinese policymakers may begin pulling back on stimulus as the country's recovery takes root. Head to CNBC.com for more. And remember, you can follow us on Twitter at CNBCI.
Amazon's results after the bell. Uber's rather boozy bet. Where's the beef? And GameStop going Hollywood. It is time for what else? Rapid fire. Able to bring it back as things kind of went back to normal just a bit. Here now with their hot takes of the day. Deirdre Bosa, Michael Santoli, and Kate Rice. This is an epic lineup. I can't wait to see who survives. All right, first up, Amazon is set to report their earnings after the bell. Analysts expecting just under $120 billion in sales. That means it would join the exclusive $100 billion revenue club alongside only Apple and Walmart in the U.S. Over the past 6 months, Amazon has actually underperformed the broader market. It's up only 7% versus 17% for the index. So could this report be the catalyst to break it out of its slump? Deirdre Bosa, first to you. What are you expecting on the numbers themselves? How big might they be?
Well, we are expecting extremely big numbers. $100 billion revenue quarter is just a starting point. A lot of folks on the street think it's going to be much bigger than that. But I think the key here, Brian, is profitability, which isn't something we usually attribute to Amazon. It's sort of gotten a free pass for many years, but over the last few years, it has really been a more financially disciplined company. I think the street is going to be looking for that profit margin from the company, especially when it is spending billions and billions of dollars, not only on COVID relief, but also building out further its one-day shipping. So that's going to be key. And what Amazon sort of says about the quarter ahead, because while revenue is firing on all cylinders, this is already Amazon's most profitable year.
You know, Michael Santoli, are we learning? Is it possible that the overall market can go up even if Amazon is not leading the cart?
Yeah, we've learned that since about Labor Day. You know, the stock is still about $100 below its September 1st high. It's gone sideways. By the way, it's still up 70% on a one-year basis, so it really has just been digesting a massive, massive move off the March lows. And it's done this before. It's gone sideways for various periods. Netflix had a similar setup to its earnings where it had really done nothing for months and then, of course, had blowout numbers. But, yeah, it's a broader market than it had been. The weighting in the S&P 500 of the top 5 biggest stocks is down somewhat from its all-time highs recently. But I think it's too early to say it's going to be an either-or market. These guys can still participate if everything else is going up, too.
Kate Rogers, every day on average, don't have to be specific. How many boxes are you breaking down in California? You can't go out and do anything in California. How many boxes every day do you recycle?
We do get a lot of Amazon Prime deliveries here, and we've also now started using Whole Foods grocery delivery, which is something that I had shied away from. But in Q4, we've seen many more restrictions. COVID cases obviously surging. One of the reasons why it will be such a strong quarter for Amazon. And Bank of America points out this stock and the company works even and is better positioned rather than its peers in a vaccine scenario when vaccines roll out, because consumer preferences has shifted. Me moving to Whole Foods delivery is one of them for sure, Brian. I was never someone that did that before. I think a lot more consumers are relying on all of their different offerings in a much bigger way now. And do we go back after this? Do we go back once the vaccine rolls out? I'm not quite so sure.
I hope we go back to the store because I'd like to see a few stores stay in business. Kate, we're going to stick with you, all right? The old quick snake around, because Uber is making it rain all over Drizly. That's an alcohol delivery service. Uber buying it for just over $1 billion in cash. They're the largest e-commerce alcohol marketplace in North America. I'm assuming, Kate Rogers, there's some way to make sure, you know, like my 15-year-old self wouldn't have ordered beer for the delivery. Yeah, I'm 32. I'm Abe Frobman, the Sausage King of Chicago. Talk to us about this deal and what it might mean for Uber. We know the Drizly founders are getting paid.
Yeah, absolutely. Huge, huge deal this morning. And also just looking at the food and restaurant space, how important alcohol delivery has become to struggling restaurants, Brian, was something that I thought of when I saw Uber was buying Drizly, because Uber Eats and its food delivery platform has become really key. And I'm wondering, and maybe Deirdre may know better than I would, but can you now mix ticket items on Uber Eats when you're looking for delivery? We know alcohol delivery, cocktails to go, that's been something that's helped the independent restaurants when they're struggling at this time. It just seems like the next natural step for Uber to kind of wade into that market, because it's becoming increasingly popular. To my last point about consumer preferences really shifting.
Kate, it may be the next natural step, but yeah, so it may be the next natural step, but again, like some other areas, is Uber late? Dara Khosrowshahi, the CEO, he's an operator. He tends to buy companies to plug different vendors into the platform and, with mixed results. So compare what Uber has just done, announced today, with some of the other business models. There's a company based in Philadelphia called GoPuff that is taking a more Amazon-like approach to delivery. They're owning it from end to end, the infrastructure, the technology, the liquor licenses. So like in food delivery, which Uber has really lagged behind. You saw DoorDash increase its market share at a much faster rate and overtake Uber in a very big way. I just wonder if we're going to see the same thing here. DoorDash, by the way, has its own convenience store. So are you going to order wine when you order your food delivery, or are you going to order from a convenience store model where you can get your essentials and your wine at the same time?
Yeah, my 22-year-old self would have said cannabis and Jack in the Box or Taco Bell should have tied up, I guess, but that's a different issue. Michael Santoli, we look at these numbers. Uber is a big company, right? It wants to be known as a technology company. Is delivering food, like, a couple of burgers, by the way, burning carbon as all these cars are now sitting in our driveways running. Is that the way to get a 25, 50 multiple?
It's technology, because essentially what you are is the app, you're the dispatch, you're the hub. So, I think that basically that argument is as good as it was when Uber came public, in a sense. What I find interesting, though, is 90% of the purchase price for Drizly is in Uber shares. So Uber's saying a little more than 1% of our market cap, we are going to bet on this company, which maybe it's, too much, too little, but it's not a tremendous wager.
A lot of people trying to make money, all doing the same thing, by the way, as the burgers getting cold in the passenger seat. All right, up next, Impossible Foods items are about to get less expensive. The company's slashing prices by about 20%, marking the first time it has marked down prices. But it's the third time in the last year that it has permanently discounted some products. Restaurant distributors received price cuts in 2020 and again in January. Well, cheaper prices, though, help drive people away, Kate Rogers, from just meat. Or is it really, let's be honest, it's about taste, not price?
I think it's about all of those things, Brian. So both Impossible and Beyond Meat are looking to get customers that are seeking these non-meat and meat alternative options, but they also want people to flex into the category, right? To try them once in a while, make them a part of the rotation, even if they are people who also consume meat. So the price discounting there is important. They want to, get a little closer to parity with actual beef prices. Beyond Meat also had lowered some of its prices. It has a Cookout Classic pack that's still in stores, and that company also said that it wants to basically have one product in each category by 2024 that would be on parity with an actual meat product here. So you can see the discounting is important now. It will continue to be important. And just like we've seen companies like Starbucks see real success with these alternative milk and nut-based milk options, that's something that you can see consumers kind of gravitating towards and adding into the rotation. And I think that those customers that are flexing into the category will continue to become important to all of these brands moving forward.
But again, Deirdre, a space, whatever, by the way, whatever you think of the product, maybe you love it. Some people I know do, some people don't. There's a lot of competition. There's, again, just growing competition for the consumer buck.
Yeah, and we've been showing the stock price of Beyond Meat, and really tough break for this company. It's yet to turn an annual profit, and now if it's engaging in some kind of price war with Impossible Foods, it's going to be even tougher. And remember, this is a public company, so you can see it a lot clearer than you can Impossible Foods, and perhaps Impossible Food is able to raise more money to subsidize prices.
All right, finally, get this. GameStop may be going Hollywood. At least two different projects, one on Netflix, one on MGM, are reportedly under development to look at the investment saga that started on Reddit and turned into a cultural phenomena. Mike said, Jolie, I get it, but they could also just watch CNBC every day. We're watching it play out in real time. Do you think there's enough meat here to have a movie?
Well, you could always make something out of it. It's pretty tough to say at the outset. I understand why you would want to. It does seem to some degree cinematic in terms of it being, kind of underdogs, big money involved, humbling of, at least temporarily humbling of some billionaires. So I get it. But, we had two SNL sketches, I think, that made reference to this last week. If you needed another sign that maybe we reached a crescendo in attention on this particular narrow story in the past few days, the fact that you have them, soliciting scripts on it might be one of them.
Yeah, and by the way, it's a bad movie today, down 116. A lot of people getting burned. By the way, trading limits and stuff on some of these platforms. A lot of people are going to be really ticked off, probably already lawyering up. Deirdre Bosa, what do you think? You think there is enough here? Somebody did point out, by the way, on Twitter, I can't remember who, that the guy Roaring Kitty who kind of started this whole thing on GameStop and the CEO of Robinhood look almost too much alike. Wink, wink.
Yeah, I think I also saw a few others dragged into that,
you see that?
meme or whatever you want to call it. Adam Newman was one of them. There is a striking similarity to some of the most interesting people we talk about. Brian, is there enough there? I mean, yes, we get a front row view to this every day. It's been one of the most exciting weeks on CNBC. We've had such interesting conversations. Where it goes from here, that is anyone's guess. This could quickly become, a more interesting storyline or perhaps a boring one, and maybe that wouldn't be too bad either. But I'm sure Hollywood will find a way to, dial up the drama.
I saw Ben Medrick's name was involved. Of course, everything he writes is just entertaining, and I've never met the guy, but I think I've read all of his books. I know he's been rumored of, I don't know how you already write the book, or maybe it's half written, but we'll see how this plays out. And by the way, I hope it plays out well for a lot of these retail investors. Deirdre, Michael, Kate, thank you all very much. Appreciate it, guys. Good rapid fire. All right, still ahead. The pandemic continuing to keep people out of casinos for the most part, but MGM is placing a big bet on social gaming and a new SPAC. Former MGM CEO Jim Murren joins Contessa Brewer next. And take a look at Bitcoin, where the volatility continues. Bitcoin has been all over the place the last couple of weeks. It's up 1185 right now, back over 35,000 or 3.5%. Ether and others are also up. And we are back right after this.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Fred, tell us about this painting.
It was commissioned for the city of Disneyland. And
the city of Disneyland.
Yeah, before they built the amusement park there, it was just a city.
Welcome back to the Exchange, everybody. Good to see you. All right, another day, another SPAC deal. This one in the mobile gaming world. Contessa Brewer joining us now with the details and some special guests. Contessa.
Hi there, Brian. Nice to see you. The agreement just cemented brings together some well-known names in gaming. The SPAC, Oculus, is co-founded by Jim Murren, former CEO and chairman of MGM Resorts. Play Studios founder, CEO and chair is Andrew Pascal, former president of Wynn Resorts. Now, Play Studios offers well-known casual games on apps and social media games. These are free to play, games like My Vegas Blackjack. But the players earn real rewards, like a night at MGM Resorts, a partner to Play Studios. Play Studios has nearly 300 such partners around the globe, and big plans for expansion. This deal values Play Studios at $1.1 billion. The institutional investors, BlackRock, ClearBridge, Neuberger Berman, and MGM Resorts have signed on already. And joining me now for a first on CNBC exclusive, Jim Murren and Andrew Pascal. Gentlemen, thank you for joining us. It's great to see you.
Thank you for having us.
Jim, you bring to the table a wealth of knowledge about the world of gaming, and by that I mean gambling, and where it can go digitally. What are your hopes and expectations for this acquisition?
Well, I believe firmly of the intersection between live entertainment like casino gambling and digital entertainment. And I believe that consumers are increasingly looking for opportunities to consume entertainment in multiple channels. Play Studios is right at the epicenter of that. It is in the digital gaming space, but it allows their customers to redeem real stuff in the live world. And so I expect that Play Studios will be able to use its great franchise of great games, great mechanics, with its one-of-a-kind loyalty platform that no other company has been able to achieve, to be able to embark on a very aggressive M&A strategy that will propel this company vastly forward.
Let's talk a little bit about the M&A strategy. And Andrew, the strategy to grow a company where your customers aren't paying anything. They're playing for free. So what are your goals for the capital you get?
Well, I mean, just as Jim characterized, we feel like we've proven out this really unique model where people come and download games from the app stores and they play them for free. And as they do, they accumulate all these really great benefits that they take advantage of in the real world. And so we built the platform and the tools and refined our sensibilities about how to run a platform and a business like that. And now we want to scale it up. We've built all of our games organically with our teams and studios around the globe. And now we're going to take this resource and currency from doing this transaction, and we're going to go and find really great companies with great games of their own and a network of players, and then integrate it into our framework so that we can bring the benefits of loyalty and all of our partners like the MGM Group to those propositions and then scale and grow our business.
I've been told that the people who come into, let's just use MGM as an example because Jim's very familiar with it, as am I, that the customers who go and use their rewards for a night at MGM end up being really sticky, that they spend a lot of money at MGM and they stay within that ecosystem. Is the ultimate hope here that you can transition, you can convert those customers playing blackjack on your app for free into actual blackjack players through iGaming where it's legal?
Yeah, I mean, look, it's beyond a hope. I mean, we've proven that out. We've been running and operating our business in this model for nearly 9 years, and we've delivered millions of new customers to our partners across the globe, MGM being obviously one of many, but a very important partner. And so we've proven it. It works. People love it. And the consumers that we're delivering to our partners are demonstrating that they are of at least equal, if not greater value to them than the consumers that they're sourcing through these other kind of promotional and discount channels or tactics. And so it's been very productive.
And Contessa, what also happens is a company like MGM or Royal Caribbean or many of Andrew's partners, when they want to launch a new restaurant or a new show, or they want to reintroduce themselves to their customers, they're using Play Studios and its database in order to provide that trial for that customer. It's a great customer acquisition tool. It's also a great tool to reactivate dormant customers. MGM, I know, uses it liberally to do that, and others do as well. And that's why this convergence between live and digital is so great.
And I point out it works both ways.
Hey, Jim, it's Brian Sullivan. I'd like to, if I could jump in here, guys. I know we're running out of time, and I'm sorry to bomb in on this. I want to congrats on the deal. I want to talk to you about something else, Jim, because you are the head of the coronavirus vaccination public-private task force in Nevada. And we just talked to somebody, a drug distributor. Nevada's used about 67% of its available shots. What can you guys, because these are, I know people look to the federal government, which has done some things, but this is a state-by-state operation for the most part. What can you do in Nevada to speed it up? Do you think we need to use more of that already existing supply chain and the pharmacies? because you got a large elderly population and a lot of people that are out of work and want people to get back to Vegas.
So we started off slowly on vaccinations, but we learned our lessons, and we're going to speed up very quickly, and it's going to be a public-private partnership. And so the private sector, WIN, MGM, Caesars, NV Energy, Nevada Gold Mines are all deploying their resources to help distribute the vaccine as rapidly and broadly as possible. So you're going to see a big spike of vaccinations over the next several months, beginning immediately. And I think that's going to have a big impact on consumer confidence. And it's going to have a big impact on visitation back to the shows and the restaurants of Las Vegas in the second half of the year.
Jim's got his hands in a lot of different pots right now, even though he's no longer running a big global company. Jim, looking forward to any news here on SPAC 2. Andrew, thank you for joining us and giving us some information about where Play Studios goes from here. Appreciate it, guys.
Thank you, Vanessa. Thanks so much.
Brian.
Thank you, Tessa. We appreciate you bringing the story and the guests to us. And thanks for letting me jump in on the vaccine question. Appreciate it, Contessa.
Sure.
Take care. All right, still ahead. Nobody better than Contessa. All right, Goldman Sachs says it is impossible for retail traders to short squeeze silver. They say it's just not possible. You disagree? We'll tell you why they say it next. And don't forget, you can watch us live on the go on the CNBC app. The exchange. We'll be right back. Dow 544, Bitcoin up 1,400.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
BP under pressure today as the group reported its first annual loss in a decade, citing a brutal year for the oil industry with the pandemic sapping demand.
Negative prices, fuel demand down 14%, aviation down 50%, and of course we had adjustments to our planning prices, which resulted in impairments and write-offs. But imagine if we were sitting here today with no vaccine. I've lost track of the number of vaccines that are out there now. So that is the underpinning of the recovery here.
On the next Managing Asia, Sim Wong Hoo, Singapore's well-known technopreneur, back in the spotlight.
I think Super X5 is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hoo on the next Managing Asia.
Tyler Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
And welcome back. Unfortunately for some, silver price is looking a little more like lead today, giving back pretty much what they gained yesterday All this talk of squeezing the silver market was one of the biggest headlines out there, as another army of Redditors or tweeters, there's a debate over which online army exactly, however, tried to execute a short squeeze on the precious metal. Many of them still are, a move aimed at hurting the big banks and running the price up. But according to one of those banks, Goldman Sachs to be exact, it may be an impossibility structurally. Goldman says due to the nature of the commodities market, shorting there is not like shorting stocks for a number of reasons. And both exchanges like the CME and regulators like the CFTC have protocols that they can just slap in place to avoid huge run-ups in prices, like raising margin requirements by 18% out of the blue, like the CME did last night. Some of you may disagree or just want to learn more, and to do that, go to cnbc.com/pro. All right, that does it for the exchange. Bitcoin is up, market's up, Power Lunch will pick up the rally. We'll see you tomorrow.
In the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world. It's now always keeping the balance. On the one hand, really driving the growth part, and at the same time improving the areas where we see more challenges in the market, like oil and gas.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Welcome, everybody, to Power Lunch. I'm Tyler Matheson, and here is the 2 o'clock takeout, a rally on Wall Street, but not for GameStop. No way. The stock is down 50%. So is that particular retail trade unwinding, and is that good for the market more broadly? Plus, the cloud wars take center stage. Alphabet, Amazon, both higher as they get ready to report earnings after the bell this afternoon. We will break down that big tech battle royale. And later, Bitwise filing to approve a new publicly traded Bitcoin fund. Is it one step closer to the long-awaited Bitcoin ETF? Power Lunch starts right now.
Welcome to Power Lunch. Great to be with you. I'm Melissa Lee. The Reddit-fueled retail trade falling apart at the seams. Everything from GameStop to AMC is plummeting, while the rest of the market is doing quite well today. The Nasdaq is higher by 1.7%. Bob Pisani's got all the details. Bob.
And Melissa, this is quite a rally. Remember all of this worry about GameStop and how it was affecting the markets on Friday. Just look at the S&P. We were 3,700 on the S&P on Friday afternoon. Now we're at 38, 36. We've rallied 136 points since Friday afternoon. We are now, Melissa, maybe 18, 20 points from an historic high in the S&P. I'm talking about a closing high in the S&P. That's how far we've come. You're looking at a one-month chart. We're knocking on the door of an historic high in the S&P 500. And this, of course, is coming at the expense of the shorts that are out there. GameStop essentially has been cut in half today. AMC and all the others, Bed Bath & Beyond, not quite as much, but downside. Word is out that the short positions on GameStop have been significantly reduced. And, of course, there's a lot of differences. The Reddit community seems to have split on this and whether to hold on or to sell. And the community seems very, very divided on that. Meantime, nobody's waiting for this. Mega caps moving along. We're waiting for Amazon and Alphabet. Nobody's waiting for Alphabet. Alphabet's at a historic high today, folks. We've moved in advance of the earnings. And, of course, people are anticipating terrific numbers. Apple, Facebook, Microsoft, also strong. And what we need to do to keep the rally going is we need to have really good earnings beats. That's going to be the key. We'll talk about that later in the next couple days. But generally, the numbers are really good. United Parcel Service beat on higher revenue. We expected that. Exxon, basically, they've convinced everybody the dividend's safe. They'll be able to pay it out of the cash flow. That's what people care about. That's working for Exxon. But Harley, did I read this right? Motorcycle shipments down 48% year over year. My heavens. That's why Harley is down, and we got to get people back on the road. And, guys, everybody's anticipating that's exactly what's going to happen beginning in the middle of the second quarter. Tyler, we're all going to go out and take trips, and hopefully Harley will pick up as well.
All right, thank you very much, Bob. Bob Pisani reporting GameStop halted a number of times in what has been a volatile day of trading for the stock. As Bob pointed out, it's down 50% or more. The billionaire Marc Cuban weighing in on the sell-off earlier today on Squawk Alley.
I wasn't telling people to buy more at all. In fact, I said, look, you know, any of us who have traded long enough have been through the pain of making mistakes. And you know, the key is to learn your lessons. And if you're going to hold the stock, if you can afford to hold it, you know, I'm not a fan of selling into a diving market. And so I told him if you can afford it, to hold on. But I certainly not encouraging anybody. But, you know, that said, I am a fan of what's going on with WSB, and I like the idea of this collective buying, and I think it could really have an impact on the markets in the future.
Not sure what he just said there. For more on this Reddit revolt and the impact to the markets, here's David Rosenberg, President and Chief Economist of Rosenberg Research. Let's start with his comment that he's not a fan of selling into a falling market. But my goodness, if you owned or you bought because you were tempted, you bought the stock there, GameStop, at 200 and it's now 100 and going down, why wouldn't you sell?
Well, I think that you should be selling because, look, the whole trade here were, you know, what we used to call minnows, which are retail investors, and all of a sudden they've turned into sharks and they smelled some blood. And it could have been any company. So it happened to be, you know, GameStop. It could have been, you know, XYZ. They just noticed that there was this incredible leverage short position on the stock that was greater than the outstanding share valuation, and so they saw an opportunity here to force a classic short squeeze. Look, it's not the first time this has happened between institutional players. Maybe the first time it's happened between, you know, retail investors and an institutional investor. But let's just call it for what it was. We had a hedge fund that was not managing its risk exposures appropriately. This is a big learning lesson, you know, to be very cautious on your risk exposure and your leverage. And now on the other side, I mean, these retail investors that were buying last week that are having their hat handed to them, I don't even know if they understand, and I don't mean to sound condescending about what it means to be investing in the call option market on these stocks, because once again, you're leveraging up. So there's really two lessons here on both sides of the equation. Managing your risk exposures appropriately in the hedge fund industry, lesson number one. And thankfully, there was no contagion effect and the market's rallying. On the other side, you know, I got these band of investors buying speculative stocks that only lose money, but there was no business model or any intellectual capacity behind what the retail investors were doing. They just noticed an anomaly in the marketplace, which were these extremely leveraged shorts by one particular player, and they took advantage of it. And the story's already run its course.
I'm not sure I understood Marc Cuban particularly well when he was talking about something being a good thing for retail investors. So I'm going to gloss past that. If you understood what he was saying, pick up. I think I left him at Luka Doncic,
that's why I probably didn't answer the
basketball player,
because I didn't either.
Yeah, I'm not sure. I'm not sure what he was saying there. But what does this phenomenon, this Reddit phenomenon, say about the broader market and whether it is at, near, in, beyond bubble territory and the risk of that?
Well, look, it has nothing to do with the markets being in a bubble. I mean, that really comes down to the dramatic influence that uber low interest rates have on inflating multiples on everything. And it's not just in the equity market, it's in the corporate credit market, it's even in the residential real estate market. So it's quite endemic, and we're seeing firsthand the power of these ultra low interest rates having their impact. And it's global. It's not just in the U.S. market. The influence of the retail investors. I mean, I think in 3, 6, 9 months, this will be an asterisk in history. The retail investors always been there. These investors, insofar as they can, collectively, come in and buy certain classes. I mean, to me, you drive silver up beyond its intrinsic value. To me, for a regular investor, that might be a great shorting opportunity. So it's just creating, if it's creating anything, it's probably creating more volatility in the marketplace more than anything else.
Why, David, are you so dismissive of this group of investors when we've watched social media and technology, go into other parts of society, and there's no looking back? I mean, take a look at the impact Facebook has had, Twitter has had, not just on discourse, but on politics, for instance. Why wouldn't the advent of technology, whether it be from, apps like Robinhood or sites like Reddit, have a lasting impact? We've seen it time and time again.
Well, look, I think in this specific case, last week was a specific case, Melissa,
Sure.
where a hedge fund that was overly leveraged, overly exposed with his short position got exposed. I'm not so sure. I think there's a big learning lesson there. So I'm not sure that's, we're going to be, seeing lightning strike twice in the same place. At some point, the markets will settle down, because if you say, oh, well, we've got this group of investors, they're not really fundamentally based investors. Are they buying anything fundamental? The next thing they move to a silver, then there's going to be a lot of people on the other side of that trade realizing that should silver go up 10 to 20% on one day. Gold didn't move that much, nor the commodity moved that much, but silver. So at some point, though, people are going to catch on and will quickly bet against these speculative trades. And you're going to end up getting a wash. And so I think that's what really is going to come out of this. I guess if Mike Cuban is right, is that there's nothing immoral, there's nothing illegal. Maybe there's a new entrant into the market, and it's this band of retail investors. But they will be squeezed out very quickly.
Oh, I understand that, and these are very specific stories. But the fact that you say hedge funds are going to right-size their positions and not become so overly exposed again, that implies that there is an impact, even if it's in how portfolios are managed. There is a more lasting impact on how we trade collectively than before. We know that this is a force that can actually make an impact and have ripple effects on the market now.
Well, I guess I look at it a little differently in terms of what happened last week with GameStop, which was it was a very esoteric, specific development. And maybe you can argue that it's good news insofar as if there's any other hedge funds out there that aren't managing their risk. Okay, as a hedge fund manager, you have to manage your risk every day appropriately. And so somebody discovered an anomaly, or a whole bunch of people, and leapt on it through call options. So you have leverage on top of leverage, and it causes these exaggerated moves. So that part of it is actually good news, in the sense that if I'm running a hedge fund, this is actually a real splash of cold water to make sure that I'm focusing on my risk exposure. So that's something different. These new band of investors that are creating this volatility, this will get squeezed out, because if they're not investing, if they're investing on some fad or on some flow, and it's nothing fundamental, it's going to come out very quickly.
Sure. They may be squeezed out, but they may not leave the market. So that's chapter 2, perhaps. David, great to speak with you.
They'll learn their lesson the hard way. That's what's going to happen.
Perhaps. David, thanks. David Rosenberg. So how will the fallout from the Reddit rebellion affect the planned Robinhood IPO? Let's bring in Leslie Picker right now. And Leslie, I don't know how that additional capital raise is viewed at this point.
Yeah, that's the key question, Melissa. With Robinhood and its advisors, they're all grappling with what to do in terms of the IPO moving forward. The company has several class action lawsuits, congressional hearings, hordes of customers who are fed up by the recent trading restrictions. But Robinhood also has record app downloads and a need for capital to meet those regulatory requirements amid volatility in certain pockets of the market. And that, of course, is despite having raised more than $3 billion in just the last few days. So that, of course, brings us to the IPO. I've been told it's been deprioritized as Robinhood really fights fires on a multitude of fronts. The company wasn't really close to debuting anyway. Its filing hadn't been made public. No official IPO date had been set. This recent crisis, though, and this recent turn of events could affect a few things. Number one, valuation. Reports suggested that Robinhood was targeting about $20 billion for a price tag in the deal. That figure could move up and down depending on how recent events unfold. Number two, method. Does Robinhood still pursue a traditional IPO method to go public, or does it do something like, say, a SPAC merger? And number three, timing. When is the right time for a debut, guys?
Leslie, is there any thought that perhaps the regulatory environment might ding its valuation or perhaps delay the IPO even further if there are questions surrounding the payment for order flow model, which is basically its business model, then it's got a big problem.
Yeah, so one thing I'm trying to figure out is what this most recent equity infusion, what that has meant for their valuation. Has it helped it go higher? Has it gone down? Because on one hand, you could say that there are all of these downloads that have taken place as people really draw more attention to Robinhood. But as you mentioned, the company doesn't make money based on the amount of people who are downloading their app. They make money by selling their order flow. And so if there is more regulation that would affect their business model, would affect their way of making money, essentially, then that absolutely, based on what we know at this point in time, that could affect valuation if it impacts their future cash flows.
All right. Leslie, thank you. Leslie Picker. Tyler?
All right, we've got a market flash on Kraft Heinz and Hormel, and Courtney Reagan has the details. Court?
Hi there, Tyler. So both of these stocks moving on news from the Wall Street Journal that Kraft Heinz could be nearing a deal to sell its Planters snack business to Hormel. The deal could be valued at $3 billion. This is according to sources close to the matter in this Wall Street Journal report. You can see shares of Hormel higher by 5.5%. Kraft Heinz off session highs now, but still higher by about 0.6% on this report. You might recall that Kraft Heinz has been going through a process of divesting brands as consumer tastes have changed, although we know that there's been sort of a harken back to nostalgic brands during the pandemic as well. So perhaps a little bit of a confusion for should we get rid of them, should you not, depending on how long that nostalgia lasts. But right now you can see shares are both higher for Hormel and Kraft Heinz on this report. Tyler, back over to you.
Courtney, it's too obvious to say, but $3 billion for Planters is not peanuts, right?
It is not peanuts at all. I like that one, Tyler.
All right. Good to see you again, Court. All right. Coming up, we will have more on the retail trading frenzy. Will it make the stock market a more level playing field? We've got those details. Plus, a new Bitcoin fund could hit the public market. We'll talk to Bitwise about why it is filing now and whether this is a good sign for future Bitcoin ETFs. More Power Lunch right after this.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market. As you say, the increased retail activity in the market and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
We created karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, Blake Mykowski. CNBC.
Bitcoin hovering around 35,000. The recent boom in the cryptocurrency driven in part by more money coming from institutional investors. Bitwise Asset Management, a crypto asset manager, is hoping to capitalize on that, filing for its Bitcoin fund to trade publicly. It sees this Bitcoin-specific fund as a rival to Grayscale's Bitcoin Trust. Joining us now is Bitwise Asset Management Chief Investment Officer Matt Hogan. Matt, good to see you.
Thanks for having me on. Excited to be here.
So we know how to compare this. We're looking at GBTC. The expense ratios are different. Is that where you hope to differentiate yourself?
That's the big point of differentiation. Both Grayscale and us have been managing money in the crypto market for a number of years, well established. We use institutional custodians. The big difference, we're charging a 1.5% fee. They charge a 2% fee. Obviously, they're larger and more liquid, but we want to give investors a choice if they care about fees from a reputable, established manager. So that's why we're bringing this out to public trading, hopefully.
Can you explain that they're more liquid part of the equation? That caught my attention.
Sure. It's just like in the ETF space. You know, often the first mover in the ETF market becomes the larger fund, and there's more trading, and it's liquid, easy to trade. Then you get new entrants that come in with lower fees, and maybe they have a little bit less liquidity. Maybe you have to trade it a little more carefully. Maybe it's better for long-term buy and hold investors as opposed to short-term traders. So really, different funds serving different markets. We specialize in serving professional investors and people who want to take a long-term allocation to crypto. And for those people, fees really do matter. They add up over time.
Presumably, though, as this particular fund, should it get the green light, it gets bigger and bigger, it will be as liquid, I would imagine, as a larger fund like a GBTC. Is that correct?
I love what you're saying, and I definitely hope that's true, Melissa, and that's our plan. So over time, yes, we would hope that it gets more liquid, and that's our expectation. And again, we've seen it time and time again in other parts of the market covered by ETFs. This isn't an ETF, it's an OTC traded trust, but the same rules should apply. People care about fees, they care about quality. Hopefully we're giving them both.
You know, Matt, I know you, our viewers know you primarily from ETF.com and Inside ETFs. And so I wanted to get your take on what was going on with GameStop and the ride it's put some specific ETFs on along with it, namely the retail ETF, for instance, even the Russell 2000 for that matter. GameStop, for a brief period of time, was the largest component on the Russell 2000. What's your take in terms of the impact on sort of the narrower ETFs out there?
Yeah, I think it does expose a risk, which is when you get those very narrow ETFs that very select stock baskets and you get significant run-ups, you can see single securities coming to be a big part of that portfolio. I think we're all wrestling with the implications of GameStop, not just on the ETF market, but on other parts of the market. You know, I think we'll see probably ETFs take a little bit more discretion around the edges in these unusual circumstances if they continue this way. But it is something for ETF investors to think about and be aware of. Just because it's an ETF doesn't necessarily mean it's diversified, right? We've come a long way from the spiders of the world that give broad-based exposure. We now have very narrow ETFs. They can be very interesting, very exciting, very good for portfolios, but you do have to be careful, and what you're pointing out is one of the reasons why.
Are you going to go with a Bitcoin ETF? Do you hope to, let me rephrase that. Do you hope to have a Bitcoin ETF, and what do you think that will do in terms of assets in the market for Bitcoin?
Absolutely, Melissa. We're working day and night and have been for years on trying to get a Bitcoin ETF approved by the SEC. And it's not just us, it's other asset managers. I think it will open up the market to a large number of investors. Look, there is no perfect way today to get exposure to Bitcoin. You could buy it on your phone, but there's security risk. You could buy through one of our funds, but maybe there's paperwork risk or premiums and discounts that come with these OTC traded trusts. An ETF would make it push button easy. So of course it would bring more investors into the market. I think it's going to happen. The question for investors is, do they want to wait until it's push button easy, or do they want to use one of these other alternatives to get in before that happens? And that's just a choice that every investor has to make, and different investors will weigh it and decide differently.
Matt, great to see you. Thank you.
Thanks for having me on.
Matt Hogan of Bitwise. Tyler.
Melissa, thank you. Still ahead, stocks are soaring as we await Alphabet and Amazon earnings after the bell. We'll explain why it could all come down to the cloud wars. Power Lunch, back right after this.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
This budget is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5 in the year in which the spending happens. The 2.5% of GDP spending on the infrastructure can translate into between 5.5 to 6% of GDP just from the infrastructure. This would be, of course, adding to the V-shaped recovery. The healthcare spending that's actually a signature moment in India's history in terms of the emphasis on healthcare. All right, the Reddit-fueled
The Reddit-fueled stocks all plummeting today, a loss for the so-called little guys who banded together to gang up on hedge funds. But all's fair in love and war and trading, right? Robert Frank joins us now with the numbers on who owns stock and how much. Robert?
Hey, Tyler. Well, one of the big questions here is whether all this retail trading boom actually democratizes the stock market or actually alienates an entire new generation of investors. And this is important because the top 10% of Americans now own 88% of all corporate equity and mutual fund shares. That is among the highest shares on record and actually above the pre-pandemic levels. Now, the peak for American stock ownership actually appears to be back in 2002, when about 67% of Americans said they owned stocks. Now, about half of all Americans don't even have any participation in the stock market, even if you include retirement accounts. Now, the concentration is especially high at the very top. The top 1% now owns more than half of all stocks. They gained over $6 trillion in wealth since March. Now, generationally, today's millennials also lagging way behind the median value of their stock holdings, about a third less than Gen Xers at the same stage in life. You look at the disparities along racial lines, those are also getting worse. Stock ownership by Black and Hispanic households, now about half of that of white households. So, Tyler, we need more Americans involved, have a stake in this market. We'll see when all the dust settles from these trades whether some of them stay in.
Well, you know, this is a fascinating topic here about inequality of wealth, inequality of stock holdings. And of course, I guess my feeling here is that if you don't have discretionary surplus cash, it's very hard to get started in stock owning. If you are working just to pay the rent and put food on the table, it is very hard to separate out 1, 2, 3% of your earnings into a 401k or to open a stock market account separate from that.
You're absolutely right. And you add to that the student loan problem. The generation, you look at millennials and Gen Y, the amount of student loan debt that they had to take on to get through college, you know this, that made it even more difficult to save. And so one of the ideas out there, which has gotten a lot of bipartisan support, is the idea of a baby bond. When someone's born, you give them either $1,000 or $2,000 or maybe a $5,000 loan that they could then put in the stock market and have that throughout their life. So even if they have trouble saving and investing early on in life, they will always have that money that was socked away when they were born. So that's one idea that could gain traction in the Capitol.
All right. Robert Frank, thank you very much. Melissa.
Ahead on Power Lunch, big tech on deck. Alphabet hitting new highs ahead of its earnings after the bell. Amazon's also on deck. What should we expect from both companies? Growing cloud businesses, plus putting the pedal to the metal. CarParts.com up 30% just over the past month. The CEO will join us. And as we head to break, February is Black History Month, and we are honoring some of our CNBC contributors. Here is the host of NBC's American Ninja Warrior, Akbar Baja Biamia, on his professional inspiration.
Two people that really inspire me, I'd have to say LeBron James and Maverick Carter. I love the teamwork that they have. You can see the camaraderie, you can see the business partnership, but I think the overall message is you can bring and trust people from your community to move you forward. That's the big inspiration in their partnership.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Can a recovery be equal, green, and united?
There is a direct link between vaccine and economic recovery.
The journey seems to be a little bit delayed, but should not be derailed.
We do need some more fiscal stimulus to continue to bridge the gap. There's still an enormous amount of uncertainty.
New targets of climate change is an opportunity for innovation.
That's all coming up on CNBC's virtual Davos debate, Restoring Growth.
one of our primary focuses for 2021 is really to expand our footprint outside of Indonesia. I think, over the last few years, we've definitely invested relatively smaller amounts in our markets outside of Indonesia. But we think this is the year where we really want to spread our wings and be a regional and global business. And food delivery is part of that plan.
And here is your CNBC COVID update at this hour. As it tries to get more Americans vaccinated quickly, next week the federal government will be sending 1 million doses to more than 6,500 pharmacies around the country. That's with an emphasis on minority communities that have been hit hard by the pandemic, and that's on top of the allocations already going to states. 401 law enforcement officers have died due to COVID-19 since the pandemic began. That's according to a new count by the Fraternal Order of Police. It says that almost 100 of those have occurred in Texas, the top state on the list by a wide margin. And Andrew Yang, who ran for president last year and is now running to be New York City's mayor, has tested positive for COVID. In a statement, he says that he has mild symptoms but is otherwise feeling well and in good spirits as he quarantines. And you are up to date. I'll send it back to you, Tyler.
Rahel, thank you very much. And let's take a look at the markets right now. Very, very healthy day for stocks, especially the Dow, soaring 550 points or thereabouts. As you see at 563 now, a nearly 2% gain. Both NASDAQ and S&P 500 are up more than 1.5%. So is the Dow, for that matter. The laggard here, relatively, the Russell 2000 up 1.1%. Oil market closing for the day. Courtney Reagan has the numbers. Court.
Hi there, Tyler. So oil rising by more than 2% for the second straight day today as OPEC production curbs continue to give support to those prices. Brent is finishing above the $57 mark while WTI hits its highest level in more than a year. In January, OPEC did increase production for the 7th month in a row, but the growth was smaller than expected, according to a Reuters tally. Winter weather in the Northeast and cold forecasts elsewhere have also given a boost in demand for fuel, though natural gas trading closer to the flat line after an 11% gain yesterday. Melissa, over to you.
Courtney, thank you. Amazon and Alphabet higher today ahead of their earnings after the bell. The Google owner hitting new highs. Big expectations for both names, especially from their cloud businesses. Microsoft delivered strong results last week from its intelligent cloud unit, which includes, of course, Azure. Last quarter, Amazon reported more than $11 billion in sales from AWS and Alphabet more than $3 billion in revenue from Google Cloud. It does plan to break out costs and profitability for the first time this quarter. Here now to dig deeper is Aaron Kessler, analyst at Raymond James. Aaron, I know you're going to be really busy after the bell tonight. So what is the first metric you're going to look for in Amazon's report and in Alphabet's report?
Yeah, so Amazon's really all about, I would say, a combination of sales and profitability here. So we're looking for total revenue growth of about 35%, slight moderation in the online growth versus Q3, but still strong growth. They had Prime Day in October as well, which should benefit them. Additionally, Amazon Web Services, we're looking for about 29% growth, similar to Q3. If you looked at Microsoft, it was fairly similar Q3 to Q4 as well. We're looking for a fairly stable growth in the 30% range. Advertising growth for Amazon, also looking for strong growth, right around 38% year over year, slight decel from Q3, but strong there as well. And then GAAP operating income, about $4.4 billion is the number we're looking for. They still have a bit of a headwind from COVID, but we think that those comps will get easier in 2021 as well. On the Google side, we're looking for net revenue growth of about 18%. That's actually an acceleration versus the 15% in Q3. Our channel checks generally indicating a re-acceleration of growth as the economy reopened. Specifically on search, we're looking for about a 5-point acceleration from 6% in Q3 to 11% Q4. In YouTube, looking for about a 7-point acceleration from 32% to 39%. On the cloud side, as you mentioned, looking for strong growth there for Google as well, about 44%. I think the profitability is less important at this point. We want to see them continue to grow at a healthy rate, and margins will come later.
For both of these companies, Aaron, we're going to come to a point where it's going to be more difficult comps. Both of them did pretty well during the pandemic, particularly for Amazon. So how does Amazon sort of keep the momentum going, and what is already priced into the stock at this point?
Yeah, definitely on Amazon, you're going to have tougher comps in 2021. On the e-commerce side, that was clearly a tailwind for a number of e-commerce companies. We are looking for moderating growth into maybe the 10 to 15% range, especially in Q2. However, as we talked about, you've seen a big headwind of about $10 billion this year on the operating income side from COVID. We think that'll ease in 21 as well. So even though revenue growth will slow, you're likely to get some profit improvement in 2021. On Google, you actually have the opposite situation. We had pretty tough, easy comps in Q2 as with Google search. People are doing less searches early on, specifically in the travel sector, which was a big headwind. And we're starting to see a re-acceleration in travel spending as consumers start to anticipate maybe traveling in the second half of this year. And so comps on the search side, as well as YouTube, will be fairly easy in Q2 and then get tougher as the year goes along, though.
How should we think about the pickup in travel and Google? You know, you don't think of Alphabet as a reopening play, but maybe investors should.
Yeah, we think travel represents roughly 10% of their search revenues, and that almost went to zero in kind of Q2 of last year. And so that's kind of pure kind of revenues that should come back, especially in the second half of the year. But even we're starting to hear that travel advertisers are starting to come back at a healthy pace, even in Q1 here, anticipating that stronger second half recovery at this point. So specifically on the travel side, we do expect a stronger growth there, which should boost overall Google search volumes. That plus e-commerce continues to be the biggest part of Google search. We're expecting a pretty decent 2021 for Google search revenues.
All right, Aaron, great to hear from you. Thank you.
Great, thank you.
Aaron Kessler. And for more on Amazon, go to cnbc.com/pro. A great write-up on what every major analyst is expecting from the company's report. Tyler.
Melissa, the markets are rallying today ahead of those earnings that we expect later. The Dow leading the way, up nearly 2%. S&P 500, NASDAQ up very sprightly as well. But GameStop and the Reddit stocks, they're sinking. We will show you those names and all the big movers next on Power Lunch.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC. Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
today's Power Movers. We cannot discuss movers without taking a look at the big declines in the so-called meme stocks. GameStop is down more than 50%. It's back below $100. AMC, Cost Express, all down more than 35%. But take a look at the year-to-date changes. They are still big winners on the year. DraftKings is rallying today. Cathie Wood and ARK Investments disclosing a stake of 620,000 DraftKings shares. That is part of the firm's next-generation internet ETF. And we end it with pot stocks continuing to rally as cannabis regulation gets more favorable across the globe. There has been movement in Portugal and France, and many are looking at Mexico as the next country likely to legalize. All of the stocks on your screen have doubled in the past 3 months. Now let's get to Seema Modi for Trading Nation. Seema.
Hey, Melissa, Chipotle, that's the stock we're talking about today, hitting a record high ahead of its earnings after the bell. A trifecta of menu innovation, a strong digital platform, and an affordable price point, setting up a strong quarter. So will the company deliver? And what can CEO Brian Nichols say to keep the bullish story intact? Your Trading Nation team today is Marc Tepper of Strategic Wealth Partners and Gina Sanchez of Chantico Global and Lido Advisors. Marc, what really stood out to me was Chipotle's plans to hire an additional 15,000 workers here in the U.S. Does that tell you that demand is expected to remain strong even as restaurants reopen and consumers are presented with more food options?
I would say so. I mean, you know, one thing that they're really doing very well is they're rolling out additional units, specifically units with drive-thrus, which is great. I mean, that's obviously where we're headed as a country. But when it comes to Chipotle, look, I love the company. I love what they've done. I love what they're doing right now with rolling out these new stores. But I don't love the valuation, right? Look, they've done a great job of evolving the menu to target customers that wouldn't have eaten their food before. Keto, vegan, paleo. Like I said, they're rolling out new units with drive-thrus. They're doing everything right, but the price, in my opinion, already reflects that. The valuation right now is like $43 billion. It's kind of priced for perfection. So, Seema, you mentioned digital, mobile, delivery, unit growth, all that stuff at the beginning. If that's what we're trying to play, I would personally rather do that through Wingstop. Now, that's a $4 billion company rather than a $40 billion company, and it's Super Bowl week. I mean, I'm focusing on wings and pizza right now over burritos, honestly. So, look, with Wingstop, they have an asset-light business model that leads to better gross margins. It's a very quick ROI for franchisees, which further drives additional unit growth. It kind of reminds me of Domino's Pizza about 5 years ago, and we all know what happened to Domino's over the course of that time frame. It basically quadrupled. So that's how I'd play this trend.
And both Domino's and Chipotle, they both had that digital strategy working for them. Gina, Chipotle, speaking of valuation, trades at 40 times forward earnings. Is there something that CEO Brian Nichols could say tonight on the earnings call that would make you less concerned about the valuation?
No, I actually think that valuation, definitely has a lot of positive priced in. You know, if you look at the forward expectations or even the targets that we're expecting this evening, I think we're expecting something like 7% same-store sales growth, opening of 200 new stores, and, better margins. There is no way that that gets over 40 times forward earnings. I think that's the big fly in this ointment.
All right, well, the stock, we're watching it closely ahead of earnings out after the bell. Gina and Marc, great to have you both on. And check out tradingnation.cnbc.com, where we debate the mega cap stock rally ahead of Amazon and Alphabet earnings. That's on Trading Nation. Mel and Tyler, back to you.
All right, Seema, thank you. Check out shares of carparts.com. Up nearly 40% in just 1 month. The stock has a high short interest, however. So has the gain been based on fundamentals or short selling backlash? We will ask the CEO next on Power Lunch.
And now, the latest. The countdown to the close of the U.S. markets is sponsored by IG.
Sullivan.
Good morning.
Worldwide Exchange on CNBC.
BP under pressure today as the group reported its first annual loss in a decade, citing a brutal year for the oil industry with the pandemic sapping demand.
Negative prices, fuel demand down
14%, aviation down 50%, and of course we had adjustments to our planning prices, which resulted in impairments and write-offs. But imagine if we were sitting here today with no vaccine. I've lost track of the number of vaccines that are out there now. So that is the underpinning of the recovery here.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared Ireland would look like into the future.
Ireland's Prime Minister of the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Welcome back, everybody. The Reddit trade reversing with many of the stocks that fueled last week's mania, like GameStop and AMC, all tumbling today. CarParts.com is another stock that has been heavily shorted and seeing some volatility. The stock is down this week, but up more than 40% over the past month after the launch of its new shopping platform for electric vehicle, not electronic necessarily, but there's a lot of electronics in it. Trust me, electric EV parts. Lev Peker is the CEO of CarParts.com, and we welcome him now. Lev, welcome. Welcome back, actually. Good to have you with us.
Thank you so much for having me.
Let me ask you about the high short interest in the stock in light of what's been going on in the market. As I understand it, you've got about 40% of the shares are being shorted. Is that of concern to you, or do you just play past it? How do you handle something like that?
Yeah, so we have about 46% of our float that's short right now. And, we're really focused on building a great business and on delivering on our mission to our customers, which is to get them back on the road. And, the short thesis on our stock is that, we're a COVID play, and that once COVID is over, people will go back to shopping the way that they used to. However, we haven't really seen a slowdown in our business. If you think about our Q3 results, we grew 70%. And we grew 3 to 5 times faster than our closest competitors. And so we'll continue building a great business and focusing on solving a customer problem. And, the short interest will work itself out.
Sure. At the same time, though, there is this rise in your stock, Levin. So I'm curious as to how you are thinking about additional capital raises. I know you gave it an interview recently, and you said that you would be open to it, that would be your obligation to shareholders. Are you poised to do so? Do you have a registration with the SEC? It looks like the last registration you had was back in August when you did a capital raise. So it looked like it was associated with that capital raise back then.
Correct. So we do have a shelf. So we filed a shelf last year for $250 million, and then We raised $65 million. We don't have an immediate need for capital today, but as valuations change, I think for some companies it's kind of a way to make something a reality. If you look at a company like Tesla, they kept raising money at higher and higher valuations, and that allowed them to grow into the valuation that they received. So we would definitely be open to doing a raise depending on the valuation. But we want to be very, very targeted and very specific about at what price would dilute our shareholders. And so depending on the valuation, that's kind of how we think about the capital raise.
The company is performing well right now, Lev. In the last week or so, you introduced a special sort of part of your website that will sell car parts for electronic vehicles or electric vehicles. I keep saying electronic. Electric vehicles. How is that going? And over time, what percentage of your revenue do you expect those parts to be compared with car parts for conventional fossil fuel vehicles?
Yeah, so a common myth is that, electric vehicles and combustion engine vehicles have different parts. 93% of parts are actually pretty similar. You look at bumper covers and fenders and door handles and headlights and taillights, like all of those parts are the same, whether it's a combustion engine or an electric vehicle or a hybrid vehicle. And hybrids actually have even more parts than a traditional vehicle because they have both an electric component as well as a fuel-powered component. So those cars have even more parts than a traditional vehicle. If you think about where GM is going, so 2035, all new cars sold by GM will be electric. California announced something similar where, by 2035, all cars will be electric that are sold in the state. Our sweet spot is a 6 to 12-year-old vehicle, but we believe in making the investments today to start building a destination for consumers and to continue delivering on our mission of getting drivers back on the road, regardless of what vehicle they own and what vehicle they drive. And I think our percentage of revenue will kind of follow the penetration of electric vehicles and hybrids into the overall car park. So as those cars get, penetrated more and more, we'll see more and more sales coming from those vehicles.
Talk to me about how your business reacts to the economy broadly. Do you do better relatively when the economy does worse because people are keeping their cars longer, the consumer pulls back? Or do you do better when the economy does better?
Yeah, so there are two things there. One is when the economy gets worse, people keep their cars longer, and then they also buy used cars instead of new cars. And we've seen that play out last year, where sales of new cars fell to about 7 million in the U.S., but used cars were flying off the lots, and actually the pricing of used cars increased. And so that's one trend that kind of helps our business. The second trend is more people, when the economy does worse, more people are looking to save money. And so they do more repairs themselves instead of taking it to a shop. And again, you can watch a video on YouTube, 15 minutes of your time, and you could save quite a bit of money by shopping online, buying your parts and doing the repair yourself. So our business is kind of counter-cyclical. When the economy does worse, we do a lot better.
All right, Lev, thank you very much. Lev Peker, carparts.com. We thank you. Melissa.
Tyler, the Dow holding on to a very nice rally. It is now up nearly 600 points, 583 to be exact. We got Goldman Sachs, Disney, and American Express leading the way higher. And don't forget, you can always watch or listen to us live on the go on the CNBC app. We'll be right back.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
And if you have all this stuff you don't want to be asked about, maybe don't go on a show called All Things Considered. They mean all things. If you don't like questions, I think Fox News has a show called No Things Considered.
Siemens Energy has announced it will cut almost 8,000 jobs by 2025 as part of a cost-cutting program. It comes as the German company returned to profit in the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world, it's now always keeping the balance. On the one hand, really driving the growth part, and at the same time improving the areas where we see more challenges in the market, like oil and gas.
Well, two of the big stories today, folks, the rise in Bitcoin as it goes up a great deal. But eclipsing that really is this massive move in the Dow Industrials, up nearly 600 points right now, almost 2%. The S&P roughly the same for NASDAQ. Maybe it's relief from the Reddit spasm of last week. Maybe it is a realization that a big stimulus package may be pushed through by the Democrats alone. Whatever. Melissa, stocks are up.
Yep, and one stock that is up a lot, we hit this in the Power Movers, Tyler, is DraftKings, on news that Cathie Wood's Next Generation ETF is taking a stake in it. And Cathie Wood of ARK Investment seems to have the magic touch, the Midas touch, in terms of the stocks she chooses. And this is partly technical because a lot of flows have gone into ARK Investment, which propels buying of these shares. But part of it's just that they've seen the vision that Cathie Wood has, and we're going to have much more on this tonight on Fast. So I'll see you then, Tyler. Thanks for watching Power Lunch. Closing bell starts right now.
It certainly does, Tyler. Melissa, thank you very much. Welcome to the Closing Bell, everyone. I'm Wilfred Frost with Sarah Eisen. Stocks ripping higher again. The bounce back from last week's sell-off continues. Let's have a look at what's driving the action. The unwinding of the meme trades, GameStop, AMC, Silver, all lower today as equities broadly climb higher. We'll have more on that dramatic dynamic in the markets coming up. Earnings continue to come in strong. UPS, Exxon, Alibaba all beat this morning, and more cross in just an hour, in fact. And while it's not GameStop, some other momentum plays are in the green. Uber is up big on an alcohol acquisition. DraftKings, as Mel just said, surges after Cathie Wood starts buying a new batch of SPACs, also hitting the tape. The Dow's up nearly 600 points there, not far from the session highs of about 2%.
Financials in the lead today. Coming up on the show, Allianz Chief Economic Advisor Mohamed El-Erian says the moves in silver, GameStop, and the broader S&P 500 are all connected. He's going to join us to discuss what could happen next. Plus, we are counting you down to one of the most important afternoons of earnings season. Amazon, Alphabet, Chipotle, EA Gear set to report results. We've got a great lineup of experts to break down the numbers and tell you what to do with the stocks. But let's begin with the broader market rally. Stocks higher as we head into the final hour of trade. Let's get straight to Mike Santoli with a closer look at the action, Mike, with all sectors working right now.
Yeah, it's very broad, with the exception, of course, of those sort of epicenter Reddit stocks that are on the decline. Take the pressure off some of the portfolio restructuring. That shakeout last week, 3.3%. We've gained back most of it. This is a two-year chart of the S&P 500. You've actually been hovering since roughly noon at a level right below where it sort of fell apart in the middle of last week. So we'll see if it can recover further from that. I did want to point out early 2020, late January into early February of 2020, that's when you had this little oopsie right there. It was a very, very orderly uptrend from the fourth quarter of the prior year, just like this one was. You did have this big gut check. It hit the 50-day moving average, as this did, and then you resumed higher from there. Now, I'm not predicting the fall off the cliff because that was obviously a outside shock that struck the market. The point being is we might have been in the market for a little bit of an excuse to back off some anyway. Take a look at some of these sort of risk appetite indicators, subsectors of the market. You guys are talking about, ARC investment, ARC innovation. That's kind of the flagship, almost back to the highs. It's been a pretty big bounce over 2 days. The IPO, similarly, it's actually a little bit below. Semis are underperforming. Actually, software is flying today. Semis are not doing quite as well as the broad market. So we'll see if that's a little bit of an overhang. They had a great run and obviously a little bit of a mixed response to some of the earnings that came out of that group. Globally, let's remind people, we've been fixated on GameStop, Reddit, all these local domestic stuff. Over the 6-month period, the emerging markets and non-U.S. stocks have been well outperforming the S&P 500. That at least reinforces the notion that it is a global move. It's a global recovery move. Of course, the dollar has been rebounding, so we'll see if this can continue, guys.
Dollar rebounding, though, given up some of its gains today, only up 0.25%. The other sort of standout move, Mike, I guess, having risen above 30 quite comfortably, 2 big days of declines for the VIX. Is that a bullish signal?
It is. I mean, it's a confirming bullish signal. In other words, it's not something that's leading us to say that this is up and away from here, but it absolutely shows you that there is a dramatic tension release happening. And the fact that we had an elevated VIX often tells you that, if we get a sell-off and it's quick and doesn't really have some selling momentum that follows it, the VIX already kind of handicapped some rough patches, so that means it can bleed lower and the market's maybe on some more stable footing.
All right, Mike, we'll see you in just a few minutes. Dow's up almost 600 points right now. Despite today's broader market rally, shares of GameStop and other Reddit retail trade names getting slammed for a second day in a row. GameStop down 57% right now. You can see the carnage across AMC, Cost, Express, BlackBerry, all those shorted names. Mohamed El-Erian joins us. El-Erian, former PIMCO CEO, Allianz chief economic advisor. Mohamed, there was always going to be a limit to how much money retail traders could put behind these names. Is that it? Did we see the end of it?
In large part. I mean, the limit came much faster because they were restricted from buying more. And if you are going to implement a short squeeze, you need to continue to keep the pressures on the shorts. And because they were frustrated and distracted to talk about silver, to talk about other things, yes, that trade has now died down enormously, which means it's a green light for the rest of the market to go up because we no longer have the threat of degrossing.
Well, explain that further. What does it have to do with the rest of the market, the broader market?
So where was the pain trade? And, they always tell you, figure out where the weak hand is, because if you don't know where it is, it's you. The pain trade was in hedge funds that had shorted way too much of a handful of stocks. So when they came under pressure, either they had to come up with more cash for margin calls, or alternatively, they had to cover their shorts, which means they needed cash. What did they do? They sold their longs. So think of balance sheets contracting. So the people on this side, on the other side of the shorts, make a ton of money, GameStop, and the people on this side holding equities lose because there's a massive selling going on there. Now, that was a dynamic last week, a degrossing. With the short squeeze over, you no longer have that. So buyers on the dip now have the green light, and they've done what they've done repeatedly, and it has worked well for them so far.
So that was the theme of last week, as you said, Mohamed. What about next week or next month if retail investors, or any investors for that matter, start to feel the pain from having been long the likes of GameStop? Do they start to dump their longs, whether that's the Bitcoins of this world or the S&P 500 trackers of this world?
So my sense is that trade was concentrated among a certain segment of retail investors who had enormous power because they came across a really smart trade and were able to coordinate. I don't think it has broad implication, but there is another issue in play, and you'll hear me repeat it over and over. All this is enabled by tremendous liquidity and very low cost of borrowing. So both sides of this trade had leverage. Both sides of this trade involved margin. So don't underestimate that the signal all along is this market is really extending far, with people going well beyond the natural habitat, piling on risk, And that is something that we are witnessing every single day.
Yeah, I mean, it's a great disconnect that you've been talking about for a long time now between the markets and the economy and the fundamentals. So liquidity spigot is still wide open, Mohamed. Does that mean that this could easily happen again?
Yeah, what you saw is what my friend and colleague Robert Kohlensberger says: you get illiquidity in the midst of liquidity. The hedge funds that were short faced illiquidity in the midst of liquidity. And we came, I want to stress, we came very close to a market accident. And you've heard me say that among the four things that can disrupt this rally, two we have to keep front and center. One is the possibility of a market accident, and we came close. Ask yourself, why is Robinhood raising so much money after last week? And the second thing is, you haven't mentioned yet, the yield curve is as steep as it has been for the last 3 years. Keep an eye on that as well. Those two things are risk factors. They're in the risk scenario, not in the baseline scenario, they're in the risk scenario, but they are risk factors to this wonderful rally we are experiencing.
But Mohamed, expand for us on that second point about the yield curve, because clearly, as you said, it's steep and 110 is high relative to where the 10-year was 6 months ago. But it's not high in long-term perspectives. And on top of that, most importantly, the Fed continues to commit almost unreservedly to keeping the short end very low. So what levels and which part of the curve will matter for the broad equity markets?
So the Fed has already told you that they're worried about this. Think about their verbal intervention after the 210s steepened a lot in the first full week of this year. They don't want to see interest rates go up too quickly. Why? Because it threatens the equity market. It does two things. One is you can no longer argue, Tina, there is no alternative to equities if bonds start paying something. But secondly, all these very strong buy signals that come from models with discounted cash flow become weaker. So the Fed, if this continues, and it continues if people continue to price in high inflation, the Fed will be faced with two choices that it will not like. Either it has to do more implicit or explicit yield curve control, or alternatively, it has to risk a financial market volatility. And the Fed doesn't want to go there. So just keep an eye on what happens to those 210s as we go forward from here.
Mohamed, great to see you. Thanks for joining us.
Thank you.
Mohamed El-Erian there. Up next, the stimulus conversation front and center once again in Washington. But can a deal be reached that satisfies both sides of the aisle? We'll speak with someone who's involved in those discussions for years in the last administration, Marc, the former chief of staff to Vice President Pence. You're watching Closing Bell on CNBC.
Is to light up a civilization. To purify a waterhead is to last a hope. To build a trackway is to facilitate connectivity. To develop an algorithm is to offer one more possibility to the world. Shanghai Electric. Beyond Shanghai. Beyond electric.
The countdown to the close of the U.S. markets is sponsored by IG.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market, as you say, the increased retail activity in the market, and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth.
and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
We really think about the farmer. We need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch on CNBC.
Minutes left of trade, another strong rally day on Wall Street. Stimulus negotiations are ramping up once again in Washington. Ilan Moy with a look at where things stand right now. Ilan.
Well, Sarah, Senate Democrats just had a virtual meeting with President Biden and Treasury Secretary Janet Yellen, where the administration argued their case for Biden's $1.9 trillion COVID relief package. Now, this comes as both the House and the Senate are starting the process to pass a bill without any Republican support. And top Senate Democrat Chuck Schumer said that Biden is totally on board with that plan.
We share President Biden's desire to advance this legislation in a bipartisan way, but the work must move forward. We are not going to dilute, dither, or delay, because the needs of the American people are just too great.
But there is some resistance within Biden's own party. Democratic Senator Joe Manchin of West Virginia said that he does not support the $15 an hour minimum wage that's in Biden's proposal. Still, Manchin said that he would vote to move forward with this process, but he expects, guys, that the actual bill would be targeted toward the COVID crisis. Back to you.
Ilan, thanks so much for that. Much to discuss on stimulus and other areas in Washington. Let's bring in former Chief of Staff to Vice President Pence, Marc Short. Marc, good afternoon to you. Thanks for joining us.
Well, thanks for having me on this afternoon.
Well, want to get to stimulus in just a moment and other latest developments in Washington, but wanted to start with the final days of the Trump administration. You were, in fact, barred from the White House at one point because of the stance the vice president took towards the president. I wondered how that left you feeling as you left the White House at the administration end. Were you a supporter of the administration or a critic?
Well, Wilf, I'm very proud of a lot of the things that we accomplished over the 4 years in the Trump-Pence administration, and was very honored to serve. And I was very proud of the vice president and the courage he showed on January 6th. I think that you know, unfortunately, there was some bad advice, I think, that was provided to the president about certain powers that the vice president may or may not have. I think the notion that anyone would believe that our founders would bestow upon one single person the ability to throw out election results, I think is pretty absurd. But the reality is that we accomplished a lot in those 4 years. I think there's a very good record that the president has that he can be proud of over those 4 years.
To your point about those final days and weeks, if it is the case that the vice president and his team, yourself included, showed courage in standing up to the president around January the 6th, do you regret not showing that courage a little earlier in the weeks ahead when it was clear that the result... I mean, were you showing it behind the scenes and counseling the president to stop challenging the result of the election?
Well, Wilf, I think that the vice president was very clear with the president throughout the process about what he believed his functions under the Constitution would allow. But to be clear, I think that when I say the vice president's courage, it was in that moment when Despite people attacking the Capitol, the vice president never vacated the Capitol. He stayed there, was in constant communication with the leadership, and said, we're going to finish the vote and the work of the American people tonight. And he was one of the leaders in making sure that there was not a delay and that the various protocols were followed and that the Senate and House came back together and completed work that night, roughly at about 4 a.m. So I think that's the courage that I'm speaking of.
One more for me on this one, Marc, and that is,
Sarah.
what is the status of the relationship between Pence and Trump, and what does that mean for Vice President Mike Pence's future? Is it going to be with Trump or without him?
I think that they've had several conversations that have been cordial in the last few weeks, and I think again that the vice president's very proud of the relationship that they had and what they accomplished. But I think that at this point, the vice president still has a very bright future. But I know that he and his spouse will consider what doors they think the Lord's opening for them and decisions they make in the future. And now it's really not the time for them to be as focused on that.
Marc, looking forward, what is your expectation of bipartisan support for a big stimulus bill in the coming weeks?
Well, Wolf, I think it's really the only pathway forward. I think it's important to remember that thus far there's been multiple bills passed that have allocated $4.5 trillion for COVID relief. And so as you look at what the Biden administration has proposed, there's some things where there's agreement and there's some things where there's not. And as you know, we passed the historic tax relief under budget reconciliation back in 2017 on a very partisan basis. But it's hard to see how many of the things in the Biden plan can muster approval through budget reconciliation. In other words, a Senate parliamentarian would say raising the minimum wage to $15 probably doesn't fit under a budget reconciliation. So a lot of the more controversial elements of their plan will likely fall out anyways. So really their only pathway forward is to find a way to partner with Republicans to get 60 votes. Otherwise, if they pursue a strictly partisan path, there's not really a way to do it because either the parliamentarian will rule them out, or as you just reported, Senator Manchin has already said he doesn't support the increase in the minimum wage that's federally mandated to $15. So really the only pathway forward is to say, how can we marry up with 10 Republicans in the Senate to find a pathway to 60 votes?
Although Senator Bernie Sanders had said that there are, I think, 2 studies that they're going to be citing showing that an increase in federal minimum wage would increase the federal revenues that come in and ultimately the budget. So maybe they can get it through that way. I take your point, but don't you think it's a little hypocritical, Marc, for Republicans to start warning alarm bells over the debt when the Trump administration added $7 trillion over the last 4 years?
Yeah, I think it's a very fair point, Sarah. I think that the reality is that both Republicans and Democrats have failed to show restraint when it comes to spending taxpayer dollars, and I think that that's unfortunate. Having said that, I think even if you put that aside, we can have a very distinct separate argument that says raising the minimum wage to $15, even the nonpartisan Congressional Budget Office has said it would kill between 1.5 and 3 million jobs in America. That's probably not good policy. So even if I can accept your point that both Republicans and Democrats have failed to hold the line on spending, the reality is that some of the pieces of this proposal probably aren't going to be good for the economy regardless.
Marc, I wonder what you thought about whether the terms for stimulus checks should be altered or tightened somewhat. There's plenty of anecdotal evidence and more to suggest that a lot of people have used stimulus checks to invest in stocks. Are those checks meant for spending that is needed to live in the current year, or are they meant for long-term investment and savings, such as investing in stocks?
Yeah, I'm probably somebody who doesn't believe that the direct payments is really good policy. I think that as well, some of the concerns about the unemployment insurance, what we saw with the first bill that we passed that had up to $600 is it became very difficult for people, particularly in the hospitality business, to encourage laborers to come back to work because in many cases they were earning more not to work. I think that's a very bad disincentive. And so I think there has to be an acceptance that a lot of people are put out of work for no fault of their own. And in some cases, the government has forced businesses to shut down. And so extending unemployment insurance makes sense for them, but raising it significantly above the $300, the Biden proposal is $400, I think is a mistake. And I think that many of the direct payments have also proven to be less than beneficial to the overall economy.
Marc Shaw, thanks so much for joining us today.
Thanks for having me, Wolf.
After the break, the short story of GameStop. Mike Santoli hosted a discussion today with noted short seller Carson Block about GameStop and the Reddit traders. We'll bring you those comments next.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. As BP posts its first annual loss in a decade, the CEO Bernard Looney tells CNBC there is light at the end of the tunnel after what was a brutal year for the sector. That story's on the website now. U.S. President Joe Biden will push ahead with his $1.9 trillion COVID-19 relief package, rejecting calls for a scaled-down bill after a meeting with Republicans. But the GOP remains optimistic that there's still a way to meet in the middle. Head online for the full story. And China's economic growth is likely to moderate in the next few months, according to Goldman Sachs. It says Chinese policymakers may begin pulling back on stimulus as the country's recovery takes root. Head to CNBC.com for more. And remember, you can follow us on Twitter at CNBCI.
Dow up 570 points. Shares of GameStop, though, are tanking following last week's furious rally. Earlier today, our Mike Santoli led 2 interviews on CNBC Pro focused on the GameStop saga from the long and the short sides. Mike, what were the big highlights?
Yeah, Sarah, I actually spoke to Tom Lee of Fundstrat and Carson Block of Muddy Waters. Tom, of course, generally bullish on the stock market. Carson, a longtime short seller, looks for companies overvalued, maybe even frauds. Yet they both agreed the GameStop squeeze and crash reflects a new aggressive energy and power from retail investors that's very likely to stay around. Here's Tom on the public's rush into stocks.
That kind of increased participation is very good for markets because, number one, it's going to create a lot more natural buyers and sellers because retail and institutions don't always match. But it's also going to create disruptions to the way Wall Street might have been dominating markets for the last 10 years because now there is a potentially new source of money coming in. I think people are really underestimating how much money that ultimately represents.
Yeah, and obviously we've seen some of that disruption. Both of them also suggested traders on both sides of these meme stock trades had legitimate motivations, but probably both also overplayed their hand a bit in different directions. Here's Carson.
What do I make of GameStop? Obviously, there was very poor risk management by Melvin Capital and maybe some of the other short sellers that were in the name, but I don't see anything illegal that happened here. And in my view, And I don't look. I have to be very clear that I don't understand Wall Street Bet's psychology. I only went on it for the first time about a week and a half ago, and I think this was economically motivated.
Yeah, by that he meant that there was a core fundamental and technical thesis a few months ago on Wall Street Bets that really did hold together and argued for a much higher GameStop share price than existed at the time, below 20, I believe. But then, of course, at some point in this whole rush, it probably got detached from whatever that fundamental thesis was. So both of them finally also really believe that there is an important role for short sellers in general. If you had a market without shorts, people can't take as aggressive a position on the long side, and also you don't get a lot of capital flowing in the right directions if you don't have shorts as a discipline. So you can everybody check out a recording actually of these conversations on CNBC Pro now, guys.
Make sure to check that out, cnbc.com/vote. Plenty of other material on there as well. The countdown is on as Amazon, Alphabet, Chipotle and Electronic Arts all get set to report results. We'll bring you the numbers and analysis as soon as they cross the tape. Some big names tonight. As we head to break, here's a check on bonds. Yields high today, around about 1.10 on the 10-year. Closing bell back in a couple minutes.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
Spotlight.
I think Super X-Bike is actually far more exciting than the Sound Blaster.
So you think you can make a comeback?
I think we should make the comeback given the effort that we put in. If you look back at creative history, there are many times when actually a lot of people that will say you will never get through this because it's so onerous, it's so difficult, and somehow we get through.
Creative Technology's Sim Wong Hu on the next Managing Asia.
CNBC News Update with Rahel Solomon. Hey, Rahel.
Hi, Wolf. Good afternoon, everyone. And here's what's happening at this hour. Let's begin in Florida with a somber police procession. Police transported the bodies of 2 FBI agents killed this morning while executing a search warrant involving child pornography. 2 other agents remain in the hospital in stable condition. The FBI says that a suspect is also dead. And under pressure from regulators, Tesla is recalling nearly 135,000 Model S and Model X vehicles to fix possible touchscreen problems. A Tesla vice president disputes the need for the recall, saying there is no defect. And if you are unsure who will win the Super Bowl, well, maybe Nicholas the Dolphin can assist. He is on a 6-game streak of correct choices. He is picking the Kansas City Chiefs to be this year's champions. Now, there is some disagreement in the poll because a Dolphin named Winter has chosen Tampa Bay. You are now up to date. That is our CNBC News update for this hour. Sarah, the Dolphins have spoken. I will send it back to you.
Maybe they're not always right, like the groundhog, hopefully.
Hopefully.
Rahel, thank you. Rahel Solomon. Silver having a wild week. Up next, we're going to break down the moves with the CEO of Helka Mining. It's the largest silver producer in the U.S. We'll be right back.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
The news cycle is racing along. We have to be checking every bit of it along the way because one false narrative can change the course of how we respond to this pandemic. And we can't let that happen. We're going to do our dead level best to get it exactly right and never tell people how to think about it.
This budget is a dream budget, in my opinion. The infrastructure spending itself in India, typically the fiscal multiplier is about 2.5 in the year in which the spending happens. The 2.5% of GDP spending on the infrastructure can translate into between 5.5 to 6% of GDP just from the infrastructure. This would be, of course, adding to the V-shaped recovery. The healthcare spending that's actually a signature moment in India's history in terms of the emphasis on healthcare.
Welcome back. 25 minutes left in the session. Let's have a look at some individual market movers. Pfizer reporting mixed results with an earnings miss and revenue beat this morning. The company says it's expecting to generate about $15 billion, or roughly a quarter of its total revenue this year, from the sale of its COVID-19 vaccine. The stock's down 2%. DraftKings is searching on news. Cathie Wood's ARK Invest next generation internet ETF bought 620,000 shares. The stock jumping 9%. And UPS reporting an earnings and revenue beat this morning. The shipping company saw a nearly 8% increase in revenue per delivered package in the US market due to a jump in online shopping. The shares are up 4% or so. Be sure to catch an interview with the CEO of UPS tonight, Mad Money, 6 p.m. Eastern Time.
Well, for the rally in silver's pulling back today after the metal hit an 8-year high yesterday. Among the mining companies feeling all this volatility, Hecla Mining, the stock giving back nearly all of its gains from yesterday, falling by about 20%. Phillips Baker, president and CEO of Hecla Mining Company, joins us now for a CNBC exclusive. Phil, this must be crazy to watch all of this. What's been your reaction as silver has got caught up in the whole retail Reddit traders versus hedge funds drama on the way up and now on the way down?
Well, you know, Hecla Mining Company is a 130-year-old company, so we're kind of used to this roller coaster ride that we see in silver that occurs, you know, periodically, and so this isn't unusual, and it's we're built to survive these moves, and we're happy that the share price is actually up 8% for the week. So.
Net, you're a happy guy. What is different, though, than, you know, 100 and whatever years ago from your founding is the appeal of ETFs and the fact that they've become so useful. And we saw SLV, the big silver ETF from BlackRock, attract, I think, $900 million one day last week, which is the most ever. These commodity ETFs are a little more complicated, right, because they have to be backed by physical silver. So how has that changed the whole game and the equation for you and the demand for silver?
Well, it's really opened up people investing in silver in an easy way. You know, before it was complicated, they had to hold the silver themselves. You know, they had all the risk of loss of holding that silver. You know, now they're able to invest in the ETF, and so it's really just made it much easier to democratize, if you will, people owning silver. It's been great, I think, net for our business. Silver prices are, you know, 5 times what they were 20 years ago.
And so who do you think the marginal buyer is now? Or rather, what is their reason for buying silver? Is it as a sort of hedge asset, a protection asset, or because of exposure to its growing use in various different areas?
Yeah, it's both of those things. You know, it's a monetary asset, and you know, gold is not too far from its all-time highs. Silver is halfway there. So I think investors see that, and then they also see that growing use as an asset, as a metal that decarbonizes our economy. You know, it's critical for the electric vehicles. It's critical for photovoltaic cells. It's really a metal for the future.
EVs in particular have been a hot area for investments, all the SPACs, Tesla, of course. To what extent is silver necessary for electric vehicles? GM, for instance, with its announcement that it's going gas-free by 2035. How bullish is that for silver? How much is needed in that kind of production and these visions that are coming out of these companies?
It is a critical element of it because of the conductivity of the metal and the resistivity of the metal. The expectation is that you're going to use about 3.5 times more silver in those electric vehicles in the future than the conventional vehicles that we have today.
What's your take overall as to the influence the dollar's had in the last, let's say, 9 months, the rally that silver's had? It's pushed it back to an 8-year high, not to the sort of 11-year high that others are looking at. If the dollar stabilizes or strengthens from here, do you think silver will plateau at best?
Yeah, certainly if the dollar strengthens, it provides some headwind for silver. It provides headwind for really all commodities. But I think that's is not really the expectation to see the dollar strengthen.
Phillips Baker, we'll leave it there. Thanks so much for joining us.
Glad to. Appreciate it.
We are gearing up for a big afternoon of earnings. Amazon, Alphabet, Chipotle all set to report. We'll tell you what to expect when we go inside the market zone next. 20 minutes left. We're up 1.7% on the S&P.
To build a power plant is to light up a civilization. To purify a waterhead is to last a hope. To build a trackway is to facilitate connectivity. To develop an algorithm is to offer one more possibility to the world. Shanghai Electric. Beyond Shanghai. Beyond electric.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair.
And he's only just getting started. The brave ones, Blake Mykowski. CNBC.
Welcome to the closing bell.
It's the most important hour of the trading day.
We've got just about 36 minutes left to go in today's trade. We are seeing strength overall.
When stocks move, when volume spikes.
Is that suggesting that we think GDP is going to be strong next year?
Keeping you on the leading edge of what's driving the markets.
Many Americans are in desperate need of relief.
Minute by minute.
Partial recovery of what we lost yesterday.
Wilfred Frost, Sarah Eisen. Closing bell. Weeknights on CNBC.
Minutes left in the trading day. We're now in the closing bell market zone. Commercial free coverage of all the action heading into the close. CNBC's senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Luke Capital President Courtney Gibson with us as well. Good afternoon to you, Courtney. Let's get things off with the broader market. Stocks jumping for the second straight day. Both the S&P, NASDAQ less than 1% from all-time highs. Amazing how quickly we get back there. S&P up 1.6%. Dow's up 545 points. The high was 630 or 1.8% at the moment. And the NASDAQ up 1.7. Mike, strong rally up 3.2% over 2 days, suggesting that the GameStop-led stress to markets is behind us.
Yes, at least for now. And I think, 4% decline, high to low, was a pretty quick little shakeout. Bull markets don't really give you a lot of time to decide if this dip is worth buying. So I think it's sort of back to trend. And one of the key things is, we've been hitting on it for a few days, nothing that was going on last week really did bleed into the credit markets, didn't really derail the rise in Treasury yields. And so it wasn't really seen as a macro stress event. That's all to the good. I still think that, the S&P isn't necessarily said, okay, we're back to our orderly ways of ratcheting higher, every day and just keeping the angle of ascent we had going into this year. So, I think you can basically see it as a very good bounce, and let's see if it proves more from here.
Yeah, up already 3.2% for the week, Courtney. Has this opened up any opportunities for you?
Hey, Sarah. Well, good to see you guys, and Mike as well. It's interesting. I actually started buying on Friday. That was a really interesting opportunity where you hadn't seen some names at those levels since October, right? And so when you saw kind of the VIX spiking, you saw some of the fear in the market, in the stock market, you saw fear in the bond market. I mean, you had the 10-year below 1%. We finally are now seeing that creep back above 1%. I think it's still up there today. And so I did pick up on some names that I really, really liked, some new positions, even in the PayPals of the world, and then added to some of those names that I thought were a little too beat up because either A, someone was raising some capital for liquidity, or they just got kind of taken down with the dip in the market.
What did you make of the fact, Courtney, that the likes of the banks or Microsoft or Apple reacted so badly to strong earnings? Was that only because of what was going on with the GameStop-type short squeeze, or does it worry you that for the rest of earnings season, valuations have already kind of priced in some very strong numbers?
Well, anyone who's pricing in strong numbers for valuations in these names and selling them going forward is likely making a very big mistake. I think with those names, they're some of the most liquid names in the market. They're some of the biggest winners when you think about it. And what do people do? They generally are selling their winners when there are challenges in the market and they need to raise cash. I think you saw some awesome earnings. Maybe some people bought the rumor and sold the news. Again, big mistake. Most of these companies have long-term, for those of you who like valuation, they have long-term prospects for growth, and you want to be in them for the long term. You know, whether it's, I don't know whether you like Google Alphabet because of where it is today, or it's only trading at 35 times PE, or you actually like the fact that search is coming back. There's a lot of reasons that you can say you should be in these names. I can't think of very many that you'd want to be out right now.
Up 2% into earnings. UK card spending, including debit and credit cards on securities brokers, surging 300% from last year. That's according to Barclays. The firm citing Reddit investor hype and saying the growth has largely been driven by 18 to 29-year-olds. Meanwhile, Dallas Maverick owner Marc Cuban joining Squawk Alley earlier today, fresh off of his Ask Me Anything Q&A on Reddit. Here's what he said about how investors should be looking at stocks like GameStop right now.
I wasn't telling people to buy more at all. In fact, I said, look, any of us who have traded long enough have been through the pain of making mistakes, and the key is to learn your lessons. And if you're going to hold the stock, if you can afford to hold it, I'm not a fan of selling into a diving market. And so I told him if you can afford it, to hold on. But I certainly not encouraging anybody. But, that said, I am a fan of what's going on with WSB, and I like the idea of this collective buying, and I think it could really have an impact on the markets in the future.
Marc Cuban in support there. Mike, what do you make of either that or the fact that, British, what did I say, millennials, young millennials, I don't know if they qualify as that, are charging these broker trades on their credit cards?
It's old Z's, young millennials. It just shows you that there's a sense out there that it's somewhat an easy game. And I think it was reinforced over the last 10 months because there were some easy wins based on your entry point. I don't think that, the little bit of a comeuppance to the latecomers that chased AMC and GameStop. And make no mistake, the aggregate average price paid for those stocks last Wednesday, last Thursday, last Friday is vastly above where we are right now. So a lot of money got wiped out in that trade if you did chase it toward the end. But I don't think that makes it go away. We surfed from, Hertz and American Airlines and Carnival in March and April to the cloud stocks and to SPACs. So I think that this is a new lasting energy in this market. I think it makes it a little bit more of a jumpy, unpredictable, energetic tape, but it doesn't necessarily mean it's all going to be for the good or all of them are going to be wins. I also doubt that message discipline can be maintained on something like Wall Street Bets for any old stock. It was very specific to GameStop, I think, in a lot of respects.
Mike, why are the market participants not more worried about the retail participation peaking? We've been looking at all sorts of fund manager surveys for so long, and we have a sort of better take on that. It's harder to read on the retail side, but clearly experiencing big losses all of a sudden, whether that's in GameStop or elsewhere, could that not turn the tide of what has clearly been a very supportive trend over the last year, as the Barclays data shows in the UK as well as in the US, for equity market levels in general?
I suppose it could. I just don't think that it goes away that quickly. I think that these are phases, they're not moments. And, it's really not that, it's not even a year old, really, that we've actually been in this mode of seeing that much money rush from that direction. So, yes, at some point, it's going to lead to a little more pockets of irrationality. At some point, maybe it does get overdone in an overall sense. But it's tough to think that that's going to be the thing that takes the market down. Because, by the way, we were in a bull market for a long time without the little guy throwing money at it. So I don't think there's only one way for the market to do okay.
Courtney, does it factor into your bullish view of the market, the fact that there is increased participation and has been, and that could now be at risk?
I definitely don't think that it is a risk per se, right? I think that risk has a negative connotation. More participants in the market, whether institutional or retail, creates more liquidity. There's always, for one person that tells me I should be selling a stock, someone else is saying that you should be buying a stock. And so ultimately, may the best man or woman win in those cases. I do not think that it is a negative piece of the equation. I think people might need to change their models to account for potential risks in the market. Look, when we think about, and I heard that Barclays stat, and I want to go back to it for a second. Last year, credit card debt went down by 10%, and more than $4 trillion was pent up in checking accounts and $5 trillion in savings accounts. That's a lot of money in the market for people to potentially invest. People are not being frivolous out here. You might have some folks that decide they want to take some incremental bets here and there or trade, and then you have some other people that are looking at their 401ks in a very different light than they had before. They didn't know what a value fund was versus a growth fund. Now you have people participating in the market, and that is a good thing from my perspective.
Uber taking a $1 billion shot on alcohol delivery startup Drizly. Deirdre Bosa has the details.
Well, if it all comes down to convenience, that is the next leg in the delivery wars, and Uber is essentially playing catch-up with Drizly. According to Edison Trends, Uber has fallen behind DoorDash and GoPuff in the third-party convenience goods market with just an 8% share. Now, Drizly does give Uber another vendor to plug into the platform, but that strategy, guys, has had mixed results under CEO Dara Khosrowshahi. Wall Street, though, does like the move. Uber shares up more than 7% today.
Dee, thanks very much. I mean, lots of things. We were discussing this a bit on our call, guys, earlier that stand out for me. One is that Drizly is a great service because it allows you to get around the oddity, I think, in New York, where you can't buy both beer and wine in the same store. I've never quite understood that. It also exposes maybe, again, a New York-specific factor of the massively inefficient market where the same product can be very differently priced between different liquor stores. Maybe you never realize that until you get on Drizly, and you can actually arbitrage quite successfully. But to my final point, which kind of brings it back to the market, is it is a service you think will suffer significantly when lockdown ends. And Mike, it's a relatively expensive price. Yes, all stock, but relatively expensive price compared to their revenues.
I think the bet is that, yes, of course, there might be some incremental demand that the service has enjoyed because of the current circumstances, but because it's also on a long-term basis an innovation for all the reasons you mentioned, and just in general, on-demand delivery type convenience is becoming a bigger deal. I imagine that's why Uber felt it was worth 1% of Uber's market cap, 90% of which is in Uber shares, to just have a little bit of a foothold in this area.
Well, it's also taking a category that was virtually zero, which is spending on online alcohol, and just coming up into something and seeing explosive growth, even if we can't see numbers like this continue. Even though we know Wilfred's a big buyer. Courtney, what do you make of Uber? It's part of a broader shift. They've doubled down on Eats, on buying Postmates, and now this, and getting out of some of their other strategic bets during the pandemic. Where does that leave them coming out on the other end?
I think Uber is doing exactly what I would want any growth company to be doing in the market right now, and that is investing, investing, investing for the future. They could have sat back on their laurels and said, oh, you know what? Uber Eats is doing well. I'm going to just stick with it, and we're going to focus on that since our ride-hailing business has slowed down due to the pandemic. No. Instead, they're thinking, where can we invest our capital? They have some investments outside of the United States, and then the acquisition front. I am just completely thrilled with what Uber is doing and continuing to reinvent itself. I remember at the beginning of the pandemic, people thought this stock was going to zero. Look at where it is today.
It's been a big shift. Speaking of, Amazon headlining a big day for earnings after the bell. Let's get to Deirdre Bosa for a preview. Deirdre.
Well, Amazon is set to join the $100 billion revenue club tonight. That's an exclusive one. It only counts Apple and Walmart among members currently. The bottom line for Amazon in focus, too, though, now, even without the fourth quarter, 2020 was already Amazon's most profitable year ever. And that's as it spends billions of dollars on COVID relief and further building out its one-day shipping infrastructure. Keep in mind, though, Amazon shares, they have actually underperformed the broader markets over the last 6 months, up 1% ahead of those results, guys.
Yeah, down almost 10% from the last earnings. Deirdre Bosa, thank you. Courtney, I was looking forward to asking you about retail. Of course, your new board position at Lululemon, and specifically on Amazon, whether these trends will continue post-pandemic, just the amount of e-commerce shopping and buying, and whether companies like a Lulu or an Amazon are thinking in terms of guidance about whether the online shopping boom continues or whether people just go back to the way it was.
Well, Sarah, I am absolutely a very proud board member of Lululemon, and what I'm most proud about is how the management team really took the bull by the horns and adapted to the new structure. I think online and e-commerce, for those companies that did a great job pivoting, they will see long-term growth that probably most wouldn't have even expected. When you think about in Amazon or just retail in general, I mean, the market is less than 20% penetrated at this point, right? Or with Amazon, you think about AWS and how many are not on cloud computing. The marketplace, the TAM, if you will, is just tremendous for these companies, and for well-run companies that are continuing to invest, you want to be a part of it. I mean, now Amazon's in the $100 billion club. I mean, you know, like you said, can't many say that at this point.
Don't know if we can just quickly pull up the Euro chart, guys, intraday. Tiny little pickup, nothing too major, but CNBC can confirm that former ECB chief Mario Draghi has been summoned by the president of Italy, Mattarella, and it's likely to be invited to form a government as prime minister. Of course, the government recently broke down. The Euro bulls will want to see fresh elections avoided, and Mario Draghi's seen as someone that might be able to bring together various factions, as he's not really a distinct member of any of the political parties, and avoiding elections is really what the market would want to see in the short term. Likely that he will be invited to form a government, having been summoned by the president, and the Euro taking a little bit of a step up on that news. We just need Marc to now become the Canadian Prime Minister, and Kuroda, the Japanese Prime Minister, and great stuff for us. Got Janet Yellen's back in the game. All good. Anyway, Mike, 2 minutes left. Internals.
Yeah, I think markets in general would like to avoid elections whenever possible, for as long as possible, but not quite possible here. Take a look at the breadth. It's actually very strong, so it's about better than 3-to-1, advancing to declining on the New York Stock Exchange. Interesting, once again, look at the volume split. Not nearly as impressive. Why? Because 500 million shares between GameStop and AMC on the New York Stock Exchange are to the downside. So other than that, this would be a very strong breadth day, but it's going to foul up some people's indicators as to whether this was a very, kind of vociferous rally that means something for the forward-going outlook. Now, take a look at the VIX, really having a big crush here in volatility, expected volatility, down to 26, back into the range it was before this little blip. Kind of looks similar to what we saw in November around the election, that really sharp drop, shot higher, and then a quick decline. So it's net bullish as long as it lasts, Will.
45 seconds left of the session, off the highs, but still a very healthy gain. The Dow's up 480 points. The high was 630, but up 1.6% as we stand. NASDAQ also up 1.6. S&P's up a little less, 1.4%. That takes the gains for the week over 2 days for the S&P 500 to about 3%. All 11 sectors are higher. Healthcare's at the bottom. At the top, financials, industrials, consumer discretionary, all three of those up more than 2%. Dollar's up 10 basis points or so, giving up a bit of its gain today. Oil's up 2%. Gold down 1.5, silver down 9%, 10-year up to 1.1. And, of course, the likes of GameStop down sharply. GameStop itself is down 60% at the close. S&P up 1.4%, a little off the highs, but a very healthy session as it was yesterday, Sarah.
Yeah, nice back-to-back gains for Wall Street. Welcome back, everyone. If you are just joining us to Closing Bell, I'm Sarah Eisen here with Wilfred Frost and Mike Santoli, CNBC Senior Markets Commentator. Take a look at how we finished up the day. Dow closing up by about 476 points, 1.6%. Biggest positive impact on the Dow was Goldman Sachs. In fact, financials were the best performing sector in the overall market. We talked earlier with Mohamed El-Erian about the yield curve steepening. That's certainly helpful for the profitability of banks, but banks weren't the only ones. Industrials, consumer discretionary, all gaining 2% apiece. Every sector closing higher. The S&P overall up 1.4%. The NASDAQ also rallying strongly thanks to big tech names like Tesla, for instance, which was one of the biggest contributors, up 1.5% on the NASDAQ, and the Russell 2000 index of small caps up about 1.1%. So everybody's higher for the week. Coming up Keep in mind, though, we were coming off of the worst week for stocks since back in October. We've got a lot of earnings coming out this hour. Amazon, Alphabet, EA, Chipotle will bring you the numbers as soon as they cross. We'll also have instant reaction and tell you what to do with the stock. First, let's talk about the market. Courtney Gibson is with us from Loop Capital. Peter Cicchini from Alpha Omega Advisors joins the conversation. First, though, I'll send it to you, Mike, on another strong, broad rally that faded a little bit into the close off the best levels of the session. What does it all tell you?
It did. Actually, for about 5 or 6 days in a row, you've had a little bit of a fade into the close. It hasn't necessarily told you how the next day was going to go. But I think it's certainly a positive to get 2 back-to-back days where you had a significant gain and people felt like the pressure was off and you can go back into a lot of what are considered to be more reliable mega cap growth stocks. Yes, it was broad. I still think you want to withhold judgment as to whether it's just kind of, back to that same upward slanting market that we had going into this year, just because, we really are just back to not even where we were 5 or 6 days ago. And you have to see how the rest of it we absorb this little 2-day pop.
Courtney, as far as you said, you were looking at the opportunity to buy some stocks that had been beaten down and from the hedge funds de-risking as a result of all of this short retail trading action, short squeeze. What sort of names are you getting into, and do you still see opportunity there?
Well, Sarah, we obviously see what financials did today. I think the XLF has made all-time highs right now, and I am a huge proponent. Maybe I'm biased, working for an investment bank and brokerage firm, but I definitely love financials, and I love tech. And there are companies that blend the two together. So even if you didn't play in GameStop, or you're like, I want to steer clear of that, there are names that actually you can be in that are going to do well and did well due to what? Volatility, markets moving. Everything from Market Access, which I sit on the board of, to a Virtu, to the exchanges themselves. When you think about volatility and volumes trading, there are tremendous opportunities in the marketplace. Or you could go traditional banks. I've loved them for a very long time. I bought more Bank of America more recently when the stock dropped
my apologies,
more recently.
just going to jump in and get to these Alphabet numbers that are crossing up 4% in after-hours trade. Big beat, both lines coming in revenue 56.9 billion. The forecast was for 53 billion. EPS coming in at 22.30 per share. The forecast was for 15.90, so a nice beat on both lines. Just trying to look through the individual line items. We're looking like overall services revenue coming in at 52.8 billion. Cloud coming in at 3.8 billion. The forecast there was for 3.8 billion, so that's largely in line with expectation. Sarah, Mike, just going to keep digging through some of these individual line items, but top and bottom lines, nice beats, up 4% in after hours.
Just want to point out some news on Amazon, which is also moving after hours as we get earnings. Big announcement. It looks like there is going to be a CEO change at the top of Amazon. This is obviously huge news. Andy Jassy is going to become Amazon's CEO, replacing Jeff Bezos. Jeff Bezos will be the executive chairman. Obviously, Bezos, the founder, longtime CEO. Stock is down 1.5% after hours. We're going to dig through the earnings as well. But that's a huge sort of news item, Mike. As far as CEO changes, hard to imagine a bigger deal than Amazon.
Yeah, no, absolutely. Tremendously big news. I don't think it was necessarily handicapped. It reminds me a little bit of when Bill Gates, roughly 20 years, I think, after Microsoft's IPO, did step down from day-to-day control of Microsoft. And, Andy Jassy, of course, been there, of course, responsible for AWS, maybe says something about the future growth path in terms of the priorities of the business. But not surprised to see just a little bit of a reflex lower in Amazon. But executive chairman, he's staying, he's the biggest shareholder. I'm not sure it necessarily changes the broader picture.
Yeah, Wilfred, I was just going to bring up the point on AWS. Amazon back on the move higher now after hours, up 2.3%. He ran AWS long time. That's the cloud business. Wilfred, it's the profit driver for Amazon. Its growth has moderated a bit lately, and it's faced some pretty steep competition from the likes of Microsoft and Google, all trying to capture some market share from cloud. When you think of Amazon and the investment case there, most analysts do point to the market share reach of retail in particular and what they've been able to do to transform how we shop, e-commerce, especially in the pandemic, what they've done with grocery. I think let's get to Deirdre Bosa, who has a little bit more on this pretty big shakeup. Deirdre.
Yeah, and Sarah, I'm just looking right now at this memo that Jeff Bezos has issued to his fellow Amazonians. He says that he intends to focus his energies and attention on new products and early initiatives. And he says, as we well know, he is well known within the company. He has been at Amazon almost as long as Jeff Bezos. Bezos says that he will be an outstanding leader and has my full confidence. I'm looking through this right now. He says as well that they've decided to use their large scale and scope to lead on important social issues. He says that he finds his work meaningful and fun. And he says, as much as I still tap dance into the office, I'm excited about this transition. I would say, guys, you talked a lot about it. Andy Jassy is well known. He led and really created AWS, which gave Amazon a 7-year lead in the cloud that, Microsoft and Google, the other big players, are still trying to catch up to. There was some concerns a few months ago when one of the top executives stepped down, Jeff Wilke, and some wondered maybe what would that mean for succession plans, because he was another name that was floated around. But Andy Jassy has always really been the person that many people look to that, has really helped Bezos build the company. But I think it is surprising that this is happening now because Bezos is still young. And as he says, he tap dances to the office. I'm not sure that anyone expected him to step down this early, but it does certainly represent a new chapter. And guys, I will now dig into the financial results and bring you those as soon as I've got them.
Well, I've been doing that, Dee, whilst you were going through that. And that's probably the reason the shares reversed their losses, though ironically, AWS actually a slight miss this quarter, but still strong, of course, year over year in terms of gains. But let's just run through these numbers. So revenue coming in at $125.6 billion. The forecast was for $119.7, so a nice $5 billion beat there on the revenue line, and a comfortable, almost doubling their EPS estimate. The estimate was 723, came in at 14.09. Just going through the individual lines very quickly. So AWS revenue was forecast at 12.8, came in at 12.7. International revenue came in nicely ahead of forecast, 37.4. The forecast was 32.4. And North American also ahead, but just slightly, 75.3. The forecast was 73.9. So it was really on North American international sales that was beat on the revenue line, particularly international, as opposed to on the AWS side. And just looking at the guidance as well for Q1, revenue guidance was expected to come in at 95.7, and they're giving a guide of 100 to 106 billion for Q1. So a nice beat there. Going to be interesting as well, just Mike, if I dig in a bit deeper, to see where their EPS beat has come through. But I wonder if it is COVID costs not coming in quite as high expected. They're forecasting $2 billion in COVID costs for the first quarter. I've just got to dig in and find that for the past quarter. But either way, a strong beat on the top line and very much so on the bottom line.
Yes, very strong. And I also would say that in terms of the revenue guidance for the current quarter, above the consensus forecast, it's a company that is usually not over-promising on a forward-looking basis, so usually conservative. Yes, we're a month into a 3-month quarter, but that's not a very wide band. So that's probably just a small net positive, not the biggest quarter, of course, on retail anyway.
John Fort able to join us as well. John, nice numbers, but no doubt you're more keen to reflect on this pretty significant news on a change of CEO.
Yeah, Andy Jassy, that's big news. Andy Jassy, of course, has been at Amazon for nearly 25 years, and he founded Amazon Web Services, in 2003. And, I've talked to him many times about the founding story of AWS, about his relationship with Jeff Bezos. I think it's interesting that just a few months ago, the head of Amazon's consumer unit, which is, the more traditional Amazon.com part of the business, he stepped down. Now Andy Jassy being elevated to this position. It goes to show just how important this cloud business has become to Amazon overall. And of course, it was born out of the core needs of Amazon's e-commerce business and the thought that, boy, they could use this same infrastructure and this same flexibility that they needed to change the game for enterprise software and enterprise infrastructure in general. And now that's expanded in so many different directions. They're innovating in hardware. They're really driving a lot of what's happening, not just in enterprise, but even in the chips business. So, you know, this move from Amazon is interesting. And Andy Jassy has perhaps in some ways been an underappreciated figure in technology over the last 20 years, but he has been pretty well appreciated, I will say.
Yeah, it's certainly appreciated by his boss, becoming CEO. I just want to highlight that we're keeping track of all the after-hours movers for you. Alphabet's up 7% right now on a big earnings beat. Chipotle's flat, and Electronic Arts is down 5%. You can see them all on the side of the screens on the market zone. But John, we'll stick with the big news here, and that is Jeff Bezos handing the reins to Andy Jassy. Thanks for giving us a little tutorial on who Andy Jassy is. Are you surprised the shares of Amazon, it was a huge quarter, are up a little bit, but this is a stock. I mean, we have to talk about Jeff Bezos and what Amazon looks like without Jeff Bezos, who is the founder, right? Famously started in his garage, had the vision that a lot of people on Wall Street did not see, and then they did, and they rode that wave. It was a tremendous one, becoming not just the most important online e-commerce retailer, buyer of Whole Foods, and now major cloud player. John, what does this company look like without Bezos running it?
You know, I'll want to hear more about exactly what Bezos is going to do. You know, he's stepping down from the role as CEO. I'd be shocked if he steps away from Amazon entirely. I just don't believe he's capable of that. So more detail I'll want to hear, but keep in mind, Larry Ellison hasn't been the CEO.
May have just lost John Fort there. We'll get John's connection back up and make sure we come back to him. In the meantime, Deirdre Bosa has been looking through the release and has more reflection on this news for us.
Yeah, so it looks like Jeff Bezos is not going to be stepping away entirely. In this memo, he says that executive chair, he's going to stay engaged in important Amazon initiatives. But he also says that he's going to use some of his new time and energy to focus on some of his other projects, including the Day One Fund, the Bezos Earth Fund, Blue Origin, his space company, of course, and the Washington Post, he says, among my other passions. He says that he's never had more energy, and this isn't about retiring. And guys, it's interesting because I remember, you know, over the last few years, there was always this question, you can bet on Amazon and you don't bet against Bezos, but what happens if Bezos isn't there anymore? And I think it really speaks to the bench of talent that he has developed, the fact that Andy Jassy is still there. We've actually seen a number of high-level Amazon executives go to startups over the last few years. One went to Airbnb to be the CFO. So there has been sort of a little bit of an exodus, but Bezos has managed to keep some of the very top people, that tight circle there. And that's why it was a bit of a shock when Jeff Wilke left late last year, too. So perhaps it's a way of keeping Andy Jassy as well. He's so important to the company, and you've seen other executives pursue other things.
So important to the company, Mike. Interesting, though, snapshotting this particular quarter, AWS revenue 12.7 billion. The total revenue, of course, over 125. So AWS, a tenth of the revenue, makes up, of course, a much bigger percentage of the bottom line. Operating income, 3.8 billion, the total for the quarter, 4.5. So it's a huge part of the profitability, huge part of the multiple expansion it's earned. But quite different skills one would need to run that part of the business versus, to be crude, a retailer.
Yeah, you would think, although it is all mostly systems and data centers and deciding on capital budgets and exactly how aggressive you want to be getting out there. And of course, you know, it's a faster growing segment of the overall economy in terms of cloud services than top line retail. So that's why you have the higher margins and the faster growth. But yeah, without a doubt, it's going to be different. It's a much bigger job. And I think, if I could take an educated guess of what John was going to say, he's going to point out, Jeff Bezos becoming kind of executive chairman. Larry Ellison 6 or 7 years ago stepped down as CEO of Oracle, but has remained there as a presence. There have been co-CEOs after him. So I think there's a lot of different ways you can have more or less involvement as executive chairman, and it could be a way of kind of ushering in the next generation of leadership. It's a question as to whether how much is actually ceded to the new people. We'll have to see.
John, we got cut off earlier. What was your thoughts that you were finishing off?
Well, I don't even have to say anything. Mike said it. No, that's exactly the point that I was going to make, is that Larry Ellison hasn't been CEO of Oracle for quite a while, but is very much present and is very much influential at that company. And you look at, Bill Gates stepped back from the CEO role, but still had an outsized presence at Microsoft for years. There's nothing like a founder. There just really isn't. And Jeff Bezos is such an integral part of what Amazon is. His presence will still be felt there. And he's been doing a lot of different things for a long time. So I wouldn't take this as a fundamental shift in what Amazon is or necessarily how it's focused. I do think it is a statement about the value of AWS and the things that Amazon has been innovating in there. I mean, if you think about the scale of it. Yes, if you're just looking at revenue, that's one thing, but the retailer part, I mean, the gross revenue there is like an entirely different beast than what you've got in AWS, which is infrastructure as a service, software as a service, platform as a service, really building out different server and networking infrastructure. It's database now, it's chip design internally. Really, there are a lot of different areas where Amazon is expanding and could yet expand under Andy Jassy. And, so investors really have to look at and understand Amazon's bench in a whole new way now, the scale of what's been happening in Seattle. And I'm intentionally saying Seattle because it's Amazon, it's Microsoft, and lately it's a lot more than that. It's really impressive.
Amazon now unchanged, down a little bit after hours. We need to hear from an investor, Courtney. Even if what John says is true, and it sounds like he plans to stay on as executive chairman and won't be too far away, without him running the day-to-day business and being the CEO, does that change the investment thesis around Amazon?
Look, as the founder of that company, I highly doubt that he would not have put someone in that seat that he felt could do the job as good, if not better than him. And he'll be there to help shepherd it along. Andy's been there 25 years, as we've talked about. 25 years is a long time. And when we talk about skill set and we talk about managing a business, I'm sure that he's had a tremendous amount of exposure across that business and influence that one might not even know that he's had. So I think this is an incredible move by Jeff, by the team at Amazon, by their board in positioning them for the future. And I don't know about you, Sarah, but it's not going to change my decision to have 15 more Amazon packages delivered to my house tomorrow. So let's really kind of put this in perspective as to what Amazon as an institution is, and as an investor personally, and as a brokerage firm on behalf of a number of institutional clients, no one is running to a fire sale on Amazon due to this news.
Peter, remind us what the valuation of this company is like, and I guess quite an impressive beat on the bottom line in particular this quarter.
Yeah, I mean, I think we're at about, for Amazon, at about 80 times 2021 earnings. I think the reason why the Jassy move is so important and astute on the part of the company is that we got to think about what comps are going to look like for next year. I mean, a lot of demand and a lot of activity has been pulled forward due to the pandemic. And, the business has made tremendous, maybe 2 or 3 years worth of progress in just a year. And so I think the really interesting part of this is that it focuses investors on the future, on the business that's growing the fastest, and perhaps away from what are going to be really difficult comps for next year.
If you're just joining us, let's remind you what's going on. Amazon just out with earnings, beating estimates on both lines. The biggest news of the report, though, a leadership change. Jeff Bezos will transition to the role of executive chairman in the third quarter, and AWS chief Andy Jassy will become CEO. Let's bring in Tom Forte from D.A. Davidson. He's got a buy rating and a $3,800 price target. Ed Lee joins us as well from the New York Times. Good afternoon to you both. I'll come to you first, Tom, because interesting watching the share price reaction. Understandably, people initially a little worried at the fact that Jeff Bezos might be stepping down, though executive chairman role, he'll still be there. And what's your take on Andy Jassy?
My take on Andy Jassy is Amazon is declaring that it is a services company. So you think about AWS, you think about retail as a service, empowering third-party sellers to sell products on Amazon, delivering those products on behalf of third-party sellers. So I think that this is a declaration that Amazon is a services company. And when you go back in its history, when it launched AWS and embraced the relative strong margin versus their first-party retail business, that is why the stock is where it is today. So I think Andy Jassy can lead the company forward as a services company.
Tom, in the statement, Bezos calls it an optimal time for this transition. I think Jassy was always seen as an heir apparent, was he not? But the timing comes as a bit of a surprise. Why do you think this is happening right now?
So I do acknowledge that it happened earlier than I would have anticipated. And looking back, as John Fort pointed out, when Jeff Wilke retired, I think that tipped off that Andy Jassy was in line to be the heir apparent. But to Jeff Bezos' credit, he's handing off the company when it is incredibly healthy. So he's giving Andy Jassy a very strong Amazon. And Amazon, if you think about it, is potentially at a turning point when you think about what they're doing in healthcare with Amazon Pharmacy, with testing their employees for COVID, with clinics for their employees' families for COVID. So again, I think it's a declaration that long-term Amazon is a services company.
Ed Lee, I mean, clearly Jeff Bezos is still going to be executive chair, but also the release says he'll have time to focus on the Day One Fund, Bezos Earth Fund, Blue Origin, Washington Post, and other passions. He's going to remain a very busy man, of course.
He will remain a busy man, as you said. I mean, but look, founder-led companies are founder-led for a reason, and I agree with John Fort entirely. I'm actually going to sort of take it a step further from what John was suggesting or saying, and how much of this leadership change is sort of a de facto versus a de jure change. In other words, these other interests that Jeff has had are things that he's always spent a ton of time doing, and Day One is sort of a key phrase for him. It's sort of his mantra where, you know, every day is Day One, which means you cannot rest on your laurels. You have to continuously innovate, come up with new things. I think he's always been playing that role, and all these different divisions, whether it's AWS led by Jassy or the retail led by Dave Clark, they've been really well managed. So he's been the guy at the top who can sort of do the more fun stuff, right? Innovate, and very much in the vein of how startups, even long-running startups, have been running. So I think, you know, there's maybe just a formality to what has already been. And in that way, I don't, you know, the thesis on Amazon really shouldn't change for that reason. If anything, you know, if it's more official, you're going to look for more, you know, he was interested in drone deliveries for a while, and I know that's still something he's looking at. So just look out for more crazy and fun ideas from him beyond just his own personal stuff, whether it's the Washington Post or Blue Origin. I think Amazon ultimately benefits from this more official change of what he has already been doing.
Maybe why we're not seeing a huge reaction in the share prices, Mike. What do you make of it? It's down now 0.5% or so. Would you expect it to be down more, given how intertwined Jeff Bezos was with the investment thesis of Amazon? The whole Amazon comes into your space and then, you know, the stock plummets, whether it's in groceries or pharmacies or cloud or whatever else it's gone through over the last few years.
I don't know that I'm surprised. I don't think it would be expected to be down that much more, probably because it's considered to be just such a powerful machine, and that Jeff Bezos' culture that he's created there, I mean, you don't even have to be part of the company to have like memorized the 1997 letter to shareholders from the IPO prospectus. I mean, I think it's just become such a cult of how we do things. So I don't think for that reason people think it's going to change course. And also, and I would never, ever propose this as some kind of a reason that precipitated this move, but there has been one line of criticism out there as we look at all the other things that Jeff Bezos has been interested in devoting time and resources to, just asking the question, is he more outward facing right now? Is he paying attention to other things? He obviously got a divorce. There's been the whole thing about a headquarters contest to where are we going to move and more showing up at, Hollywood industry stuff. So I don't think people wanted him out by any stretch of the imagination, but I think already there was a sense that it was less nose to the grindstone every day, and that basically the company is what he built and the culture is what he constructed. And I think you can have some faith that that's going to persist.
Tom Forte, just quickly, clearly Andy Jassy's department, AWS, has the highest profit margin. Should that be a focus for him to improve profit margin in the other parts of the business in the year ahead?
So absolutely. I think if you look at their efforts in advertising, you look at their efforts in enabling third-party sellers to sell on Amazon, which is a higher margin effort than first-party sales on Amazon. I think that, again, Amazon as a services company will benefit from higher margin than the original Amazon retailer that we think about.
Andy Jassy becomes the CEO of Amazon, the head of AWS. Thanks, everybody, for weighing in. We appreciate it. Tom, Courtney, Ed Lee, Mike Santoli, the works. Coming up, we're going to have much more on this decision, Amazon's stock move, what it's going to mean for the future of this company. Amazon getting a new CEO. Plus, we will dig into Alphabet's blowout earnings with an analyst who sees more upside for this stock, moving sharply higher already and after hours. We'll be right back.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
This story went from a dilapidated, rundown duplex all the way to the White House.
Mr. Haley was surprised at how easy it was to make an extraordinary amount of money by doing essentially nothing.
How far would you go?
You can smell the money. That's why the clients come here.
For money.
$40,000 would be paid for the killing of the judge and the prosecutor.
American Greed on CNBC.
Movers all around. Amazon with the big news that Jeff Bezos is stepping aside as CEO. Andy Jassy, the head of AWS, the cloud business, will become CEO. Bezos will become executive chairman. Stock moving a bit lower after hours, initially surging on much better results from Amazon. The big mover, though, is Google parent company, Alphabet, that is, up 6.25% on the back of strong earnings. Mike, just wanted to hit Alphabet for a moment because we've been so focused on Amazon. It was a big profit beat, and it looks like it was a big revenue beat as well as the ad business comes back from the depths of COVID.
Yeah.
What do you see?
Absolutely. And by the way, the stock came into the report at a high. It was outperforming the other FANG names. I think it has a little bit of that benefit of having some comeback potential because the ad market should get better. But I always say this. I mean, I think pretty much every quarter you can say we've really never seen companies at this scale, at this level of market value and revenue that are growing 23, 24, 25% in revenue and operating income. So it's just one of those things where this is the kind of business advantages that the market was paying up aggressively for when we said it's only 5 stocks in the whole market, that's all that matters. And I think it kind of proved it out right here when it came to Alphabet. You know, I think to also probably have to start being many more questions about what it's going to do with its cash. It pretty much is, it's rivaling Apple in terms of total cash, more than that net cash. It basically, it's pretty conspicuous that it does not really have to spend very much on capital versus what it takes in, and doesn't pay a dividend, isn't all that aggressive on the buyback side. So that's just a longer term thing that you might look for.
Ed Lee from the New York Times still with us, and Ed, clearly great numbers driving the stock higher, including on the bottom line. Interesting to see the Google Cloud number come in basically in line on the top line, 3.8 billion. Of course, for Amazon, the cloud is the most profitable part of the business. For Google, though, coming in at 1.2 billion loss on Google Cloud, which is slightly more than the loss a year ago in the same quarter. So kind of interesting there that it's not delivering the profitability yet, though clearly the advertising business is in this quarter in particular. And when you consider both AWS and Google in the cloud performance relative to expectations, Microsoft the winner perhaps this quarter in cloud.
Definitely. And I mean, the Alphabet or Google Cloud, they need to spend more now to catch up. I mean, they're gaining steam, but they're a distant third to Amazon and to Azure. So I think, that investment, I think, is absolutely key. The fact that advertising came back really strong in the back half of last year is certainly helping them, not just Alphabet, but Facebook, all digital players. And I've done sort of channel checks of my own with media buyers. What's happening partly is that, a lot of the money that traditionally has been spent on TV, they're really just now moving into digital at an accelerated rate. So, of course, Alphabet and Facebook have always benefited from that, but now they're benefiting even more, as are some of the smaller digital publishers as well. So that is just expect that to continue. And I think, what we want to hear from on the call is just more color on how they see their cloud business, when they need that market share. So how much more capital expenditures, et cetera, they plan to pump into that.
Yeah, going back to the Amazon story. Ed Lee, thank you very much. We're going to keep an eye on those after-hour movers. Also want to quickly hit shares of Chipotle, which is falling after reporting Q4 earnings that missed expectations, both on the bottom and top line. Joining us now is Nicole Miller-Reagan, analyst with Piper Sandler, who's overweight the stock, recently upped her price target to $2,000. Given the backdrop, Nicole, the stock had run up so much, near the highs. This was a miss. What happened?
Well, I think the stock price movement is just high expectations. Any, opportunity to buy it lower, we would be very action-oriented in that way. The comp, when you round it, really was in line with consensus. 6% comp is really what the street was looking for. And I think, what's going to be important on the conference call is what they say about current trends in terms of comp, January, of course, and then also the margin algorithm. So they're producing much higher volumes with digital efforts, and how much can they juice the margins ultimately with the benefit of digital?
Nicole, is this a reopened stock, or has it benefited a lot from being so great digital and delivery-wise during the lockdown?
Yeah, that's a great question. The stock did well when we were, let's say, closed, because they were proactive versus reactive. And a lot of that is the operating structure, the ownership mix, and then, of course, the balance sheet. I think about it this way. The last, year or two of the stock working and the performance was about recovery. Going forward, it's absolutely about unit growth. And it's going to be the single largest or really only growth stock in terms of large cap restaurants. And so it will dominate in that way.
She's a buyer. Nicole, thank you very much for weighing in on a busy news afternoon. Nicole Miller-Reagan on Chipotle. Still ahead, we've got much more on the big story of the hour. Amazon CEO Jeff Bezos announcing he is stepping down. We'll be right back.
Divided by distance, united by business.
This is the new reality we're all in.
Helping you navigate the new normal. Squawk Box on CNBC.
Reporting on the Federal Reserve is one of the pillars of CNBC's coverage.
You guys ready? Here we come. Let's get to Steve Leisman with the Fed decision.
Up by 1/4 point.
Put up the Dow. We're up 250.
Obviously, the market reacted to it.
New Chairman Jerome Powell will hold his first news conference.
Afternoon.
Leisman gets the first question.
Where's your biggest concern here? Is it in overkill when it comes to rates? There's very little that moves the markets as consistently as the Federal Reserve does.
Give me Treasury.
I feel tremendous responsibility both to get my reporting right and to get my analysis right.
Inside Ireland's position post-Brexit.
I think this is the least worst Brexit that we could have anticipated. All our major objectives have been achieved. In terms of the island of Ireland, there is no hard border.
Coping with COVID and Irish unity.
And I come from a party that has always believed in the unity of the people of Ireland, and we must work out what a shared island would look like into the future.
Ireland's Prime Minister, the Taoiseach, Micheál Martin, sits down for the CNBC conversation.
Welcome back. Time for a CNBC News update with Rahel Solomon. Hey, Rahel.
Hello again, Wilf. Good afternoon, everyone. And here's what's happening at this hour. The Senate has narrowly confirmed Alejandro Mayorkas to be Secretary of Homeland Security. That's by a vote of 56 to 43. He is the first immigrant and the first Latino to lead the department. In South Texas, another SpaceX rocket test ends with an explosion. The Starship prototype launched successfully, but then failed to land evenly and went up in flames, as we just saw there. The CDC reporting just over 550,000 new COVID vaccinations today. That's roughly half of yesterday's figure, although many vaccination sites in the Northeast were closed due to the massive winter storm. And Italy's next leader is likely to be a technocrat after the major parties failed to form a new government. High on the list to be the country's next prime minister is former European Central Bank President Mario Draghi. Sarah, I'll send it back to you.
Yes, all over that one, whatever it takes. Rahel, thank you. Rahel Solomon. Josh Lipton has more on Alphabet's quarter. What can you tell us, Josh, with the stock surging after hours?
Yeah, surging is right there, Sarah. Being on the top and the bottom, revenue surging 23%, better than expected, $56.9 billion. Had the chance to catch up with CFO Ruth Porat. We talked about the trends and themes she saw in that quarter. She talked about an increase in advertiser activity in the quarter. Customers, she says, unlocking budgets that they had paused earlier in the year. An increase, she said, in consumer online activity. called out notable strength in search and YouTube. We also did talk about Google Cloud. Revenue there up nearly 50% year over year. That business, though, also losing about $1 billion in the quarter. I asked her what the pathway is to profitability for that business. She basically said, listen, they are in investment mode, spending still on building out data centers, infrastructure, and, of course, salespeople. Margins, she said, there will benefit as they scale over time, of course, competing there with the likes of Amazon and Microsoft. And finally, we talked about that regulatory threat, the challenges for management there. She sees them. She says, listen, the DOJ lawsuit, in her words, deeply flawed. People use Google, she argues, because they choose to, not because they can't find alternatives. Conference call kicks off at 5 p.m. Eastern. Back to you all.
Interesting to get that reaction on the antitrust suit. Josh, thank you. Josh Lipton. Up next, much more on this big story. Amazon's Jeff Bezos stepping down as CEO, Andy Jassy of the cloud business taking over. We're going to talk to a friend of Andy Jassy and former Amazon employee when Closing Bell comes right back.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Since the COVID crisis, we've seen a 2 to 3 to 4 times increase in the daily volume of data. We're supporting up to, say, 160 billion data messages 24 hours period now, which is just an extraordinary volume reflecting the volatility in the market, as you say, the increased retail activity in the market, and a whole set of other factors. We're also seeing the demand for data increasing as well. Demand for our ESG data has risen by 4 or 5 times across the world and in Asia as well.
Big news this hour, leadership change at Amazon. Jeff Bezos will transition to the role of executive chairman in the third quarter. AWS chief Andy Jassy will become CEO. Joining us by phone, Bill Carr, former digital media executive at Amazon. He's also the author of a forthcoming book on Amazon called Working Backwards. That comes out next week. Bill, you're going to have to change the conclusion, perhaps, of your book. How surprised are you by this change?
Wow, well, it is pretty big news. Quite the end of an era for a man who will certainly go down in history as one of the greatest business leaders of the 20th, if not 21st century.
What was your position there, and how well do you know Andy Jassy?
I know Andy well. I joined the company back in 1999, and I became the vice president of digital media in 2004. So my role was one of the founding leader of what was today known as Amazon Music, Prime Video, and Amazon Studios. So I launched and ran those businesses for a decade on a worldwide basis, and during that decade, I worked closely day in and day out with Jeff Bezos to help formulate the vision and the details of those big businesses.
So, Bill, talk us through if this is a blow to the company or a step up, given that that you'll have Jassy in this role, but still have Bezos as executive chairman.
Yeah, well, I think you'll see a continuation from, where they are. So having read the letter that Jeff shared with the company, it sounds like he plans to devote most of his time to working with the company on their new product innovations. And, honestly, he beginning in 2004, he was spending a substantial portion of his time working with me and my team and my boss, Steve Kessel, in digital media. And then he was working with Andy Jassy to help formulate Amazon Web Services. And so I think that's probably been how he's been spending the majority of his time, all the way back to 2004. Andy Jassy is an amazingly talented executive. He started and has launched and ran one of the most successful businesses in the world today in Amazon Web Services, and the company is in great hands with Andy Jassy and his leadership.
We also want to bring in our reporter on Amazon who has covered Bezos and Jassy, Deirdre Bosa out west. And Deirdre, it occurs to me, obviously, there are books written about Jeff Bezos' leadership, and there will be, I'm sure, many more case studies. But when you think about the future, there are some issues here. For instance, there are questions about whether the workers are going to unionize. There are questions about the treatment of warehouse workers during the pandemic, of course, and some political questions as well around antitrust and whether Amazon, for instance, rips off some of its third-party sellers or prioritizes its own. How's Andy Jassy going to be able to take all of these on, and how big of a risk or threats do you see these as?
Yeah, that's a good point, Sarah, because while this is arguably the most successful phase in Amazon's history, it's also one of the most challenging. Unionization, labor issues, antitrust issues. But when those history books have been written about Bezos, Jassy does play a major role. So, you would think that he would be well equipped, having worked alongside Jeff Bezos for over 20 years. Now, I did just talk to Amazon's CFO, Brian Olsavsky, and I asked him, what might we expect from this leadership change, from Andy Jassy leading the company? And he said that Andy brings his own skill set, that he's a visionary leader in his own right. He understands what makes Amazon such a special, innovative place. He also said, though, that there's going to be a lot of continuity. He says that Jeff will have input on all new businesses still, and what he calls a one-way door decision. Those are decisions that are not reversible, unlike two-way door decisions, more Amazon lingo. At this point as well, we're also wondering who is going to take over AWS, which, as we know, is such a critical part of the business. Olsavsky, the CFO, said that they're not announcing anything in relation to who will head up AWS at the moment. He says that they're going to work out those details between now and the third quarter when this leadership transition happens. On some of those COVID costs, which we know have been billions and billions of dollars over the last year, those are actually going to shift downwards in the first quarter. And Olsavsky says that that's mainly due to volume. They're expecting volumes to drop from about 25% from Q4 to Q1. And so COVID cost guidance, guys, is $2 billion, which is down from about $4 billion in the fourth quarter. This call is still going on, so I'll hop back on it and bring you anything else as we get it.
And Bill, just to round things off, what do you think are the best skill sets that Jassy has, and some that he might not have? As you said, you've worked closely with him, and he's a friend of yours.
So Andy is an extraordinary leader, as the reporter commented. I mean, he's worked at the company for more than 20 years, and he's worked side by side with Jeff during this period of time. Look, he and his team have invented an entirely new category called cloud computing, a category that back in 2004, no one would have thought that Amazon would have any right to even participate in such a thing. That would have been the place of Oracle or IBM or Microsoft. And, he's created a runaway hit. So he's an incredibly inventive leader, and he's an incredibly detail-oriented leader who dives into all the salient details of his business. He knows how to manage, and he's a shrewd operator. He's going to be a great leader for the company. And furthermore, both Jeff and Andy and the many other leaders of the company have spent the past 20 years building a whole management science, really what we call the Amazon invention machine in our forthcoming book, Working Backwards, that describes these scalable, repeatable processes that they've been able to employ with the company to allow the company to scale and grow and manage such a diverse set of businesses all around the world. So I think Andy's going to be great.
Bill Carr, great to have your perspective. Thanks for jumping on the news line with us.
My pleasure. Thanks for having me on.
We appreciate it. Former Amazon executive. Shares of Alphabet also moving higher after reporting a big earnings beat. Up next, we're going to dig into those numbers, plus an analyst take on Amazon's big CEO change. A busy closing bell. We'll be right back.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
I don't think these measures are going to have a huge impact. I mean, it's really an opening gambit, isn't it? Because I think even during December, when everyone was talking about the visitors from the UK, the hotel capacity was at sort of 70, 71%. So restricting capacity to 70% may not make a huge change. And I mean, I live in Dubai, and I can see that the roads are still full and people are going to offices.
Feeding the world whilst protecting the planet.
Our global food system uses half of our habitable land on Earth, and 1/3 of that is degraded, threatening the sustainability of our sector.
We are aiming to balance climate change, biodiversity, and food production to protect 30% of the planet.
Attracting finance for farming.
When we think about the farmer, we need to help to bridge the gap of risk.
Advancing agriculture on the next CNBC Virtual Davos Debate.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Next, an analyst take on Amazon's CEO change, what the shift might mean for the stock and your money. Closing bell, back in a couple.
Siemens Energy has announced it will cut almost 8,000 jobs by 2025 as part of a cost-cutting program. It comes as the German company returned to profit in the fourth quarter, but warns restructuring costs could stretch to hundreds of millions of euros.
We are obviously more or less a mirror of the energy world. It's now always keeping the balance. On the one hand, really driving the growth part, and at the same time improving the areas where we see more challenges in the market, like oil and gas.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
The news is
coming so fast right now. The pandemic has brought on a mortgage crisis. People are unable to pay their home loans because they've lost their jobs. Overnight, more than 4 million homeowners were asking for a mortgage bailout. The other story of the pandemic is this surprising housing demand. People want a backyard. They want home fitness. They want high-tech homes where they can homeschool and work from home. The home is the most important thing right now. At CNBC, we cover your financial health. That's what we do best.
For news headlined by the leadership change at Amazon, founder and CEO Jeff Bezos will become executive chairman. The head of Amazon Web Services, Andy Jassy, will become CEO of the company in Q3. We've also had earnings from Alphabet. The stock's up 6% after hours. Decent beat on both lines. Joining us now, Brent Thill from Jefferies, a buy rating, price target of 2150 for Alphabet. Mike Santoli, of course, still with us. Brent, first of all, your reaction to the Amazon leadership change news.
I think it's not a shocker. Andy obviously ran the AWS business to one of the biggest software businesses on the planet. Every startup we talk to and mature company is using AWS to underpin their back end. This is the bulk of the profitability for Amazon. It lets them experiment in the other segments of the business that are less profitable, like retail. And so we think ultimately this is a great move. I don't think that really much is going to change. Obviously, if you're a software individual, which I am for 20 plus years, we're all excited because this is the recurring visibility and the bulk of the profitability of the company. And we think that this will only firmly establish that they're going to continue to spend aggressively against Microsoft and Google. So we like this move. Obviously didn't expect the move, but think Andy obviously is an incredible leader. And what they built in AWS is really hard to comprehend given what they did in the face of all these other tech giants that were chasing them that were really, software DNA. Amazon was not a software company to begin with.
To the point of those other tech giants, what do you make of Alphabet numbers?
Phenomenal. Best top line in 2.5 years, best bottom line in 3 years. The cloud number was a little in line. Microsoft Azure actually outgrew the Google Cloud. So Microsoft's taking share. And the Microsoft Azure number is bigger than Google. So, good numbers overall. This is a cheap stock. Again, we see the stock going higher on a 15 times EBITDA multiple. Again, the stock's trading below its EBITDA growth. We continue to view Alphabet as a top large cap bet for us alongside Amazon and Microsoft.
Back to the big news, Brent, on Amazon. You mentioned you're excited as someone who covers software and someone who knows Andy Jassy and has seen the juggernaut that he's built inside of Amazon. But ultimately, Amazon is an online retailer. That's the bulk of the company, right? And it owns Whole Foods, and there's so many other aspects. So what does the appointment and the future look like for that, which has been in such a big growth period because of the pandemic and does face some tough comps as we come out of COVID?
Yeah, look, the retail business is phenomenal. I'm not trying to downplay that. It's incredible. We think it's long-lasting. E-commerce tailwinds are permanent, and we do believe they're in great shape. But to your point, Sarah, there is going to be a deceleration in the retail business, and that's why the software business is so important. The high visible revenue growth stream, this backlog growth they've been reporting to between 40 and 60% backlog gives investors encouragement that when the e-commerce business slows, and it will in the second half, that the software business continues to power forward with extremely high margins and visible revenue. Secondarily, the advertising revenue. Again, advertisers are flocking to this platform. That is a high margin business. So again, we don't want to de-emphasize the retail business, but we think there are other engines of growth that keep Amazon at altitude. They're not going to lose altitude because they have all these other businesses that no other retailer has.
Brent, Phil, thanks so much for joining us. Much appreciated. Reminder, of course, that during the actual session, GameStop closed down 60%. Broader markets were higher. The NASDAQ was up 1.5%. Will be boosted by these results, of course, tomorrow.